as a backup.
Oh, hey, we're going. We're live. Karen got it working. Okay, folks. I apologize for the technical difficulties. We want to thank our sponsors.
You're watching SuperCrowd25, the biggest event in impact crowdfunding. Over 2 days, top experts, investors, and mission-driven founders are sharing how to raise capital, discover profitable investment opportunities, and change the world. Stick around. You'll hear stories, strategies, and insights you won't find anywhere else. And if you want to go deeper, join our VIP community for just $25. Get backstage access, exclusive networking, speaker handouts, and a special VIP-only webinar. SuperCrowd25, crowdfunding the future. Impact starts here.
The property was dilapidated. It was horrible. It was code violations, drugs, crime, rundown RV trailers, no parking lot, no lights at night, just nothing. Our main focus is second chance housing. A lot of affordable housing households are led by single mothers. Our portfolio is 100% affordable. So our mandate is to be 20 to 30% below market rent. I'm personally $180,000 invested. We're only one of 2 companies globally to have a published social impact report for affordable housing on a Morningstar platform.
What's the faster way to build wealth? A traditional savings account at 0.38%, or worthy property bonds earning nearly 20 times more? Earn a fixed 7% APY starting with just $10, access your money anytime with no fees, all backed by real estate. Visit worthypropertybonds.com today.
The African diaspora is one of the biggest investors in the continent, but they are looking for a structured, transparent way of supporting this business. This is not donation. This is investment for return, including impact, and join our movement community. Thank you.
Behind today's biggest crowdfunding raises,
The leading CPA firm for Reg CF, Reg A, and Reg D compliance.
trusted,
Experienced.
set apart.
Join the CFPA for the Regulated Investment Crowdfunding Summit on October 21st and 22nd.
Register at ricsummit.org.
Rural property taxes fund vital services.
Only when they're paid.
Invest in real impact.
Visit invest.coretaxdeeds.com today.
None of these are working.
Let me guess. I'll bet you want to exit or diversify.
Thank you.
You're welcome.
ISPD strengthens health for families across Haiti.
Donate today. Make an impact.
Hello, everyone. I'm Gene Massey with Media Shares, and I'm very excited to be speaking at SuperCrowd25.
Save the date for Super Green Live, the global event on sustainability and green innovation, January 22nd through 24th, 2026.
We extend our deep appreciation to our supporting sponsors and co-hosts, including Potomac Growth, Energy Capital Funding Group, Move the Needle with Rob Kaplan, Ridgecrest Herbal, Stakeholder Enterprise, Renaissance League, the Global Equity Crowdfunding Alliance, the National Coalition for Community Capital, Green to Gold, and King's Crowd.
Enter to win one of 2 FireMax 11 tablets. Videos, books, and games come to life. Scan the QR code now.
Rules apply.
Welcome, everyone. I am so excited to have you all here. We are, I'm just thrilled to be able to introduce you to Michael Schumann, who's going to be our first speaker. Michael is the publisher of the Main Street Journal and one of the OGs of regulated investment crowdfunding, helping, is among those who were, created and built the Jobs Act that now governs this world that we operate in. Michael, welcome to the show. We're thrilled to have you on the program. Thanks for your patience getting started this morning.
Thank you, Devin, and thanks to all of you. I'm sure everyone has had their patience tried this morning, especially you, and I'm glad everyone made it. Let me share my screen here, and then we can get started with some slides that I prepared about the topic. And the topic that I would like to suggest is not how crowdfunding can be cool or how crowdfunding can be profitable or how crowdfunding can be good for your community. But I want to suggest that crowdfunding can, in fact, save the world, and specifically save the world from the climate disaster that we are all experiencing. But let me begin by talking about another planetary hero, good old Doc Brown from Back to the Future. And you may remember that in Back to the Future, Doc Brown explains to Marty McFly that when you're going to go back, you have to be really careful not to change the course of history, because even a very small perturbation in the course of history can lead to enormous changes later on. Well, in a sense, that is what we have been experiencing over the last century. We've been experiencing enormous perturbations in our climate, in our environment, in the results of industrialization. This is where I live, in Palm Springs, California. I won't reiterate all of the horribles associated with climate disruption. They include, of course, the loss of oceans, agriculture, the loss of biodiversity, the spread of pandemics and viruses. But let's just focus on what we have seen in the last 2 years. So in 2023, Palm Springs, which is a desert community about 100 miles east of Los Angeles, we experienced a devastating hurricane. Now, actually, it wasn't as bad as we feared it might be, but we got 70% of our annual rainfall in one day, and massive floods were the result. Earlier this year, in 2025, the Los Angeles area experienced unprecedented wildfires. The damage has been estimated to be as high as $275 billion. More than 12,000 structures were destroyed and 150,000 people displaced. Many Americans still feel, well, if you don't live on the coast, if you don't live in a place like Los Angeles, you're safe. But actually, no place is safe. This is Asheville, North Carolina, where another Hurricane Helene hit about a year ago. This created about $60 billion worth of damage in a place no one imagined could be flooded like this. Another 1,000 homes destroyed and an arts district decimated. I am not here to give you a whole recitation of bad news, because there is lots of good news around this as well. This is Bill McKibben, and hopefully some of you read his piece in the July New Yorker, which talked about all the unbelievably amazing progress solar energy and photovoltaics in particular has made in recent years. Now, we know that energy use and misuse is the primary driver of climate disruption, and moving from fossil fuels to renewables is the critical path for getting us to a better future. McKibben pointed out that between 1954 and 2022, we got the first terawatt of photovoltaics in the world. The second terawatt was built in 2 years, between 2022 and 2024. And this year, in 2025, we're going to cross the third terawatt of installed photovoltaic capacity. That is a remarkable acceleration. And it's so remarkable because if you think about it, we're basically getting a gigawatt of electricity. Think of a gigawatt as an old-style big coal plant or an old-style big nuclear plant. We're getting a new gigawatt of solar every 15 hours. In the United States more broadly and in the world, about 96% of all new energy demand is being met with renewable energy. And in May 2025, California produced 158% of its total energy demand because of its vast supply of renewables. In the face of this, we must point out that we are now in the midst of what I consider serious policy malpractice. We have leadership that pretends that climate disruption is a hoax, that pretends that fossil fuels are cheap and solar is expensive, and nevertheless is trying to thwart the market for renewables by ending the Inflation Reduction Act, by canceling wind projects offshore, by increasing tariffs on materials that are used for solar energy. And we almost had a special tax that was enacted by Congress on renewables. And in the face of what we are dealing with climate disruption, this is absolutely mad. But there is a solution, and this is, my friends, where crowdfunding comes in. We can't repeal gravity, and we can't repeal economic gravity. This is my home in Palm Springs, and my wife and I made our best investment in the market in our home about 3 years ago. Right there is our solar photovoltaic system. We borrowed $28,000 from our solo 401k. We put it into our collectors. And if you look at what our rate of return is, the spending, once we took in a tax credit, was $22,000. Our utility costs were between $600 and $700 per month. And over 10 years, the annualized rate of return is 22%. And that number, by the way, increases over time as the system keeps on churning out free electricity for another 20, 30 years. Now, I want to point out that this calculation here is conservative. It's conservative because, number one, our utility rates, like your utility rates, are likely to rise. Many have seen rising utility rates just this year. Number two, equipment prices are falling. We did not buy batteries, but if we were putting in the system today, we would have. The question is, how do we scale this up? And here I want to introduce another important person to this story. This is Larry Agron, the mayor of Irvine, California. Irvine is a city of 350,000 in Southern California. In the 1980s, I set up my first nonprofit with Larry called the Center for Innovative Diplomacy. And one of the things we did is we created a summit for Canadian and American mayors called SPA, the Stratospheric Protection Accord, where we enacted an agreement where these mayors would go back to their communities and reduce CFCs and halons that were contributing to the erosion of the ozone layer. And that grassroots initiative ultimately matured into the Montreal Protocols, which is a good reason why the ozone layer is largely protected today. Larry now wants to do something very similar with photovoltaics. He has hired me to work with him to solarize every residential building and every commercial building in Irvine. And if you think that is impossible, consider that in China, a city called Dezhou in Shandong province, where the population is 4 times greater, they have completely solarized their city. And we can start to do this all around the world. The problem is we will need to raise capital. We estimate we'll need about $2 billion of capital in order to complete the solarization of Irvine. And how do we do this? Well, one way we could do it is getting individuals to adopt project by project specific solar projects or groups of solar projects in the city. We might create a city-run fund that people could put their money into. There's an exemption within the Investment Company Act for municipally led funds. Or we might get the city to issue special kinds of municipal bonds. The picture here is of Green Liberty bonds issued by the Connecticut Green Bank a few years ago to support affordable solar in Connecticut. And the first issue that they did of this was $25 million of bonds. There was so much demand for this, they sold out within 48 hours. I think this can happen. It can happen in Irvine. It can happen everywhere. And the big point is that we and cities can change history. It's not going to happen from our national government or any other national government. Planet saving is going to come from crowdfunding. And it gives us a whole additional purpose to do what we want to do. And where I want to conclude is to talk about just 5 quick ideas about ways of accelerating crowdfunding to make this transition happen faster. So one is to create a new exemption within the Investment Company Act for small funds that have a lot less registration difficulties. Brian Becken from Pathlight Law here has been leading the way and pushing the SEC for a no action exemption where we could get some new kinds of community funds. A second innovation is being led by my colleague at the Bard MBA program, Janice Shade, who's creating a company called Fundamenta. And the idea of Fundamenta is to do back office services of insurance and accounting and legal work to reduce the threshold for new companies that want to create funds either in municipalities or for municipalities to make that startup a lot faster. A third innovation from Chris Miller, who has been leading an effort in Michigan to create a 50% income tax credit for local investment. That surely will get the attention of a lot more people about the importance of doing local investment and local crowdfunding. And by the way, if you think a tax credit like this doesn't pay, the Canadian government, actually the Nova Scotia provincial government, had a very similar tax credit that they enacted in 1998. And they looked at the efficacy of their investment tax credit over 25 years. And what they found is that the cost per job in lost government money from the tax credit was $500. In other words, it was 1/1000th the cost of a typical Amazon attraction scheme. Number 4 is trying to create some reforms around solo 401ks and self-directed IRAs. This is a lot of the subject of my most recent book, Put Your Money Where Your Life Is. The Trump administration has talked about some reforms for 401ks, but they're really how you can put more variable and unreliable assets like crypto into your 401k. That doesn't deal with the fundamental issue. What we need is to make 401ks more portable. We need to make them convertible into solo 401ks. We need to make it easier for people to borrow from those 401ks to put solar on their roof. And finally, there is sharing innovations. This is my friend Hunter Lovins. Hunter now has an international program called CopX, which invites cities around the world to share their best innovations. Basically, what we're thinking is that The cities of the world are the laboratories for saving the planet. And our motto should be to innovate locally and share globally. And crowdfunding is the water that can make those plants grow. Let me finish with Doc Brown again. And you may recall that at the end of the film, Doc Brown says, having come back from the future, he says, "Marty, your future is whatever you make it be. So make it a good one." Thank you very much.
I am Michael. Thank you so much. What great insights. I share your belief that crowdfunding is saving the planet and certainly has exponential ability to do that. I'm jealous of your solar, and really want to thank you for the time you spent today. I invite you to pop into the backstage area. I saw you in there earlier, but now that people have heard your compelling speech, I know that there are going to be other people who want to chat with you. I encourage you to pop in. And for those of you watching, I encourage you to if you're VIPs, pop into that backstage area so you can visit with Michael. And if you're not a VIP yet, I encourage you to sign up. There is so much VIP value left. Not only can you get access to Michael and the other speakers today, if you sign up now as a VIP, you can also get access to the LinkedIn group, the VIP LinkedIn group. That will persist long after SuperCrowd25 is over. You'll get the handouts that are exclusive to VIPs. You'll get the VIP webinar this evening at 8 p.m. Eastern. So lots of value, including access to Michael. So stick around. I encourage you to check out that 4sc.fund/25. Get your VIP pass so you can get access to Michael. Michael, thank you very, very much. We're thrilled to have had you today. I appreciate your patience, and we'll look forward to talking to you again in the future.
Great.
And now it's my pleasure to introduce you all to Gene Massey. Gene is a real rock star in the crowdfunding industry. One of those who's been around for a long time. And Gene has also proven to be just an extraordinary friend and great partner for the Super Crowd. We're grateful to Gene for all that he does and looking forward now to hearing from him. Gene, welcome and take it away.
Thank you, sir. I start my timer, and I will go through my slides and explain what a company needs to do when you plan to do a crowdfunding and how do you do it. So let me go through my slides here. Let's see, how do oh, there's a little thing to advance the slides. Okay. Why raise capital? You're going to have a problem because you're going to owe someone something. They are going to put their fingers in your pie and they want to know how do they get their money back. They're going to be all over you. And now a nice thing about crowdfunding is that you're going to get a little bit of money from a lot of people. So it's not exactly the same as getting from one rich person. You're going to get a little bit of, but you'll have an obligation to all of those people. And so you want to ask yourself, do you really need the money? Do you really want to take it from themselves, or do you want to try to bootstrap it and spend your own money and go as far as you can without taking outside capital? So you'll need startup capital mostly to prove your concept, that you have a great idea. You need enough money to demonstrate to people that what you have is really terrific. And so there is a thing that you're going to need to deal with, and every investor has three questions. They want to know, first of all, how will you not lose my money? And number two, since I'm investing my money in a relatively new business with higher risk, how am I going to get an exponential return? In other words, how is the return going to be worth my risk? And finally, they're going to want to know, when do I get my money back? And these three questions are the foundation of every pitch. Everything that you do needs to be an answer to these 3 questions. So, how do you do that? Well, the first thing you want to know and tell your investors is who pays you and what do they pay you for. They want to know you're going to make money, because every investor wants to make a piece of your money. That's what they put the money in you for, is they want to know that they're going to get a piece of your action. So you have to make a very clear picture of your path to profitability and be able to show your investors, this is what we're doing and isn't this terrific, and this is how we're going to make money. Yes, you've got a great idea. Yes, it's incredible, the problem you're solving, but how are you going to make money and who's going to pay you for your terrific idea? That's the most important thing. And you're also going to know, you're going to need to establish a corporation. You're going to need to abide by all the rules. It's called corporate governance. You're going to need a board of advisors in order to get your money. I've seen people raise money with no revenues and no product yet, but they had a stellar, great advisory board. They had all MIT professors and vice presidents of people that were in that industry. And you look at their story online and you see these are smart people, and they must be going to be do something, because they've got a great advisory board. You want to be very transparent with everybody. You can't have any secrets. This is not the place where you do secrets. You're going to be opening the kimono to your business. You're going to be giving away your secrets and explaining to people what you're going to be doing. And corporate governance is about that. It's about transparency and accountability. Now, you got a couple of choices. You can go out and write your deal on a napkin, practically, with accredited investors. And you say, well, you're going to give me your money and I'm going to give you this. And you're relatively unregulated. You file a Form D with the government and say, I'm raising money, but you're relatively unregulated. And the government doesn't pass muster on how good a deal you have. If you want to get money from non-accredited investors, or as I say sometimes, from poor people, not a millionaire, then you're going to be subject to a lot of rules for that, because the government wants to protect you from taking money from people by fooling them. And so everything you do is going to be very transparent, and they have a bunch of rules you're going to abide by. Reg CF is a type of funding that you can do with non-accredited investors, with ordinary people. They can put money, they can give you their money. So the government wants to know how you're going to do that, and you're going to need to file a bunch of paperwork and abide by the rules. And you can do both concurrently. We have a client right now that's doing a Reg A and doing a Reg CF and a Reg D. And they're doing that because Reg CF limits you to raising a maximum of 5 million per year, but a Reg D, you can raise any amount of money. So they're doing both. Okay, so you raise this money, a Reg CF, you raise on a platform or your own website with a broker behind it. If you raise it on WeFunder, Start Engine, Republic, some of the better known platforms, that's great. Or you can run it on your own website, on your own web page that you build, but it needs to have a broker behind it, like Dealmaker or Issuance or one of those companies behind you, assuring your compliance. So now the most important thing that you're going to need to remember is that investors can't find your offering really unless you're marketing it. You can be on a platform, and yes, they have hundreds of thousands of people on the platform, but I've not seen it be successful without marketing. You're going to have to market your offering, and you're going to need to market it on different types of Facebook, Instagram, LinkedIn, all the different ways of marketing you're going to need to be able to market your offering, and you're going to need to pay for that. It's not going to be cheap. And so if you don't have any money at all, it's tough to get. We have seen people in the past that wanted to do an offering and they didn't have a dime to do any marketing and they weren't going to get any money. So you need to have a budget for the marketing in order to drive traffic. Now, one of the requirements of these offerings is that you have accounting of your financials. You're going to need to have people look over your financials. You're going to need to file with a Reg CF. You're going to need to have a CPA reviewed or audited financials, depending upon how much you want to raise. So you're going to need to be able to prepare for that. And though that can be very expensive, you've got to have an accountant. And if you raise up to 5 million, you're going to have a separate auditor that audits what the accountant does. So these are very complicated things if you're going to be raising capital from people. There are a lot of regulations that you're going to need to abide by. Valuation. Every investor thinks they have $1 billion idea, and they'll say that in their in their marketing. We're going to have $1 billion company. Well, maybe not. So, and setting the value of your company is very complicated. You can base it on your revenues. You can up to date. You can base it on your projected revenues and the accompanying assumptions. But overvaluing your valuation can cause serious problems. First of all, investors won't believe you if you tell them we have $1 billion company and we're going to give you 2% of $1 billion. And so this is a wonderful investment. A lot of investors are not going to believe that. So you have to be realistic about what you're doing. Usually, an investor will tell you what the valuation is. If you go to an angel, they'll value their company for you. Or if you're not realistic, they'll tell you what your valuation should be. The nice thing about crowdfunding is that most of the investors are not analysts. They'll look at your idea and value it based on the story. So it's a very big point. What are you valuing at the company at? Now, a landing page, you have an offering somewhere on the internet, and that's your landing page. If it's on a platform, it's on the platform. The landing page is on a platform. Can you bring me a glass of water, honey? And so that landing page is where the investment takes place. So that landing page that you have driven people to from your marketing campaign, that's a very, very critical place, because that page is where you have to convince them to part with their money. You mean you want me to give you my money? My money? I'm going to give you my money? Yes, you have to have a story on that page that is good enough for them to give you their money, their investment. Another thing is that very often that page is on mobile. It's on a phone. A big percentage of the investments actually take place on a mobile phone. They go on the phone, they see the story, they see your Instagram ad, and they click on learn more, and it goes to the landing page. And on the landing page, there's a mechanism for them to actually take your money with a credit card or ACH bank transfer, but actually on the phone there. And a lot of investors don't want to do that. So that place where you convert that investment is very critical on the landing page. You have to have a good enough story on that page, and in your ad, even in your video. You have to have a good enough story that makes them want to go to click on the landing page. And then the landing page has to have more information that tells them this is a really good investment and here's why, and you should give me your money. And so that landing page, between the ad and the landing page, is very, very critical. Now, in all of this, part of your story is being able to convince the investors that your team knows what they're doing. If you ask most people that are looking to invest, they'll say, well, show me your team. Who are these people? What have they done in the past? They want confidence that the team can execute their investment and make it grow. So you're going to be marketing the company. This is the great advantage. This is probably the single greatest advantage of crowdfunding over taking money from an angel or a VC. The single greatest advantage is that when you market for your investment, you're also marketing the company. You get 2 for 1. Everything that you do to talk about your investment, it brings attention to the company for the company's solution, whatever problem it's trying to solve. So your marketing dollars you get double result for your money. So you're going to be using paid ads, Facebook, Instagram. You're going to be emails are the cheapest. You're going to need to have creative in these videos and these ads that's good enough to make them want to go to the landing page. You show them something that's so exciting in the videos and in the creative, in the marketing, that makes them want to go there. Video is definitely the #1 engagement tool. It gives you the opportunity to meet the founders and the team members. It gives them to hear from testimonials from other investors. So they want to meet you. Most investors want to know who is doing this. You're going to be making all this advertising, their analytics on it. You can get Facebook and Instagram ads, and they'll tell you, well, how much money did I spend $1? What did I get back? That's the key there. You want to optimize everything that you do. You'll have analytics that will show you. These webinars that you do will give you the opportunity for the founders to meet the principals of the company. The investors will get to meet the founders in these webinars and ask them questions. How are you going to make this money, and when do I get my money back? And they'll have a million questions, and they'll be able to talk to the founders by asking questions in a webinar. Well, let's see where we are here. Using AI. AI is a bit overblown, but it will help you. We used the AI a little bit in this PowerPoint, but we had to go back and fix it because it's not always correct. You can use it on your landing page analysis. You can use it for investor targeting and things like that. ChatGPT is probably the greatest thing that's ever been invented, and you can use it a little bit. When you get the money, you don't want to buy a Ferrari. No, as much as all over the first time, you've got all these millions of dollars that you can do stuff with, but you don't want to go crazy with it because you have an obligation to return the investor's money. And so, for example, James Cameron drives a 2013 Kia. He doesn't have anybody he needs to impress. Everybody knows him, and everybody knows him to be a genius. So he doesn't need to prove anything to anybody. And so most investments are made for a long-term benefit. The investor return is your ultimate goal. How are you going to get their money back? That's the punchline here. How are you going to return investors their money? That's your sole purpose. You take someone's money, and if you're an honest, ethical person, you want to be able to get it back for them. And you want to keep a constant good communication with your investors all along. And I am just about out of time here. But the most important thing that you want to remember is you're taking someone else's money and you need to make a return on it. And Devin, thank you very much.
Thank you. My good golly, such powerful insights. I really appreciate you sharing, Gene. You just really really delivered. There's such great information there, trying to figure out how to do all this so well. So thank you very, very much. I encourage you to pop back in. I know you've been in the backstage area. I invite you to pop back in. I know folks will want to visit with you now that they've heard you speak. So thank you very, very much. And folks, if you're watching and if you haven't yet signed up as a VIP, you still can. You can get access to Michael and all of the other speakers today, plus the handouts, plus the VIP LinkedIn group, plus the VIP webinar tonight. There's a lot of value in that VIP. I encourage you to sign up. Visit 4sc.fund/25 to sign up right now. Okay. Gene, thank you very, very much. Great job. Great job. I'm excited now to introduce you to our next speaker. I consider Brian to be a dear friend, and Brian is in the backstage area. Shannon, if you are listening, please pop backstage, give him the link so he can join us in here. I've confused the poor guy. But Brian is the really one of he's the co-chair with me of the Crowdfunding Professional Association and an exceptional human being. He is the past president of the Crowdfunding Professional Association. He is the CEO of Brainsy. He is the CEO of Crowdfund Holdings Innovators. He is the CEO of a stealth mode company that I can't tell you about, but I wish I could. So Brian is a big deal. He served on the board of the Crowdfunding Professional Association for over a decade. He is really one of the genuine great leaders in the crowdfunding space. And I am honored to know him and thrilled to be able to introduce you to him. But I see that he's still in the backstage area. So hang on, folks. Everything's going to be okay. Hang on for just a minute.
Welcome to the moment. The future's alive. Join the movement at SuperCrowd25. Ideas igniting, the sparks in the air. Dreamers and doers are gathering here. From start engine rising to we funders flame. Deal makers building, the world knows their name. Set apart guiding with wisdom they share. Together we're stronger, a force everywhere. SuperCrowd25, we're making it real. Community power, the change that we feel. Johnny Price smiling, Ron Miller's on stage. Voices united, are turning the page. Oh, SuperCrowd25. Karen Rance is calling, Diana Tucker too. Jackie Logan shining with a passionate view. Sarah Kaplan's vision, a light we all see. Crowdfund insider writes history with King's Crowd.
Brian.
Hello, Devin. Sorry about that.
Take the stage there, my friend. You're in charge now.
Okay.
Welcome.
So,
we already introduced you. Everyone's excited to have you here.
Okay. So, do you see me at the?
Yes, we do see you.
Okay.
Everybody sees you. The world sees you.
Okay. Okay. Thank you. So, apologize for having the technical thing to get in, but if let me share my slides. And as I'm doing that, I just want to say that really call out the kudos to you, Devin, and you and your team for putting this all together. It's really beneficial to it's a lot of work for you guys, but it's also very beneficial to the community and those of us who can participate. So really appreciate that you are putting this on, and again, we're all beneficiaries of that. So let me share my screen real quick, and then I'll be able to tell me if you see it. Are you seeing that, Devin?
Hang on one second. There we go. You'll just want to put them in presentation mode if you can.
Uh-huh.
There you go.
It says Wave is sharing my window, so it should be good.
Go ahead.
Great.
Go ahead there, Ryan.
Okay, thank you, Devin. So today I'm going to talk a little bit about sort of we say the next big thing in regulated investment crowdfunding. Now, in crowdfunding, there's been a whole lot of innovation that has taken place in and around crowdfunding that many people on the outside of the industry are not aware of, and that's not unexpected, because as a relatively new industry starts to grow, there's a lot that people have to really learn about it, and it takes time to get the word out about what's happening in that industry. So a lot of innovations taking place within the industry. It's very exciting. But in addition to that, there's a lot of applications for regulated investment crowdfunding that people are not yet aware of or haven't thought of, how to use this really wonderful tool to really for capital formation and for impact. So in this, we're really going to talk about the distinction between stakeholder equity and shareholder equity. And so, first, to do that, we have to first really talk a little bit about what the difference is between these two concepts. Now, stakeholders it's the broader universe of people who really have an interest in a company and how that company performs. Shareholders are very narrowly limited to the ownership class. Now, the reason why this is important to think of the difference is because a lot of people benefit and can benefit a specific enterprise as stakeholders, but shareholders really it's a more narrow subset of people who really are part of that ownership class. Now, a lot of what we're doing in the crowdfunding world and is really in many ways a reaction to some of the framework that was set forth back in 1970 by Milton Friedman, who wonderfully brilliant economist, but he also put forward some ideas that I personally think are deeply flawed. And one of those was this concept of shareholder primacy, where he said the social responsibility of a business is to increase profits. He published this in the New York Times. He went on, and again, it's really a focus on the goal of a company is to maximize the profit that it gives to its shareholders. He got the Presidential Medal of Freedom in 1988 by Ronald Reagan, and really ushered in a philosophical underpinning that became justification for the way a lot of business is run today. And so, and the challenge, I mean, there are lots of, I feel, flaws in that his theory. But one of them, if you think about, is really just the short-termism of profits, because profits can be used to reinvest and make a business sustainable, or it can be extracted, in which case many times you extract it, you may be able to pay the shareholders back more than they've invested, but you can in many ways hamper or damage or kill a business in doing that. So again, let's look at this concept and see how really things have changed. Now, this, as I mentioned, is the underpinnings for a lot of businesses done today. In 1970, when he came out with that article, there were fewer than 20 firms working in the private equity industry. And now they're between 6,000 and 7,000 in the US alone, if you double that number, if you looked at things globally. The private equity playbook, now this isn't all companies in private equity, but a lot of them have used what used to be known as a leveraged buyout model. And this is where they would, a company would come in, a developer, the private equity sponsor would come in, raise money from limited partners. They would then leverage that with debt. They match that with debt facilities, and then they would take over a target company. They pay off the existing shareholders, and then they essentially start to pay themselves back, extract money out of it. Now, there's a wonderful book that's written by Brendan Ballou, who said a book called Plunder, and he said private equity is like the 1970s Ford Pinto. Not every one of the Pintos need to explode for it to be unsafe at any speed. It's inherent in the design of the car that it becomes dangerous. So this is something to keep in mind. He goes through in his book a lot of very clear examples where private equity has really not been in the best interest of the company itself, perhaps not in the best interest of the shareholders long term, and definitely not in the interest of surrounding stakeholders. Part of that has to do with the way private equity firms will approach the businesses that they plan to own or invest or take over. They leverage them up with debt. They extract fees. They pay themselves very handsome fees for strategic guidance. They do a lot of cost cutting to bring up the bottom line profits, and so sometimes that's at the expense of laying off half a workforce. And oftentimes they'll do asset stripping, where they'll basically take our assets, sell it, and again make a profit off those, or repay themselves with some of those funds, and have other funds from the ongoing revenue streams of business for continued repayment to themselves. So now the problem with this model is something that we've seen where there have been research done that says that if you go to a private equity-owned hospital, you have a greater risk for problems, for health problems, and coming out. The patients are at greater risk in those hospitals, and so that study came out last year by some people at the Harvard Business School. Is pretty profound, saying that they're not necessarily more efficient. They're actually poor outcomes. The service level outcomes are poor for private equity hospitals than they are for others. There's also some case studies that have been done how when private equity firms go in and they buy nursing home chains, they can drive it into the ground, and the quality of care again degrades. In fact, it's so bad that there are law firms that have set up who basically will chase and look for those organizations that are acquired by private equity. It's sort of like ambulance chasing, in the sense that they will go to find people who are private equity owned in nursing homes, and they'll represent them. And that's such a ripe area because it's so predictable that these nursing homes, the quality care will decline after being owned by private equity firms. Another thing I mentioned is that post-pandemic, a lot of companies, a lot of these private equity owners would extract dividends from their companies, and the debt ratings of a lot of those companies went down after the pandemic, and in part because this private equity extraction. Now, when a company is acquired by a private equity firm or otherwise, basically, they're 10 times more likely to go bankrupt than those who aren't. And this is pretty damning. It's not about becoming an efficient company or strategically increasing their potential growth. They're just more likely to go bankrupt than those who haven't been acquired. So some will say, hey, get over it. It's just capitalism. For those who are familiar with, of course, Gordon Gekko, and old enough to have watched that show, they'll say that just, this came out of the 80s, and this is, people are comfortable. And in a way, it did. This mindset came out of the 80s. But what I would say is for the current times, we need a different mindset. And so I would counter that with the fact that capitalism, which is great, it's a tool that's very important, but it's just that, a tool, and there are different flavors of capitalism. Capitalism without sustainability is just extractive exploitation. And so there I am doing some sustainable fishing with the family. Again, you have to think about with the right lens and understand that if the right kind of capital, the private equity flavor of capitalism is not necessarily pro-social good for society. But you have to be focused on sustainability of capitalism in order for it to be a good thing. And I'm not alone in that philosophy. That, in fact, nearly 6 years ago today, the Business Roundtable came out to say, hey, we need to get away from the shareholder primacy concept. The CEOs of many of these companies were pressured into hitting quarterly earnings. And again, the focus was just on profits. They too recognized that this is a problem. So they came out, and 181 of them signed on to a letter that said we need to move away from this shareholder primacy and focus on stakeholders. So bottom line, stakeholder equity is not private equity, even though we use a similar term. The goal of stakeholder equity, and there's a group of people who are emerging, who are looking at how to use stakeholder equity as something that as a lens for how to approach business and sustainable businesses. And again, the key is sustainability, where you're really bringing in all stakeholders. There's fairness, sustainability, and we're looking at prosperity for all. We're not looking for just prosperity for a select group of the participants, it's prosperity for all. Now, this brings us to the Jobs Act. The Jobs Act really has been a wonderful tool. It's been focused to date on startups, but that is changing, and part of that came out of the actual name of it. So again, we're looking at capital formation again for startups, but what's happening is that it is shifting to more mature companies. Now, just in the timeline for many of you, signed in 2012, the SEC created the rulemaking in 2016. In 2021, the revisions to the rules came into place, and I expect, wearing my hat as co-chair of CFPA, that we'll see some other changes taking place this year or next. And so, again, it's a maturing exemption. It's evolving as industry evolves, and I continue to expect that we'll see more change coming from it. As I mentioned before, the number of companies that are going in and using crowdfunding as startups is actually diminishing compared to the number of mature companies. So Woody Neese of CCA has provided some of this data that shows that the number of startups initially were 73% when Jobs Act first came out, and now it's just over half. At least it was in 2023. But again, about half the companies are established companies using this tool. The other half are again startups. Now, the point here, the thing the point we're trying to make is that that if you start looking at regulated investment crowdfunding as a tool, then let's see how we can use it to replace the playbook that's being used by private equity. So, and how could this work? Well, think about it. If you have a company of the right size, and again, the maximum you can raise under Reg CF today is $5 million, but if under Reg A, which is the tool that would be used for this, it's $75 million per year. But if you think about that replacing what would normally be debt to banks or others, investment funds, the crowd could potentially step in. And then for the sort of general partners and the equity that's raised there by limited partners, that could potentially be ownerships through an ownership trust or perpetual trust. Again, as we start to look at the capital stack of private enterprise a little differently, we can think about ways that regulated investment crowdfunding can be used. So, and why is this possible? Well, one of the former presidents of CFPA, he made this comment that customers have more money than VCs. And that's just, not just VCs, it's any types of investors. So again, if there's enough money to make a business sustainable coming from the broader community, whether that's customers or suppliers or vendors, that is really, that creates the opportunity for this new type of structure to take place. Now, what are some targets? What are some potential areas where this type of, I call structured crowdfunding finance, could be applied? Well, if you look at ownership transitions and successions, that's ripe. The boomers, many of them are exiting out of their businesses that they've owned or created. A lot of people have talked about this silver tsunami that's coming, that's sort of here. And as they do that, you think about, well, who's going to take over? There are not enough Gen Xers who have capital put away potentially, or structured funds necessarily to acquire all those businesses. But the customers, the employees, the communities in which they operate, if you're an ice cream store, people know that ice cream store, you could potentially use this mechanism to put them into the community ownership. So that's a potential area where there could be a lot of opportunity opening up for growth and expansion expansion capital. Again, especially when you look at consumer-facing brands with high loyalty, people, they're loyal to it. And if you say, hey, you could be an investor in this product that you consume, scan the QR code in the bottom of the package when you get it out of the freezer, that could be really appealing to some people. So there have been some exploration talks with well-known brand name, widely known brand names that want to explore this potential mechanism. For turnaround financing and rescues situations, you can't make a bad business good with crowdfunding, but again, you can get more people who are invested in the well-being of the enterprise. So you could see a distressed business get turned around because it's closer to the community. You have a more loyal, fewer switching, less churn among the consumers, the customers of the product. I mean, there are situations where it could be applied for turnaround financing. And then finally, for corporate restructurings, you have companies where they may spin out a unit that no longer fits their strategic, and it could be a profitable unit. And you have, divestitures they could spin out, and that, or spin out could be a new venture that they want to do. And that spin out would be something, again, maybe not core to the business, but something where a corporation does want to keep it alive and have an upside associated with potential success. A lot of that ownership class could then be coming from customers. So again, for divestitures, we want to dig down a little bit more. So basically, I would just say that in closing, stakeholder equity, you can go to stakeholderequity.com. There's a stakeholder equity manifesto that really is written there, and invite people to explore this. It's an area where I think could be the next big thing for regulated investment crowdfunding. So with that, I'll turn it back to Devin and
Brian, great message. Great. It's such a powerful reminder that there are problems with capitalism that crowdfunding fixes. Wow, that is a powerful takeaway. An interesting complement to the discussion we had with Michael Schuman just minutes ago. Parallel points, driving us to the same end. Crowdfunding saves the world. I love it. Brian, thank you very, very much. I invite you to pop back into the backstage. You know how to get there. I know that. So pop back there. And I really want to encourage those who are VIPs to pop in and visit with Brian. He's an erudite guy. And I also want to encourage those of you who are not yet VIPs, sign up to be a VIP. Just $25. Get access to Brian in the backstage room there and all the other speakers today. Get access to the VIP LinkedIn group. Get access to the speaker handouts. We've got some cool stuff in there. We have 3 different recaps of yesterday's events, and we'll put in recaps of today's events too. So we've got a 20-page write-up. We've got a 20-minute podcast, and we've got a 7-minute video recapping yesterday, all in the speaker handouts. You get those if you get the VIP package, just $25. And you also get the VIP webinar tonight. Tremendous value still. I know it's day 2. There's still tremendous value in that $25 cheapo VIP experience. Now, let me introduce the moderator for our panel discussion. Now, Sarah Kaplan is a managing partner at Pathlight Law. She really is one of the genuine experts in the community capital arena. She and her firm have been working for a long time to connect with and support the community capital movement, addressing some really profound things in that area. So she is kind of one of the leading experts, and she's going to lead a discussion now with a few other attorneys to talk about just the vital issues in trying to stay compliant and take advantage of these regs. So with that, let me bring Sarah onto the stage here, and then we'll bring on and ask Sarah. I'm going to ask you to please introduce your panelists, Andrew and Benji, but I'm going to disappear now. So take it away, okay?
Okay, great. Thank you so much. I want to start by just thanking Devin again. All of the speakers have been acknowledging him, but I just want to say we in addition to all the other amazing stuff, we really appreciate your positive energy, and I think it is benefiting everyone who participates, everyone who's watching. Thank you for your positivity, Devin. It's really great to be with you. And I would love to thank you for introducing me, and I'm going to pop it over to the other participants to introduce themselves, if that's okay. Let's start with Andrew.
Hi there, I'm Andrew Stevenson. I'm with CrowdCheck Law, and CrowdCheck, we're kind of sort of sitting on two sides of a fence of different services to support companies that are companies and intermediaries and other service providers involved in the regulated crowdfunding space. CrowdCheck, we first stood up in 2012 with the Jobs Act of trying to kind of sort of helping to answer the question of who in their right mind would invest in securities and unknown companies over the internet. And so that's why we formed. We decided, okay, we can do the due diligence. We can provide the disclosure services. We can help companies get over the line to be able to help them do it correctly, because that's a big aspect of crowdfunding is sort of introducing a level of sophistication for companies by bringing on outside investors. That's important to do correctly.
Awesome. How about Benji?
Great. Hey, I'm Benji Jones. I'm an attorney based out of North Carolina. Like Andrew and Sarah, we've been following this crowdfunding space for a long time. I specialize or focus in on helping entrepreneurs and startups form their business and then raise capital, particularly using online investment tools, which includes regulation crowdfunding. Also, I think sometimes we also talk about what we would call rewards crowdfunding, but I think today's conversation is going to focus mostly on what we call it regulated investment crowdfunding, which is offering securities through the internet. Yeah, that's me. We're all lawyer geeks, so if we get a little too geeky for everybody, sorry. I know for sure Andrew is a geek. He's actually not wearing his headphones today, so I get so I'm very excited.
The more equipment, the better.
Anyway.
Yeah, we like to study securities law, so you don't have to, right? Like we see people teaching themselves securities law. It's like you don't actually have to do that. I wanted to quickly say a few words about community capital because Brian Christie, I was surprised that we were talking about worker ownership at this event, but Brian Christie just raised that regulation crowdfund can be used for communities to own businesses, for workers to own businesses. So just want to highlight quickly how we have seen regulated crowdfunding used for community capital. And that would include real estate cooperatives where maybe it's not technically a cooperative, but it's neighbors getting together to invest in real estate. And so regulation crowdfund would be the easiest path to compliance or like a ready, clear path to compliance. And, the East Bay Permanent Real Estate Cooperative is a great example of a real estate cooperative that did use, in their case, Regulation A. And, we've also seen worker cooperatives raising money by selling preferred shares through Regulation Crowdfund. I think those are our best examples. But yeah, so moving along to so here we are, three lawyers talking about crowdfunding. What is legal service for crowdfunding? Let's do a quick snapshot of what does legal service for crowdfunding look like? Do you want to take that, Benji?
Sure. So I kind of think of it, and I think we're specifically focusing on Regulation CF today, the $5 million exemption, just because Reg A can, there's just a lot of details, but a lot of these principles apply in what we look for when we're trying to help people create and execute on a successful regulated investment crowdfunding campaign. And I kind of think of it in four different kind of categories. And if you think about it in a Venn diagram, that each one of these categories overlaps, and the more when we get them all overlapping in the right way, we've got a hopefully a successful campaign. So I think first about structure and kind of due diligence, and this is kind of the go, no-go choice. Is this path to raise capital right for my business? So that's kind of the structure and planning phase. Then I think about the disclosure, particularly under Reg A and or Reg CF. You've got a specific disclosure document you have to prepare. And we as lawyers are really focused on trying to get that done efficiently, effectively, truthfully, and completely. And then communications. All of these regulated investment crowdfunding exemptions involve advertising. They involve soliciting directly strangers you don't know through this thing we're communicating by, the internet. And so what are the rules about communication that you need to follow both in the planning stage before you even think about it, all the way through to the end? And then the last category is compliance costs and compliance, making sure that once you successfully do your launch, you're still complying with the requirements of the exemption. I think about it in those kind of 4 categories.
And that sounds kind of complicated. So would you say that this is like hard? How would you rate regulation crowdfund in the world of hard to easy?
I would call it simple to understand, but you need to pay attention to the details for execution. So all of these exemptions, you need to understand that the path is straightforward, but how it relates to your business is very important, that you take the time to figure out, to check the boxes on how to plan it for you.
Yeah.
And just to add to that, it's a very big step in any company's existence to take investment from outside investors. It's one thing to start with just that team putting in their own money or expanding out to family, that their friends and family that they have close relationships with. But now, once you've taken money from investors whom you don't have any other connection with, it's those you really have to be more sophisticated in the way that you comply with your sort of obligations, both under state law as well as federal law. Those do just come into play. It's happened. Those are the way that the rules are written. And so those in those obligations, as mentioned, those obligations are both at the very beginning while you're doing your campaign, and stick around for afterwards with those ongoing compliance obligations.
Yeah. Yeah. So I'm not sure there's a way to make it fun, right? Like the whole world of legal compliance is kind of like, you have to do this. And I think it's valuable to distinguish what is the minimum, like, is this a DIY thing or not? So I think the minimum that a lawyer needs to do is to check, like, this is why you would need a lawyer for crowdfunding. We would check that you actually have formation documents and that what you're trying to offer through the portal is possible and matches your formation documents, and then reviewing your disclosures. That's like, you've just at the crowdfunding stage, not the later compliance stage, but getting ready to crowdfund right now. That is a fairly small scope of work, but in my view, you don't know whether you need a smaller scope of work or a bigger scope of work until you actually talk with us. And so who here offers free initial consultations?
Yeah. Melissa.
Yeah. So it's worth it to book an hour and talk to someone and get a sense of what you need, whether it's a smaller scope or bigger scope, before thinking that you can DIY. So do we have any like horror stories anyone here have a horror story they want to share?
Yeah, I think to that, Sarah, to your point about those organizational documents, and for a lot of companies just starting up, it's a kind of this thing, okay, it's just these are just boilerplate, and get formed, get organized, and start doing business as a company. Which a lot of states are set up to do that, because for especially for sort of a solo entrepreneur, your form of organization doesn't matter as much, and you're likely going to default into a limited liability company being the simplest form that's the most flexible. But that may not be the form that you want to be in order to, when doing a crowdfunding raise and taking on money from outside investors.
Mm-hmm.
LLCs potentially can grant a lot of rights to your investors to day-to-day management. And while they were not a company of ours, and when looking at some documents from so early on, and I think over time, the portals that companies are working with are getting more sophisticated as well. So we don't see some of these same issues popping up. But early on, I remember looking at an offering document from for a company on a large platform, and it was a member-managed LLC. selling membership interests in the company. And somebody did not, so the company didn't realize, and they didn't bother to ask anybody to help them understand what it meant for investors to come in as members in a member managed LLC. Those investors have day-to-day management rights, and the management of the company was now essentially sort of constrained from making decisions or entering into agreements without getting approval from all the investors. And so that's definitely something, that's an extreme case. But more so now it's more like likely to see things of they want to offer specific kind of preferences or terms to investors that may not be currently authorized by their governance documents. And so how do you get over that hurdle, or to make sure if they've already, or to make sure that they're then either get them organized or to make sure their disclosures match up to what they want to do and are able to do.
Right. So the opposite of horror stories, what are either a case study of something that worked really well, or in general, what helps a client to be really successful, really well prepared for a crowdfund campaign?
So to some degree, working with a counsel who's been working with you for a long time, that knows your business, that will ease your path into the process of crowdfunding, because that counsel already knows what you look like, what your objectives are, what your business looks like, and what your cap table looks like, and how clean things are. So it's easier if you have a relationship with a counsel who understands the disclosures and the governance to move into a crowdfunding offering. I just spoke with one of our existing clients, and they've already done a disclosure document before in another context. They understand what their cap table and what their objectives in raising capital are. And so that's helpful. But I also think it's also really helpful if you don't have that kind of counsel who understands you don't have a regular counsel, or you don't have a counsel that understands crowdfunding, call an experienced crowdfunding counsel, Andrew, Sarah, Benji, there's others, for a consultation before you start talking to the vendors. Because to be honest, crowdfunding through CF might not be the best path for you to raise the capital and achieve your objectives. And one of us can also steer you towards the right kind of marketing partnership, or the right platform for the type of raise you're trying to do, or just kind of a initial go, no go. Do you understand the exposure when you have to prepare disclosures and provide GAAP prepared financial statements? There's a lot of information you have to share with the public, that getting an initial idea from someone who is an experienced securities lawyer on what crowdfunding means and what are the other ways you can achieve your objectives. What's your problem? How are we trying to solve it? And what is the best solution for your company specifically? Crowdfunding is a great option, but it's not right for everybody. It's not right for every company. And it might not be right for your company at this phase. It could be perfect for your company at this phase. But really understanding, talking to counsel who understands the paths that are available, so that you are efficient in the work you need to do, because you really want to run your business. You don't want to be dealing with the legal parameters for an offering. You need to raise capital, but your main job is to run your business and solve the problems that your business is trying to solve. And so a good counsel can help you simplify that path for you.
And I want to reflect on that and say, much of the time, most or all of the time, if someone comes to us and says, we want to do a crowdfund campaign, we say, great. And then we look at their documents, we talk to them, and we end up getting their documents in order first and doing a private raise first, almost every time. Yeah. And like one of the things that Benji was talking about as we were getting ready for this panel was that lawyers, even though we get paid by the hour much of the time, we are looking at what's best for the client. Somehow we're really focused on best outcome for the client and what the client actually needs, and not just crowdfunding as a one-track type of product. Well, before we change topics too much, we have a question. Will the shift in crowdfunding to larger, mature businesses serve to push out and diminish access by startups and innovative companies that may be considered inferior? Does anyone want to take that question?
Yeah, I can kind of take a lead on it. I don't, because crowdfunding, regulated crowdfunding is able to serve companies at all ends of the spectrum. And I think we see that in the success rates for what's been happening. A lot of companies that are using crowdfunding are just kind of brick and mortar Main Street businesses that are looking to raise a couple $100,000. And that's not going to be diminished. So those larger companies that are potential mature businesses raising larger amounts. It's a different investor base. You kind of have the friends, family, and fans versus sort of the kind of more speculative investment. So I think there are areas that are compatible, because you're serving kind of different ends, different purposes for why an investor would be putting funds into this type of portfolio.
I think I agree with Andrew. I think we as lawyers deal with what we see the rules are today, and then gosh, we have the wish list of how we think we wish it would look differently. And I think I personally would like to see a different path that is simpler for smaller businesses raising smaller amounts. And I think that would, I don't think that crowdfunding is pushing those entities out. I think we find that the regulatory framework that's established for these kinds of companies make it harder for small companies to raise small dollars amount, because the upfront costs are kind of the same, irrespective of how much money you're raising. So I don't think it will exclude them, but I would love to see a simpler path for offerings under $500,000, so that the process for our smaller businesses is really straightforward and streamlined.
Yeah, and I have a couple of thoughts that you sparked here, but one of the simplest, lowest cost ways of raising money it involves no public advertising. It's not crowdfunding. And you kind of need a lawyer to explain it to you. So it involves some hourly billing. It's not it's on the low end of our billings, but there is the family and friends offering that relies on state law exemptions. This is not a blanket. There's no blanket exemption for family and friends offerings, but if you can rely on state law, and that would be the least expensive. But Benji, do you want to say anything more about, what is it? Because crowdfunding is supposed to be accessible. The Jobs Act and regulation crowdfunding is supposed to make it easier. And in some ways, it really opens up a whole new, for people who don't have the network of VCs. You don't need the network of VCs because there's the public, there's your customers, your network, and people who care about what you're doing. So it's supposed to be accessible. So what is it about the regulation that kind of stops those smaller businesses?
Yeah, I think there's one primary thing that is a challenge for smaller business is the financial statement requirements. Is that they need to be prepared in accordance with US GAAP, which means they can't be on a cash basis, and there's more kind of complexity in what you present. It's not just ripping your financial statements off of QuickBooks. that's not enough. And so that it sometimes requires you to have a sophisticated internal team on your financing to get that prepared. And even depending on how much you're raising, you then may need to hire a third party, an independent third party, to do your review and or an audit of those financial statements. So that it becomes kind of, particularly for mom and pop Main Street businesses, a barrier, because they do not have these financials prepared, and it's expensive and time consuming to get them prepared. So it can be kind of the first thing that I see people go, no, I don't want to do that because I don't want to spend the money. I don't have the money for it. And then I think the disclosure document itself could be streamlined in a way for some smaller businesses. I think there's questions in the Form C, that for Reg CF, it's called a Form C as in Charlie. For Reg A, it's called a Form 1A. In particular, in the CF disclosure of the Form C, there's some questions that for us lawyers, we know exactly what the question is intending to get the answer of, but they're obtuse questions that don't make sense to most business people. And so you read the question and you check no, because you don't understand the question. And so I wish, that's another place where there's risk in the process of preparing that disclosure on a DIY yourself. There's a lot of risk of not really understanding what the question is asking you, and then you don't answer the question, and you've got an omission or a material misstatement in your offering documents, which is not ideal. It's got bad effects. So to me, it's simplifying what's being asked of my company to disclose, and simplifying the financial statement disclosure. I think we could go, and these communication rules that I talked about earlier, those are a little confusing. They don't make a lot of sense sometimes. So simplifying those rules would also be really ideal, where we can just at all phases say anything to the public, as long as it's truthful, right? We all know we're not supposed to lie or puff too much in our advertising. But if we could simplify communication rules, simplify disclosure, and simplify financial statements, that would be golden, in my opinion.
Fantastic.
Andrew?
Yeah, I would say, but like, so under, kind of, no, and so those are kind of great assets. We know that there's movement going on, both Congress and the SEC, for looking at what can be improved or what can be changed under regulation crowdfunding to make it more accessible to companies. So there are some potential changes on the horizon for that, although we don't know what those are necessarily going to be or how it's going to result. But under the current framework, though, you do have sort of an additional challenge that we see is just in how, as Benji mentioned, with the financials, but also then how, because it's sort of a question of how to prepare those in order to present to investors. A similar thing can be said about how to present the disclosures to prepare for investors. Because typically in a crowdfunding campaign, you're going to have your offering page, which is the main thing that's used to gather eyeballs and sell the company. And that's usually where entrepreneurs are the most effective at. Like, I'm going to tell you why I'm going to be successful. But when you're doing a securities offering, all those types of disclosures need to be balanced. And that's usually then where that formal Form C document that Benji identified gets used. The Form C is going to be where all the risk factors are discussed, where the kind of narrative to go along with the financial statements of explaining and providing context for what these financial results mean and for the company, and how it potentially could relate to on a going forward basis. Oftentimes we see that one of the biggest challenges for entrepreneurs who do not have prior experience with capital raising is risk factors. And because as entrepreneurs, you have to be optimistic. You have to believe that this is going to work. Otherwise, you wouldn't be doing it. And so now to have to put down sort of pen to paper, so to speak, of all the things that could go wrong. That's a challenge, and there's a lot of hesitancy to do that. But it's where having sort of an advisors comes in to let you know, actually, you want to do this because this protects the company. This protects you, protects the company, because now you've laid out all those things that to ensure that investors are able to make a fully informed investment decision. You've balanced out your disclosure to just account for the reality that things can happen. And so those are very, and so that's an area, while it can be a challenge for small companies because they're not used to doing that. But it's definitely an important one, and an area that's probably going to, even with whatever changes are made, that obligation around risk factors is going to stick around.
Yeah, and I don't know how you guys manage this, but what I say to my, there's some standard stuff that your lawyers will always manage for you. We know what certain risks are. We don't need you to tell us what keeps you up at night, but we do need you to tell us what keeps you up at night, because for a securities raise, that's what you need to tell your potential investors. Look, in the summertime, look, in the winter, we are an ice cream shop at the beach. We're not going to make a lot of money in the winter time, or if we have a lot of storms in the middle of the summer, that could affect our business. So, and your lawyer knows risks, but we don't know how your business operates. We don't know what you're worried about. And you giving us a list, even just a bullet point list of what are the 10 things that are keeping you, that worry you about the business, will help you structure that in a way that is not intended to scare people away. It's intended to let people know, look, this is risky. It's not a slam dunk. It's not field of dreams. If you build it, they will come. There is risk here. You're putting your money with me. You're trusting me. And these are the things I'm worried about. And hopefully we'll find a solution to all of the problems. But really being clear with investors that the idea is there. We think it's sound, but we are worried about X, Y, and Z that could cause problems for us, is good disclosure. It's really good disclosure.
Yeah. I just want to mention the VIP link to join the VIP package was just on the screen. And I plan to be in the VIP room after this. Hopefully Benji and Andrew will be there, and you can join us and ask questions if you join the VIP package. And then, yeah, so when we write disclosures, it's like, here are all the bad things that could happen, but we're not expecting those bad things to happen. We're used to writing about bad things. Investors, please know we have to put that in there. It's a warning, but it's not the full story is really that initial page that tells the story of the company. We had talked about, tokens and mirror tokens, and just like, we should mention some trends that we're seeing, and kind of what we see coming along. Benji, you were saying that you wanted to address and acknowledge the fact of mirror tokens. Do you want to pick up on that?
Yeah. So I think there's a lot that's going on, particularly on the federal basis, on particularly the digital assets and entering into new spaces, particularly with Regulation CF. There is this new concept that of a mirror token that's being presented by one portal that is utilizing Reg CF to track companies' performances without the company itself being part of the offering. I think, and then we see a lot of really push these days in trying to build the US's position from the crypto position, and how digital assets are going to be offered, how digital assets are going to be purchased by 401ks, and those kinds of lots of changes. I personally think that the world of alternative capital raising, which is another way to say crowdfunding, online capital raising, is going to be different this time next year than it is today, just because of the the focus of this federal administration on innovation. And this industry is that it's key to it is innovation. And so also, for when you call us, forgive us when we're like, well, we're not quite sure what that platform's doing right now because they changed it 3 months ago. This is a world where the path and the offerings and the vendors and the tools are constantly changing. And so part of it is staying attuned to what's going on, attuned to what the regulations permit and what they might not permit, and getting a little comfortable with the level of iron in your stomach, right? There will not always be direct answers to, can we do X, Y, and Z? And so there's a lot of innovation, novelty, and change in the industry, which makes it exciting and fun. But you got to monitor a lot. Andrew, I don't know what your thoughts are.
Yeah, I think it's hard to not talk about sort of current trends without talking about sort of digital assets and tokens. That seems to be a goal of a lot of companies that sort of they want to tokenize in some way, and that's something that does vary in a lot of ways. Is that token just a representation of a traditional security, which becomes fairly standard practice, or is it something more? And that's where, often you get that discussion of, is this really an investment contract? Like, is that token really something that is more akin to an equity or debt investment, but you're just calling it a token, or is it really truly something that is a utility token that wouldn't be subject to U.S. securities laws? Those questions are still fuzzy. There's legislation working through Congress to try to create some framework for it. The SEC has also been looking at it for a while, but it's still a bit fuzzy now. So I think, that's where it's still important to kind of talk it through. What are we actually selling here? What is it that that investors or purchasers are getting? And then understanding, and then if you've made that determination that, hey, this is an investment, it needs to be subject to an investment rules such as regulation crowdfunding. Then making sure that that those disclosures are clear about what it is investors are getting, what are the rights associated with that token, are sort of kind of very critical for ensuring that that companies stay out of trouble.
Yeah. So the basic idea with tokens is we look through form to function, and the SEC doesn't care what you call it; they care what it is. Mm-hmm. So I would encourage people to put any questions in if they have them. We can see questions. So one of the things I wanted to sort of change the topic. We've been talking about regulation crowdfund, Reg CF, and there are other ways of doing crowdfunding. We've also talked about Regulation A, which is on the larger end. And I just want to highlight some smaller cost, potentially smaller cost pathways that I think a lot of people don't know are there. And this is kind of niche, but if you are in certain states, the state will have a crowdfunding law, and some of the state crowdfunding laws don't require using a portal. So like if you're in Georgia, there's an Invest Georgia law that does not require you to use a portal. In Minnesota, Minvest does require a portal. So it's worth looking at that state crowdfunding law. And then, I care about cooperatives, which are membership organizations that serve they're there to meet the members' economic and cultural needs, depending on what the co-op does. But there are exemptions for cooperative shares. So for certain companies, depending on what you're doing and depending on what state you're in, one of the things you can get potentially out of a free initial consultation, or even the next hour, right? Like after we identify what we can do for you, what a lawyer can do is show you the different paths. And I think some of these other paths get overlooked because people know about regulation crowdfund. Most people, or a lot of people, know about regulation crowdfund, but not everyone knows that the state has a choice where you don't need a portal or it doesn't, but I think it's worthwhile looking at what all of the choices are. So we just have a couple minutes left. Are there any highlights that either of you want to talk about that we didn't get to yet?
I'd like to kind of a word of caution that I think it's really important for companies to make sure that they've got a robust team of advisors when they undertake a public securities offering. Your vendor, if you're doing CF, and usually if you're doing Reg A, you'll need to use a third party to host your platform offering. But I think it's really important to make sure that your team, your legal team, your accounting team, if you've got another marketing team, are all built together and experienced and heading down the same path and communicating well. There can sometimes be scenarios where certain vendors think the DIY approach is going to work for you. Even if you're doing a DIY, finding a general review from an experienced attorney to help keep you on that path is really important. Accountants and the vendors aren't your legal counsel, and they can't give you legal advice. And so it's really important to kind of try to close that gap for yourself. Thank you for the tip.
I think we're all set. Devin, is that the it's time to stop talking?
Yeah, I'm afraid that's where we are. I was looking forward to this panel. It did not disappoint. I wish I could sit here and listen to you three all day. This is important stuff. My gosh, you can't do a crowdfunding campaign, a Reg CF campaign, or a Reg A campaign. You can't do a regulated investment crowdfunding campaign without you guys, right? And your peers across the country. So this has just been vitally important. Thank you so much. Sarah, I appreciate the plug for the VIP group. I hope you guys will all pop into the backstage area, and I invite all the VIPs. This is your opportunity to go ask some really pertinent questions. So I encourage you all to go take advantage of that opportunity. Again, Sarah, Andrew, Benji, thank you.
Thanks.
I want to thank our sponsors. This is a vital step in our process. Our Max Impact sponsor is Rancho Affordable Living, Proactive Realty Group. I encourage you to check out their crowdfunding campaign at 4sc.fund/rancho. But please check out all our sponsors.
You're watching SuperCrowd25, the biggest event in impact crowdfunding. Over 2 days, top experts, investors, and mission-driven founders are sharing how to raise capital, discover profitable investment opportunities, and change the world. Stick around. You'll hear stories, strategies, and insights you won't find anywhere else. And if you want to go deeper, join our VIP community for just $25. Get backstage access, exclusive networking, speaker handouts, and a special VIP-only webinar. SuperCrowd25, crowdfunding the future. Impact starts here.
The property was dilapidated. It was horrible. It was code violations, drugs, crime, rundown RV trailers, no parking lot, no lights at night, just nothing. Our main focus is second chance housing. A lot of affordable housing households are led by single mothers. Our portfolio is 100% affordable. So our mandate is to be 20 to 30% below market rent. I'm personally $180,000 invested. We're only one of 2 companies globally to have a published social impact report for affordable housing on a Morningstar platform.
What's the faster way to build wealth? A traditional savings account at 0.38%, or worthy property bonds earning nearly 20 times more. Earn a fixed 7% APY starting with just $10, access your money anytime with no fees, all backed by real estate. Visit worthypropertybonds.com today.
The African diaspora is one of the biggest investors in the continent, but they are looking for a structured, transparent way of supporting this business. This is not donation. This is investment for return, including impact, and join our movement community. Thank you.
Behind today's biggest crowdfunding raises.
The leading CPA firm for Reg CF, Reg A, and Reg D compliance.
Trusted.
Experienced.
Set apart.
Join the CFPA for the Regulated Investment Crowdfunding Summit on October 21st and 22nd.
Register at ricsummit.org.
Rural property taxes fund vital services.
Only when they're paid.
Invest in real impact.
Visit invest.coretaxdeeds.com today.
None of these are working.
Let me guess. I'll bet you want to exit or diversify.
Thank you.
You're welcome.
ISPD strengthens health for families across Haiti.
Donate today. Make an impact.
Hello, everyone. I'm Gene Massey with Media Shares, and I'm very excited to be speaking at SuperCrowd25.
Save the date for Super Green Live, the global event on sustainability and green innovation, January 22nd through 24th, 2026. We extend our deep appreciation to our supporting sponsors and co-hosts, including Potomac Growth, Energy Capital Funding Group, Move the Needle with Rob Kaplan, Ridgecrest Herbal, Stakeholder Enterprise, Renaissance League, the Global Equity Crowdfunding Alliance, the National Coalition for Community Capital, Green to Gold, and King's Crowd.
Enter to win one of 2 FireMax 11 tablets. Videos, books, and games come to life. Scan the QR code now.
Rules apply.
Welcome back, everyone. I am so excited. Got a little out of sync there. It's easy to discombobulate Devin. Let's just be clear about that. But I am so excited to introduce our next speaker. Dara is one of those OGs of crowdfunding, and we've had several on the program. We'll have several more today. But think about that. These are people who are passionate about crowdfunding. They've stayed connected to this community, continue to utilize it 15 years into the effort to create and institutionalize what we're celebrating today. So I'm thrilled to introduce Dara Albright. She is a member of the board of directors of Worthy Financial and, like I say, one of the OGs of crowdfunding. With that, let me bring Dara onto the stage. Dara, thank you so much for being here. We're just thrilled and excited to hear from you today.
Oh, thank you so much, Devin, and thanks for putting this great event together. It is really an honor to be here, and I am so excited today to talk about something that I think is a pretty simple idea that I think everyone could get behind, and that is that everyone deserves proper diversification, not just billionaires, not just institutions, everyone, every investor, every retirement saver, every worker. And today I'm going to show you a couple of really eye-popping slides and charts that will show you why traditional Wall Street is actually failing the masses and why fintech is actually stepping up to save them. So let me get those slides up here. All right. Can you see that? Good. Okay. So hang on. How do I move these slides? Hang on. Slides not moving. Let me just see something here. Got it. Okay. Sorry about that, folks. Okay, so let's just start with the fact that duplication is not diversification, no matter how much you try to spin it. If your retirement account is spread across multiple mutual funds, you're not getting proper diversification. Instead, what you're really getting is just the reshuffling of the same limited number of publicly traded companies over and over again. And it's even worse because, especially if you're in index funds, you're primarily getting, what you're doing is just doubling down on the same 10 mega corporations. And here's even the bigger picture. The bigger picture is that since about 1996, the public company count has shrunk dramatically, cut in half since 1996. We went from about 8,000 publicly traded companies in 96 to about, somewhere roughly around 4,000 today. Now, at the same time that the number of publicly traded companies is continuously declining, and if we're at the rate we're going over the next 50 years will be below 2,000. At the same time that is happening, the market capitalization of the companies that remain public are exploding. In fact, since 96, during that same time frame, market capitalizations have exploded sixfold. So what's happening is that your people think that they're spreading risk, but you're really not. You're really just betting more on a smaller number of larger and mature companies. And what that equates to is less diversification and less appreciation, because the companies that remain that are larger have less room to grow. So, the fact is that the growth curve really happens long before a company goes public. And in fact, pre-IPO returns have historically outpaced public gains by about 6 to 1. This is the sweet spot. Now, years ago, these are companies that, the pre-IPO companies are companies that would have been public in previous decades or previous years. But today, because companies are delaying their IPO, waiting longer and longer, they're not going public until they're significantly larger in market capitalization. And I'll give you an example. Intel went public in 1971 with a market capitalization of just about, little bit over $50 million. And that's an M, 50 million. That today, some Reg CF deals are worth larger than that. So, that's basically where we are today. What's happening is that by the time the companies actually do their IPO, most of that value is already gone. And unfortunately, retail investors are left with pretty much the scraps. And that's why the retail has really become, in more recent years, the exit strategy for the financially privileged. Now, for decades, right, advisors have been preaching about the 60-40 portfolio, which is 60% publicly traded stocks, 40% publicly traded bonds, which is essentially the debt of the same shrinking pool of publicly traded companies. Now, that might have been fine in a different world, but in today, in the modern world, really the 60-40 portfolio is no longer a safety net. In fact, it's become a liability. And the future of diversification truly lies today in alternatives, in real estate, stock, private equity, private credit, and yes, even digital assets. The truth is that modern portfolios need uncorrelated assets. They need yield and stability. And in order to get that, they need to look beyond Wall Street and they need to head on over towards Main Street. Now, institutions already know this, of course, right? That's why they've already been investing in alternatives for a long time now. And in fact, they really have been focusing on the private credit space in the last 15 years. And, they realize that this is really where the returns are as far as yield is concerned. It's also lower correlation to the public markets. But, unfortunately, retail investors have really been locked out of this really coveted asset class. Fortunately, though, because of P2P and crowd lending platforms, they've really stepped up to deliver private credit to retail investors in more recent years. And also thanks to technological innovation and regulatory changes, such as the Jobs Act, which you always talk a lot about in this space, as well as a new executive order that focuses on 401k plans that I'm going to address momentarily. But because of those two areas, the technological innovation as well as the regulatory shifts, everyday investors are now being able to gain greater access to private credit yields. And this is where Worthy comes in. Worthy is the Robin Hood of private credit. With as little as $10, investors can buy bonds that fund community real estate projects. And while their nest eggs are growing at 7% a year, their dollars are hard at work building homes and supporting their local economies and creating a real impact. But Worthy customers are not just passive investors. They're also stakeholders in community projects. We call them Worthies, and Worthies are getting more diversification, they're getting better yield, and they're really getting that chance to make a real impact. Worthy bonds are not your grandmother's bond, and it's not your grandmother's old savings account. It's a smarter and simpler and painless way to accumulate nest eggs. And, really, so let me give you like a little bit of what Worthy does here. So Worthy is affordable, first of all, and accessible to everyone with $10 minimums. It's, basically for, the price of not even 2 Starbucks coffees, or maybe, price of 2 Starbucks lattes, let's say. You could basically have a $10 bond that's already yielding 7% each year. There's no fees. And the beauty of this, that Worthy also has a fintech app to it that, well, first of all, allows for auto investments if you like, but also a really key feature is spare change roundup investments. So essentially, you go to your supermarket, you spend $99.50 at the grocery store, you pay $100, that 50 cents that from the difference between what you pay the grocery store and that roundup goes into your Worthy account. And every time you hit $10, it will purchase a new $10 bond for you. And another great part about this is that these bonds are actually supported by real world assets, in this case, real estate. And, truly, like, the timing cannot be more urgent. I mean, there is a significant savings gap. I mean, there are 72 million millennials that need better savings tools out there. There are 57 million gig workers and growing that need better savings options. Today, the median account balance is for 25 to 44-year-olds is only $20,000. And we really need to start making changes. And people want to have more of an impact with their investments. In fact, 85% of Americans say that they want value-lined investments. So, okay, now I want to talk a little bit about that executive order that I referenced earlier. Essentially, what's happening is retirement is being reimagined. And, the regulatory landscape is shifting very fast. Now, there was a new executive order that was just signed, this month, August 7th, I believe it was. And what it does is it opens up 401ks to private, to all different kinds of alternative assets, private credit, private equity, real estate, and digital assets. But whereas this is really groundbreaking and game-changing, when I first heard that there was going to be an executive order that was going to be signed to open up 401ks to alternatives, of course I was excited, but I was also cautiously optimistic because I thought that, okay, this is just going to be another way where it'll open up to those assets, but it will open up to those alternative assets through various kind of managed funds. So that would, basically help the BlackRocks and the Vanguards of the world, but really not everyday savers. I could not have been more wrong, because what this executive order actually does is it provides direct access to private credit or real estate, or an investment directly into a company, not just through managed wrappers. The executive order also does something really interesting, and this is something I've been passionate about for a while. It actually mandates the SEC to create reforms to the accredited investor rule. And I'm sure many of you that are listening to this know the what I call the unconstitutional accredited investor rule, which basically says if you don't have a certain net worth or if you're not making a certain amount each year, well, then basically you're not smart enough to invest your money the way that you want to. So, hopefully we can see some changes there. It also mandates the Department of Labor to create new fiduciary safe harbors. And that's really interesting because in recent years, fiduciaries have been fearful of putting any of retail investors into alternative assets and giving them proper diversification because of fears of lawsuits. So we see some changes there that's going to open up a lot of doors too. And we're going to see 401k menus shifting from that outdated 60-40, mutual fund monopolies into really true multi-asset platforms. So there's really never been, a better moment for community finance. Now, hang on. The proof is actually in the numbers. So if you look at this, this is a pretty eye-opening chart. If you had $1,000 in your 401k, this goes back to 2014, and you were in the 60-40 portfolio, you would have, that $1,000 would be worth $2,790 today. Now, had you diversified that and you added, a little bit of private equity in there, you added private credit in there, you added some Bitcoin in there, that $1,000 could have been worth more than $37,000 today. Now that is significant. But of course, okay, that adds the Bitcoin element to it. And there's been a lot of volatility in that. But even if you take Bitcoin out of that and you just look at a 60-40 portfolio versus a alternative portfolio with just putting in some, private equity, private credit, and like a worthy bonds that's, yielding 7%. You're still looking at a better return and a much higher Sharpe ratio, meaning that you had taken on a lot less risk to get that return. So, this is really great for the fiduciaries that really are seeking, maybe more stability. And, they need to know that risk adjusted path is really anchored in private credit, and in products like worthy bonds. And I'll just tell you that, this chart, I think, also says it all because it really dispels that myth that private, assets, alternative assets are risky, too risky for the individual investor. The numbers say otherwise. That is just not the case. Now, private assets, are they, do they have more liquidity risk? Yes, but that doesn't make them riskier. So, overall, and then when it, comes down to it, everyone is worthy of better returns. And, thanks to platforms, like Worthy, thanks to, some of the changes in the regulatory landscape, investors are getting that. And we're in a whole new world now. And it's really exciting to be here and to watch it all unfold. And if you like, you could check out the QR code here. You can learn more about Worthy Bonds. And I look forward to seeing everyone in the breakout sessions. Thank you.
Well, Dara, great presentation. Great presentation. I want to, just take a moment. You did such a great overview of why Worthy. Brilliant. And I'm excited. I'm trying to figure out how much of my money I'm going to allocate to Worthy bonds. But I wonder if you would go back in time with us for just a minute.
Yeah.
Tell us, take just a minute. We've got a minute or two, just a minute or two. How did you get started in this crowdfunding journey? Because you've been around in this work for 15 years. I mean, it's been a minute. Been a minute. You've been working on this for a while now. Tell us a little bit about that.
Yeah, and you know, I'll tell you something. You know, it's funny. I saw you just put up that a conference coming up in January 22nd to the 4th. I actually did the very first crowdfunding conference in the country on January 23rd, 2012. So we're actually going up on the on the anniversary of that. You know, my background has basically been just really traditional Wall Street. You know, I've done everything from retail sales to institutional sales, and I really cut my teeth really in the IPO market. And you know, back in the '90s when this little invention called the internet was emerging and really kind of starting to change how we invest, how we bank, how we shop, everything. You know, how we communicate. And at that time in the 1990s, you know, you could still invest into a company that was going public. And when a company went public, you know, they would go public at, you know, the average at that time was probably like around 300 million in market capitalization. They would raise 40, 50 million on their IPO. And, you know, there was tremendous growth in front of them. And over the years, that really just started changing. We just saw our IPO markets just, you know, really becoming completely dysfunctional, where, you know, you started to see companies that had to be in the billions to get public. So, you know, they wouldn't go public until much of that appreciation was already behind them. And
or hundreds of billions.
Hundred, exactly.
Yeah, remember, Facebook went public and then dropped in
Exactly.
half. Yeah, that sure felt good to all those poor retail investors who got excited about investing in Facebook and then lost half their money and sold.
Exactly. And, you know, and that's why I said, you know, retail has become the exit strategy for the financially privileged in, you know, traditional markets. And, you know, thankfully, this is like really starting to change with, you know, rules like the Jobs Act changes, you know, through the Jobs Act, through like, you know, this new executive order I just mentioned, because that one's really significant. And I'll tell you why. Most retail investors don't invest with the money that they have sitting around in a checking account. They actually do invest with their retirement dollars. That's the bulk of their, you know, investable assets.
So true. We got to wrap up now, but
Yeah.
Dara, thank you so much. Great presentation. We really appreciate you, and we appreciate the Worthy team sponsoring this event. It's been a tremendous help to us. I do want to encourage people to check out Worthy, these Worthy funds. It is compelling. Dara did a great job of telling the story, but the deeper you dig, the beautifuler it gets. So check it out, everybody. Dara, I invite you to pop over to the backstage area and say hi to the folks there. And folks, if you're interested in checking out, I would encourage you strongly to visit the VIP room. And if you're not a VIP yet, visit 4sc.fund/VIP. 4sc.fund/25 to get your VIP tickets, and then you can pop into the backstage area with Dara and check it out. So, Dara, thank you very, very much.
Thanks. I'm going to go check it out right now. Thank you.
Okay, now, folks, I am so excited to introduce you to Kendall Almarico. I'm going to confess something. I'm a little embarrassed. We have a whole host of rock stars on the program. But Kendall Almarico is a crowdfunding attorney that I've known for a long, long time. He's been around doing this work for at least a decade, and he was the first person I invited to be on the program at SuperCrowd25. That's how compelling a speaker he is. I'm excited to introduce you to him and have him on the show. Kendall, welcome. We're thrilled to have you here.
Well, thanks for having me, Devin. I feel special, especially since you just used the word beautiful-er right before you introduced me. So I think it was probably a Freudian slip of some kind. Who knows?
Yeah, that's right. There you go.
No, thanks for having me, and I'm thrilled to be here and excited to talk about. It's funny because people introduce me as a lawyer; they're always expecting, "Oh, we're going to have a bunch of dry legal stuff." Today, we're actually not going to really talk about a lot of dry legal stuff. We're going to talk about the top 10 things that happen, both from a legal perspective, but also, more importantly, from a marketing perspective, when you do something wrong that can affect an equity crowdfunding offering, whether it's under Reg CF, Reg A, or even a 506C offering. And this all comes from practical experience. I'm going to try to see if I can make my slides work here. If they don't worry, I can still go through these and make it all as wonderful as possible. But give me 1 second here while I click the button that I think will make this work. Let's see. And well, it looks like we're going to have an issue with this. So I'm just going to go ahead and go through these without doing it. So bottom line here is when Devin and I talked about what would be something good for me to talk about, I have a very unique practice in that I'm a securities attorney by trade. And primarily what I do is help people, help platforms, help funding portals, help broker dealers manage any kind of issues related to this type of offering through the Jobs Act. I always start off by telling people that about 10 years ago, Forbes called me the top crowdfunding and Jobs Act attorney in the world in one of their articles, which I thought was pretty funny because I think I was maybe the only one at the time, other than a couple of other people that are still around doing this, which makes me probably one of the worst ones at the same time. But here I am today, and I have written in the past for entrepreneur.com. I was listed in Inc.'s list of crowdfunding people in the world that you need to know. I was actually higher ranked than the chairman of the SEC at the time, which is insanely stupid. Certainly not anywhere near as important as those people. And I got named the #1 crowdfunding influencer in the world in 2016 by a website I've never heard of before. So I got a lot of great credentials that probably don't mean a whole lot, but I do have a lot of practical experience. I've been doing this for 10 years. And over the next 15, 16 minutes, I'm going to talk to you about things to not do when you're doing a crowdfunding offering of any kind, whether it's under Reg A or Reg CF. The first thing that I wanted to start with, and I think that is the most important one of all, is that people have this misconception that I call it the field of dreams problem. I'm just going to build this thing, I'm going to put it up online, and all of a sudden, magically, I'm going to get investors in. And that's just simply not the case. Crowdfunding is all about marketing. It is not so much about the legal work and not so much about the accounting work. Those things are very important to get you to the point of being able to raise money. But if you don't know how to market and you don't build a crowd to market to, you're not going to be successful. And the #1 thing I tell people from the very beginning is don't launch your equity crowdfunding offering until you've already built that crowd. If you start without the crowd, you're just going to sit there. You're not going to raise money. And so you need to think about this from the very beginning, building your social media following, building up a list of people that you know would like to invest in your company, friends, family, bringing in influencers, people that you know are going to be able to reach out to a number of people. But before you launch, you should have already built your crowd. And that's the single one biggest mistake I see people do is they go out there, they go live, and they have nobody to invest. And you are responsible as a company, as an issuer, as somebody raising money. You are responsible for driving the investors to the offering page online to invest. There is no magic wand out there. There is no someone who's going to say abracadabra and magically thousands and tens of thousands and millions of people are going to come to your offering page. That doesn't happen. You as a company are responsible for driving that traffic. And we're going to talk about some of those things. But one of the things that I do in my practice outside of being a lawyer is I tend to take on a role I call as the quarterback, where I consult with companies and actually help them build the audience, help them reach the audience, help them with all the things that have nothing to do with being a lawyer, but have everything to do with being a marketer and an entrepreneur and a businessman. And so there's really 2 different things you need here when you go into these. One is you need to make sure you have the right people helping you do the legal stuff and accounting stuff, but you really, really, really need to focus on marketing, and you really need to focus on building that crowd before you get started. The second thing that I wanted to bring up, this is more of a legal one, and I'm sure other people have talked about this, but there is a difference between regulation CF, regulation crowdfunding, where you can raise up to $5 million and anyone can invest, whether they're accredited investors or not, and Regulation A, where you can raise up to $75 million with the same type of crowd of people. The big difference is there are a lot of regulations, and my number two mistake that people make is you can't advertise or market the terms of the offering. In other words, the price of the stock, when the offering ends, what type of equity or debt you're selling. You can't do those things for Regulation CF only. You cannot do those anywhere in your marketing other than on the funding portal or broker-dealer website where you're raising money. So you can't run an ad, you can't put a Facebook ad up, a Google ad, you can't have a press release that says we're selling shares for $5 a share. Come to this website for Reg CF. You can only have those terms of the offering on the site where you're raising the money, and you can explain them there and what have you. With Regulation A, you can do it anywhere you want. It doesn't matter as long as you're not false and misleading. But it's one of those weird quirks in the Jobs Act where you have two laws that are virtually the same thing, Regulation CF and Regulation A, that allow you to raise money from anyone in the public. But the big difference is you have a lot of advertising regulations and marketing regulations about what you can and cannot say in Regulation CF that you don't have with Regulation A. And those specifically surround the concept of what are the terms of the offering. You cannot bring those up. And I see it all the time. I see people running ads saying, invest for only $10 a share in our new company. And it's a Reg CF offering. And that ad is blatantly illegal. The problem is the SEC or a state regulator can come in and say, you know what, you're breaking the law. We're going to take away this exemption. We're going to make you send all the money back to your investors. We're going to make you a public company. We're going to fine you. There's a whole lot of bad things that can happen. So just don't do it. Don't succumb to the temptation of saying, hey, this is the term of the offering and I'm going to put it in my ads because who's going to ever see it or no. Don't do that. Third mistake I see all the time is making the flow to get to your investment more difficult than it should be. As I say, always point people right to your investment page. I see a lot of people who say, we're going to start a Reg CF or a Reg A offering. I want to send the people to my website first, my company website. I want them to go there and learn about the company and then direct them to the offering page where they're going to invest. This is a mistake. You need to send people directly to the page where they can invest. I can't tell you how many studies on e-commerce will tell you that every time you add another click or another form to fill out or another place that has to be redirected, you lose a large percentage of the people that are going through the process. So why would you send people to your company website rather than send them right to the page where they can invest? And I see this all the time. And I always wonder, why are people doing this? Because you're just losing out on a huge number of people that could be going through. And the other thing that you see a lot is, in the same kind of regard, is something I call cart abandons. Whenever you bring people to your web page, it's a very, very small percentage of people that are going to click to then get through to the offering page where you can invest. When they get to the offering page, you need to make that checkout process as simple as possible, because the more people that try to go through it and the longer it is, the more difficult it is for people to finish it. And e-commerce people will tell you there's about a 70% abandon rate of across the board in e-commerce of people that start to buy something or start to invest in our case and don't finish. With mobile phones, it's actually over 80% because it's harder to get your fingers to do things. So you're going to lose the grand majority of people that are going there to begin with, which is another whole topic that you need to think about is, how do I bring those people back in? How do I get those cart abandons to actually invest? But those are things that you can avoid very much by A, getting people right to the page where they can invest, and B, making the process as simple as possible for them to check out and get through. Here's number four. The number four thing that people make as a mistake, and this is a big one. I see it all the time. People think this is totally fine, but you are not allowed to pay unregistered people money to refer you investors. And by that, I mean it cannot be a transaction-based payment. And let me tell you what that means. When you hire a broker-dealer to do your Reg A offering or your Reg CF offering, or when you go to a funding portal to do your Reg CF offering, they are legally registered with the SEC and FINRA, and they are allowed to charge a percentage of every dollar that's raised from every investor. That's the way Wall Street set it up. They want their own to be able to make money. The difference is if you decide to pay someone, let's say you have someone, I'll run ads for you. I want to take a percentage of what you raise, or I've got a list of investors I'll sell you and I'll take a percentage of whatever you raise. Those are illegal finder's fees. They are absolutely not allowed. There are some exceptions when people are in another country, but just as a basic rule, you are not allowed to pay any kind of success fee, transaction fee, or anything that looks like it's based on an investor actually investing to someone to market for you. And I am approached constantly by clients who say, I've got someone who's willing to go raise some money for me. They just want to get 5% of whatever they bring in. And I say, are they registered? Are they, FINRA? Do they have a broker dealer? No, they're not. You can't do it. You can pay them a flat fee. You can pay them a monthly fee. You can pay them something that's not based on the amount you're raising, the number of people that they bring in that invest, or the amount that's invested, but you cannot pay transaction based to people. So that's one of those things you need to check with your lawyers about to make sure you're not screwing up. One of the things that happens is you have to disclose if you pay that to the SEC in certain filings. And when you do that, they know. And if you don't disclose it, you just lied to the SEC, which is even worse. So there's a lot of bad things that can happen by doing it and not much good that happens, so steer away from that. Mistake number 5. This is the biggest mistake I see with clients, and this has nothing to do with legal. Mistake number 5 is not communicating with your investors. So you go out, you take the effort, you make the effort to create this offering, you go out there, you start raising money, you do all these things, and guess what? You decide you're not going to talk to your investors after they come in. You should be constantly communicating with your investors, whether it's a follow-up email, videos, what have you. Let them know that they're important. They may have only given you $100 or $1,000 or what have you, but if you treat those people like the business partners that they are, they invested in your company because they love what you're doing. They will now turn into people that help you advocate for your company. They'll buy your products. They will go out and tell their friends and family and what have you to invest. So it's very important to not miss those people. Mistake number 6 is influencers. Without going into too much detail, if you're paying influencers to drive traffic to any online equity crowdfunding site, you have to disclose that you are paying them. It needs to be, there are very specific rules. Again, this is something to check with your lawyers about and make sure they follow rules. I've written an article. If you go to Medium and go to Kendall Almarico on Medium, I've written a great article. I think it's a great article. It talks about the things that can go wrong if you do this. But it's very, very common to have influencers say things like, I love this company, I just invested in it. That's okay. But if you're paying them to do that, they also need to say, I was paid to do this, and they have to disclose the amount of compensation, or you can get in some very serious trouble. So those are things I see constantly ignored, but it's one thing to be very aware of. Mistake number 7 is assuming that when you take your Reg CF offering or your Reg A offering, you put it on a funding portal or you put it in a broker-dealer's website, that funding portal or that broker-dealer are going to bring you all of your investors. That just doesn't happen. I mean, the legitimate funding portals out there will tell you when you talk to them, I've got 1 million investors on our site or what have you. The broker-dealers will tell you, we've got all this bases of investors, blah, blah, blah. But they are not actually going to do much in terms of getting those people to you unless you've raised some of the money yourself from your own people before they'll actually market to you. But more importantly, don't assume that because a funding portal says to you, we've got 1 million investors on our site, that those 1 million investors are interested in investing in your company, or that they will ever even see your offering. My experience has been, and I'm sure people have had different experiences, but I've done this on all the major funding portals. I've done it through all the major broker dealers. I've run a number of these offerings. My experience is that it's really only about 5 to 15% of the money you raise comes from that audience that you get from the funding portal. 85 to 90% of the money you raise comes from your own marketing efforts. So if you don't have the ability to reach a huge number of people, you need to spend money on marketing to reach those people. Don't count on going on a funding portal and all of a sudden magically having all of their investor base come to your offering. It just doesn't happen. It's not the way it really works. Mistake number 8. I tell my clients all the time, you want to be $1 billion company, act like a billion-dollar company now, even though you're not. And by that, I mean, do the little things professionally. When you do your video for your crowdfunding, make it really good. Have good lighting, have good audio. Don't do it, fuzzy. Your camera's way over there. You hear it sounds like you're in a tin can. When your website's being built, use great graphics. Don't use crappy stuff. Don't make it look like a 1980s website. There's a million of these little things you can do. Your signature blocks in your emails, make them uniform. Make sure that your company is on your LinkedIn profile. These are like very simple things. Coca-Cola, their executives, you go to their LinkedIn profile, they're on there. You go to their website, it looks professional. Their videos they put out look professional. I'm not saying you have to spend the money Coca-Cola does to do this. We live in a world where it's pretty amazingly easy to make things look incredibly great. So do it now. Start acting like you're a billion-dollar company now. Don't wait until you're a billion-dollar company and then try and make the things that you've done look better at that time. You're going to build investor confidence. How close are we at, Devin? I've got two more points to make. Then one of them is very simple.
Race through them.
Got it. Number. Don't make unsubstantiated claims. You can't lie. SEC rules say no lying, you don't have any puffery like you do in regular advertising. Just tell the truth in all your ads. And the last one is just a reiteration of what I said before. It's all about marketing. If you don't market correctly, you're not going to raise the money. Don't ever forget during this, crowdfunding is all about marketing. The legal stuff is important. The accounting stuff is important. Everything's important. But if you don't market it correctly, you will not be successful.
Boy, what a great!
Did I race through enough?
Yeah, that's perfect. Kendall, that was just a fabulous. It's worth every moment that you spent preparing. Every moment that people have invested in this conference is redeemed just by this one presentation. Full of
Devin, let me also offer something. I'll upload the deck that you can, if people want to see it. Unfortunately, I was unable to make the prep session. I got a bunch of crazy stuff going on, and I thought I could just push this button. But there's a very nice deck that goes through all this that'll make it very simple for people, and it has some really bad AI images in it that I created that I think will make people laugh too. There's some good ones there. So
okay, so let me invite you to pop into the VIP room if you've got a few minutes. I know there'll be people who want to chat there. Some of the other attorneys that were on the panel earlier are, I think, still in there, and so you can pop in and join that conversation. I know there are a lot of interested people. And folks, if you're not a VIP yet, I encourage you to join the VIPs. Just $25, you get access to Kendall and the rest of the speakers today, the VIP group, the VIP webinar tonight. You get the VIP LinkedIn group, the handouts. There is so much value there. Don't worry that you've somehow missed the boat because you didn't do it yesterday. There's still value there, well worth the $25. Kendall, thank you so much.
Thank you, Devin. I'm a cheap date for $25. That's perfect.
That's right. Absolutely. You never get more time with smart people for $25 in your life. So
incredible deal.
That's right. Hey, thank you very, very much, Kendall.
Thank you, Devin. I really appreciate it.
All righty. I am excited now to introduce you to our next speaker. Johnny Price and I are going to have a little conversation, a little one-on-one, but Johnny is the president of WeFunder. There's some rock stars on the SuperCrowd program today, and I want to be really clear. Johnny Price is one of the big ones, right? This is why people signed up. I asked AI to write some marketing content for me, and the AI recognized that the reason to show up today was to hear Johnny Price speak. So this is a big deal. Even ChatGPT knows it. Johnny, thank you so much for being here.
Thanks for having me, man. It's always good to chat with you, and thanks for the kind words.
Well, it's really kind of you. I know you have been, and I think still are, on a sabbatical. And,
yeah, that is a testament to your importance, Devin. That I am taking a mini half-hour break from a 3-month sabbatical. But yeah, my brain is covered in cobwebs. So no hard questions, please, about
Okay.
Reg policy, because I can't remember anything about regulation crowdfunding at this point.
Yeah. Well, Johnny, I really do appreciate you taking a break from your break to join us today. And I was so thrilled when you agreed to do that. It's been funny, we have a lot of overlapping people in our circles. And so I've had 2 or 3 people reach out and say, Johnny's not going to do it. He's on his sabbatical. We got Johnny. He's a great guy.
Not for anyone, but for Devin Thorpe.
Yeah. I'm just kind of bragging. That's what I'm doing here. I'm just kind of bragging that Johnny Price showed up for us from his vacation. Thank you. I really do genuinely appreciate it. Listen, I want to jump in. We focus on impact, crowdfunding, making money, but impact is a key qualifier for us at the Super Crowd. And your roots are deep in that, right? Before WeFunder, you were at Kiva, which was a huge, nonprofit entity working on creating value through crowdfunding for disadvantaged entrepreneurs and for social entrepreneurs. How have you seen that work transition into your WeFunder work? What's the overlap? What's the connection there?
Yeah, absolutely. I mean, yeah, as you say, you can trace a through line from my career. I started my career in management consulting. Not too much impact there, unless you're getting really creative with the accounting. But yeah, I was at Kiva.org for 7 years, and I started their US team there. So most people knew Kiva for lending to farmers in rural Kenya or Cambodia or South America, the developing world. But I led the team where we brought that model to support entrepreneurs in the US. And so we were making very small micro loans, 5K, 10K loans to underrepresented small business owners in the US, mom and pop shops, barbershop in inner city Detroit, rural farm in Arkansas, let's say. And those loans were 0% interest. And as you say, they were crowdfunded. So I ran that team for 7 years. And then in 2018, I joined WeFunder. WeFunder is a public benefit corporation. We are a for-profit company, but we're a PBC as opposed to a C Corp or an LLC. And so we're legally obligated not to maximize shareholder value, but to maximize or to uphold our PBC charter, which talks about getting more capital flowing to startup founders and spreading the benefits of capitalism around more broadly, which obviously is a big part of what investment crowdfunding is all about. So there's obviously a lot of parallels between Kiva and WeFunder that focus on impact, the crowdfunding element. The biggest difference, I would say, is that Kiva was a nonprofit. So as an investor, you weren't looking to make a return. You were just hoping to get your principal back and then re-lend it and help someone else. But it was very philanthropically motivated. Whereas on WeFunder, there's a kind of a hybrid investor motivation, right? Investors are looking to have a positive social impact in the investments they're making. Obviously, as your name of this kind of conference and your movement implies, I know that's really important for you. But also, probably most investors are looking to make a financial return and have the ability to make a financial return. And then Kiva was a nonprofit, so not really a kind of economically sustainable business model, or didn't really have the potential to grow. It was really entirely dependent on grant funding. Whereas at WeFunder, being a for-profit business, we charge fees to founders if they're raising money. The main way we make money is to charge founders a percentage of that. That's revenue for us. And then we can use that revenue to cover our costs and grow the company. And it's a sustainable business model. So those are kind of the two differences, I would say, between my work at Kiva and my work at WeFunder.
Well, it's really a kind of a fascinating parallel, and it is easy for me, at least, to browse the WeFunder pages and see the connection. Right, I see lots of diverse founders who traditionally have had difficulty raising capital from venture capitalists. I visit WeFunder and I see lots of social entrepreneurs. My gosh.
Mm-hmm.
The truth is I have invested in across a lot of platforms, but no platform more than WeFunder.
That for me is a big part of why I work at WeFunder, By the way, that doesn't need to be a left of the political spectrum thing. I would say, if you're a Democrat, I'll tell you that, 1% of venture capital goes to black founders, and I think it's 2% goes to female-only founders versus 80% to male-only founders. And so if you're a Democrat, I'll say, yes, if you kind of democratize who's making these investment decisions, we can get more capital flowing to entrepreneurs of color, female founders. But if you're a Republican, I'll say that the last stat I saw, 77% of venture capital goes to 3 states, California, New York, and Massachusetts. And so, those states are all blue.
Blue states, right?
So maybe if we want to get more capital flowing to Tennessee, where I live, then again, if you allow more people in Tennessee, because all the VCs are on the coast, right? A big part of the reason why so much venture capital flows to those 3 states is because the VCs are there. It's kind of symbiotic. But if you can empower citizens in Tennessee to become citizen investors, and hopefully we can get more capital flowing to founders in Tennessee. So that's on the kind of, the diversity of founders on the platform, ethnicity-wise, gender-wise, geography-wise as well. And then, in terms of industry sectors, I personally believe that too much venture capital over the last, 3 or 4 decades has gone to optimizing ad clicks. And, it would be cool if more went to, businesses that are, where I would say are maybe having a more positive social impact. And healthcare is a really good example of that. Healthcare is the number 1 sector on WeFunder. And I think part of the reason for that is that, a healthcare venture capitalist, obviously they're just looking to maximize financial returns. But if you have a family member who died of a particular cancer, and there's a startup that's trying to tackle that cancer, then your motivation as an investor to invest in that startup very obviously might be about more than just maximizing your financial return. And so healthcare is one example, but it's not just kind of tech startups, right? It might also be local restaurants and coffee shops. And, maybe I want to invest in a restaurant down the street from me. My wife invested in one that was on Honeycomb, which is a really awesome platform that's focused on kind of Main Street businesses. I'm sure you know them very well. And, now we go to the restaurant and, we're investors in the restaurant and we get perks because we invested in that restaurant. And so, for me, I think one of the things that democratizing investing can do is to kind of shift the allocation of capital and maybe kind of fund more of the businesses or the types of companies that we as society collectively would want to kind of shift money towards. Shouldn't overdo that. Reg CF or plus Reg A is a very, very small percentage right now of like venture capital at WeFunder. We're trying to grow that percentage and grow the whole industry. I'm sure we all are. So hopefully over time we can move the needle more, but right now it's still a pretty small drop in the ocean.
One of the sort of key branding elements of WeFunder is the idea of community. Mm-hmm. And I think, a community round. In fact, I think you and your team are insistent that that's what we call a crowdfunding round. It's a community round. And that means a lot of different things to a lot of different people. And it's a flexible term, which is great. How do you think about it? What do you think of as being the perfect community round, and how does that differ from a traditional venture capital round in your mind in terms of outcomes, benefits to society and others?
Yeah, and I realize I might get in trouble with you for saying this because crowdfunding is kind of in your tagline underneath your picture there on this Zoom call, and obviously a lot of people are kind of invested in the term crowdfunding, no pun intended. But I like community round for 2 reasons. The first is I think I'm more into community than crowds, and for me that is kind of what this whole industry is about, is kind of building your community. Like Kendall said on just before I came on, like you want to build your community first and then do an investment crowdfunding raise. It is for companies that have community, that care about community, And for me, I get more value in it. It kind of makes more logical sense to me if we're talking about building community here than going to the crowd. So that's the first reason. And the second reason, honestly, maybe a little related, but in my experience talking to startup founders over the last few years, we unveiled that term in, I want to say 2022. They just think community round sounds way cooler, and VCs do as well. And so I think the biggest challenge that we have as a sector, I'm curious if you agree with this, is that a lot of founders will just go the VC path. If they can raise VC money, they will raise from VCs because it's the done thing, you know. And a lot of VCs will say, don't do crowdfunding because it will mess up your cap table or whatever. You know, it's too risky or whatever. So the biggest challenge for me that we have as a sector is to get the coolest startups and cool, you know, also kind of AKA the ones that are hockey sticking and gonna generate power law amazing returns for their investors, which is why VCs are piling into them. So those companies that, you know, VCs are lining up to invest, they're oversubscribed. I think like VCs are quite smart. I'm not saying they get it perfectly right, but generally speaking, they make returns for their LP investors. So generally speaking, if VCs are lining up to get into deals, on average, those deals will generate returns for investors. Those are the deals that we want to get on WeFunder and other platforms as well. And so we want to make this cool. We want to make this something that is compelling. And every single founder I've ever spoken to says community rounds sound way cooler than, you know, running an investment crowdfunding race. And so that's a big part of why we like the term. And it's exactly the same thing, right? It's a Reg CF, it's equity crowdfunding, investment crowdfunding, it's a community round, it's exactly the same thing. It's just branding, but it's a really interesting example for me of the power of branding and what you call something can actually make a real difference. And like, does a really hot startup founder want to do crowdfunding? No. But do you want to let your community invest in your startup so they can benefit as well as these VCs? Sure. Okay. Like, show me a startup founder that doesn't at least profess to want to build stronger community.
Yeah, it's a fascinating thing, and I think the idea of branding crowdfunding in a way that works and appeals to more people is important. I'm glad that you're being thoughtful about that. What are other things that we can do as a community to enhance the branding of regulation crowdfunding so that founders in Silicon Valley and other cool startups around the country feel more free to do a community round so that more of us have an opportunity to participate before they go public at $100 billion valuation and their stock drops 50%?
Yeah, it's a good question. I mean, part of the reason I am at WeFunder after 7.5 years in the job is I think that this can be the future, and it's still small and the growth rate is too slow and we're trying to accelerate that. But it's not that hard for me to imagine a world where, especially consumer-facing companies or companies where it makes more sense to engage and build stronger communities, where those companies would invite their community to participate as investors alongside VCs and institutional investors. Don't know if we'll ever get to the point where we kind of totally eradicate VCs. Don't even really want to or need to. I think VCs actually can play a valuable role in kind of doing due diligence and setting terms and that kind of thing. But it's quite easy for me to see how in the future, it's a done thing for consumer-facing companies or community-oriented companies to invite their communities to invest in them. And it's almost like you're under pressure from your community to do that. And if you don't do that, then you're seen as not caring about your community because your competitors are inviting their customers to share in the upside. Why wouldn't you? Do you not care about your customers and community? So that's kind of the future that we're trying to build. And, I think it will just naturally happen more and more. I think that the most important raises that we've had on WeFunder that can kind of move that needle are companies like Mercury Bank. I would say that is one of the jewels in WeFunder's crown, where as part of their Series B, they raised 120 million Series B. I think it was led by Co2 and Andreessen Horowitz invested, and they had VCs lining up. They were oversubscribed, but they reserved a $5 million allocation to like 2,500 of their customers invest. Now they've gone on to raise their next round. Their Series C was led by Sequoia and happened earlier this year. So that is, for me, about the most prestigious startup that has done a community round, a Reg CF, and invited their customers to participate. And so companies like Replit and Levels and Substack are other examples of Andreessen Horowitz-backed companies that have done a WeFunder raise. But the number's too few. Beehive Series B was, I can't remember, NEA led their Series B, and then they just did $1 million allocation. But for me, it's like we just need more and more of those examples. And over time, the concerns of VCs and lawyers and founders that, this isn't cool, or this is what you do if you can't raise from real investors, or this is too risky. There aren't too many precedents. There aren't examples of companies that have done this and raised follow-on financing and gone on to IPO. Like over time, those concerns will dissipate because there'll just be more and more examples, and crucially, like really prestigious, really cool examples, and companies that do not have a problem raising money. They have all the best investors in Silicon Valley lining up to invest in them. They just think it's cool to let their customers invest. So I think part of it is just it will naturally happen more and more over time. But that's not really something we can do. I think to your question on what we can do to kind of accelerate the transition towards that future end state, is the main thing I can think of is just support the founders you invest in, not just with money, but in other ways as well, right? So if you can be a loyal customer and tell your friends about it, be an ambassador for that company that you invested in, or maybe help them with a hire that they're looking to hire for, or give them product feedback, and just be a champion. We talk about this, we pay lip service to this a lot, like, oh, you make kind of loyal customers and passionate brand ambassadors. That's one of the reasons that founders should do a Reg CF. But if we as investors, community investors, actually really deliver on that and really add value for founders, then when founders are talking to other founders about how they should raise capital along their journey, it becomes more and more obvious. Like the product of a community round is not just, I raised this money, but wow, this really benefited my business in all these cool ways. And, it was so awesome to invite my customers to become investors. And then they really did, spend money with me, and they were more passionate brand ambassadors, et cetera, et cetera. So the more we can actually deliver on like the value of community, I think the more it will make kind of economic sense, for founders to raise money in this way, at least as part of the round. And as you kind of, the question you asked earlier was getting at, and the Mercury example or the Replit example, I think Replit's was an 80 million Series B and then did $5 million for their community. Beehive was a 32 million Series B from VCs and then 1 million from their community. So definitely doesn't need to be an either or thing. I'd say VCs add a ton of value. So raise from VCs, absolutely. But then also letting your customers invest can add a ton of value. So do that as well as maybe a small allocation of your Series A, your Series B, your Series C.
It does have a tremendous benefit to society when more of us can participate in that wealth creation process, right, with the VCs. That's definitely a benefit. One of the complaints that I hear from the Silicon Valley community all the time is, hey, you're going to mess up your cap table. You mentioned this, but you have done thousands, I think now. I think you measure the offerings, the successful offerings now in the thousands, if not close. You tell me, I forget. But most of those offerings have many hundreds of investors. Some have thousands of investors. Have you seen any real horror stories come up because they have too many shareholders? What are you seeing in reality?
Yeah, well, WeFunder kind of solves this problem. I think it was in 2021 when the SEC rule changes to Reg CF were rolled out, and they allowed for SPVs, special purpose vehicles, or a crowdfunding vehicle, I think is what the law calls it. Again, that's what cobwebs in my brain. But and so this is how kind of conventional angel investing works. Platforms like AngelList, all the individual investors are rolled up to one special purpose vehicle, one SPV, which is an LLC that is the investor, which is the one line on the cap table. So yeah, concerns about messy cap tables are just basically no longer a thing on WeFunder. And so yeah, that's a nice kind of easy answer. That used to be a problem in the pre-2021 days, but any concerns about cap table complexity are now just honestly kind of wrong and out of date.
That's and I think what you're saying implicitly is you haven't had any of those companies come back to you and say, my cap table is screwed up, right? You screwed up my cap table. Have you had any of those conversations?
I don't think so. Maybe there were a few before the 2021 SPV changes, but since the SPV, I don't think we've had any issues like that. And even before, I can't think of specific examples. It just maybe there were some, but yeah, that's kind of multiple years out of date now.
Yeah, I've never been very sympathetic to that argument. Somehow having more shareholders is a big problem. There are a few technical issues that are a little glitchy, but
yeah, I think the only thing was kind of what's that phrase? Perception is reality, and if VCs, even if for no actual reason, are kind of wanting a clean cap table, then maybe that makes it harder to raise from VCs if you don't have a clean cap table. But yeah, I mean, at least with the way WeFunder approaches it, it's just not an issue anymore. And if companies like Mercury and Substack that are being backed by Andreessen Horowitz are fine with this cap table solution, then for me it should work for everyone.
Yeah, that's pretty good imprimatur, right?
Right.
Have them in your deals. You've written a post on Substack, speaking of Substack, about how, who should and who shouldn't try to do a community round on WeFunder or at all. Refresh our recollection. What's your advice?
Yeah, I mean, I think at the heart of it, it's going to work best for companies that have a community, as Kendall mentioned previously, and care about building community. If you're a, no offense, boring B2B SaaS company, and you have a small number of enterprise customers, you don't really care about community, then it just it's less of a good fit. But if you're consumer facing or you really care about building community, I would argue there's no better community building strategy than to let your community invest. So if you really care about building community as a founder, the ultimate apogee of that is letting your community invest in your startup. So that's the sweet spot. That being said, I mean, I would say the majority of companies on WeFunder, they need to raise money. And this is a way that they can raise money, even if they might find it harder to raise from conventional, let's say, VC institutional investors or even kind of larger angel investors. So there's many examples of companies that might raise like 100K to get going, or maybe they're doing the angel circuit. It's a grind, it's taking time, and this can just kind of pour a little fuel on the fire, because now they can get in front of WeFunder's million investors, and now they can publicly promote the offering, and now they can raise from unaccredited investors, and now they can lower the ticket size. And so, and like a lot of healthcare companies, I think is a good example of that. I mentioned earlier that's our number one sector. I guess some of them might get benefit from community. They do actually, but probably a lot of kind of early stage biotech companies, it's actually less about building the community, and it's just more about, okay, this is an easier way to raise money, and this can make it, accelerate my fundraising. So that's kind of the other answer to the question. So use case one, I think the cooler, like more fun use case is companies that have community really care about building community. Use case number two, very, very common. Hey, this seems like a bit of an easier way to raise capital where I can just push the gas pedal on my fundraise.
Yeah. One of the challenges for entrepreneurs and investors is thinking about analyzing and making sense of valuations. How do you coach entrepreneurs and investors to think about that? Because there's a little bit of tension, right, in how an entrepreneur and an investor think about it. But in the end, it works best when those views kind of harmonize. How do you think about it?
Yeah, I mean, honestly, like one kind of almost trite example, but ChatGPT is awesome. If you plug in your startup and your situation and growth rates, like kind of key inputs into investor valuation and terms into ChatGPT, you'll probably get a pretty sensible valuation or kind of investment terms, right? And then you can ask, what are the different types of investment structure? Should I do a price round or a convertible note or a safe? What are the differences between the two? Or if I'm a Main Street business, what are the pros and cons of like a revenue share loan versus a standard loan versus a straight equity deal? And so I think that's a really cool example of where AI is just kind of redressing the balance, I would say. But it used to be maybe 10 years ago where like VCs would have so much kind of power and it was almost like mystique and what are these different terms in the term sheet. And I think it's a really interesting kind of example of how AI has just maybe leveled the playing field, and now founders can come into those conversations with a lot more, I guess, armed a little bit more in those conversations. Obviously, we have the data of WeFunder companies and how they've done historically. I always am a little reticent to put too much faith in that data because just there's so much variability there, and it's very hard to kind of draw too many firm conclusions from that. But we certainly can help founders set investor terms and valuations based on like WeFunder precedent. And I always encourage them, look, just talk to investors, right? You definitely don't want to just like put your page up on WeFunder and blast it on social media on launch day and hope for the best. By the time you get to kind of public promotion, you want to have really kind of tested the waters, no pun intended, and just felt out investors. So in those kind of early conversations, trying to triangulate, and if you don't have someone that's willing to write you a 10K, 20K check on these terms, then you probably want to work a little bit harder to find those anchor investors before having confidence that those terms are going to work. And okay, now let's put it up to the crowd. But I do think, one of this goes back to the kind of diversity and also kind of geographic kind of diversity of investments on WeFunder and in this whole sector. I think there are a lot of markets where there aren't enough investors, and those investors, I would say have too much power. And so just like commands kind of crazily low valuations, but founders in those markets don't really have any options. And so they're kind of forced to take those terms which aren't necessarily fair for founders. And so I do think that's one of the benefits of this model where people from around the country, even around the world, can come in and invest. It like gives those founders a slightly bigger pool of investors. And so it kind of can help ameliorate sometimes if there's kind of investors taking advantage of founders because they're the only game in town.
Yeah, it's fabulous. Johnny, thank you so much for making time on vacation to be with us. It's just been a joy. Your insights are invaluable. Your perspective is tremendous, and I thank you very much. Give our best to your family thank them for sacrificing you for an hour to
Hey, the kids are at school and my wife's at work, so no sacrifice on their part. Yeah, it's more me sacrificing the time on the pickleball court. But yeah, Devin, you are the man. Thank you for everything you do to grow this sector and kind of build this movement and community. You're awesome, and I'll be back in the saddle in a few days' time. So I look forward to catching up post September 1st when my 3-month sabbatical finally sadly draws to a close.
All righty. Well, we look forward to having you back. Thanks a bunch, Johnny. Really
Thanks, man.
appreciate you being here.
See ya.
I'm excited now to introduce the moderator of our next panel. Our next panel discussion is more crowdfunding portal leaders. And one of my dear friends, Dorian Dickinson, the CEO and managing director, co-founder of Funding Hope, is our next speaker. He's our moderator for this panel discussion. And I've had the opportunity over the last 4 or 5 years to get to know Dorian very well. And, he is absolutely passionate about using crowdfunding to solve real world problems. He focuses on the UN SDGs as a way to measure impact and looks for all the companies raising on Funding Hope to have some alignment with those tremendous goals. And that kind of impact is tremendous. I'm so grateful that there are people in this world who are so passionate about solving these big world problems. Let me bring Dorian onto the screen here. Dorian, thank you very much for being here. I'm going to invite you to introduce your panelists. You've got a great panel here of, tremendous experts who all know everything about crowdfunding. And so I'm going to duck out of the way here quickly so you can carry on, okay?
Thanks, Devin. I really appreciate it. Good afternoon or good morning if you're still on the West Coast. Welcome to Gatekeepers of the Crowd, inside the minds of Reg CF leaders. As Devin said, I'm Dorian Dickinson. I'm the CEO of Funding Hope, a FINRA member investment crowdfunding platform, and I'm honored to moderate today's discussion. Regulation crowdfunding has become a powerful way to democratize access to capital, empower founders, and bring everyday investors into building businesses that matter. With that opportunity also comes responsibility. And today's panelists are the gatekeepers helping set standards, make tough calls, and shape the future of this industry. Today, we'll explore where Reg CF stands in 2025, the challenges and opportunities ahead, and how founders, investors, and platforms can work together to make crowdfunding even more impactful. Before we dive in, I'd like each of the panelists to take a moment and introduce yourself and your platform. Ladies first, Jackie.
Hey, everybody. A pleasure to be here. My name is Jackie Logan, and I co-founded Raise Green. Raise Green is a crowdfunding portal that is dedicated to climate solutions. You can think of anything from a solar array on top of a school, which would be more like a debt offering for a set amount of time, all the way to a new climate tech startup, which may be raising under some form of equity. And after about 5 years of running Raise Green, 44 securities offerings, raising over 10 million through the platform for climate-oriented investments. We decided to join up with Honeycomb Credit in December. It was a strategic decision to be part of a larger organization with additional services that we could provide to entrepreneurs and project developers that we felt were critical in the space. And we had overlapping values-aligned approaches, they being focused on the health and well-being of local communities through small businesses, and we being focused on the health and well-being of our planet and small communities, focusing on climate solutions. And so now I am at Honeycomb Credit, building out the climate space there. It's been an amazing 8 months already. It's unbelievable. And we've put close to 2 million through the platform, just focused in the climate space. And, I get up every day and am energized to talk to folks that are doing amazing things and investors that want to make a difference. So a pleasure to be here, and look forward to the conversation.
That's introduce yourself and your platform.
Is that John or Levi?
Levi.
Okay.
Yeah, I'm Levi Brackman, and I'm the CEO and founder of Invone. Invone originally started off as mainly focused on real estate. So we have a very deep expertise in real estate. So helping real estate owners, real estate developers, real estate syndicators raise money for their real estate projects. But we have moved on since then to basically be agnostic about the type of issuer who wants to raise money on our platform. What really makes us different is that you can think of us as like the low-cost airlines of funding portals. And what that means is that we're unbundled, right? So instead of you buy the 8%, whatever it is that you have to pay as a cost of capital or the commission to the portal, we actually allow people to buy in various different levels. And also you can either have a monthly fee and then you pay a lot lower on commission, or you end up paying no monthly fee and then a little bit of higher commission. The top commission that we have is only 5%, and we go down as low as 1.5% as a percentage of capital raised. So if you really know that you're going to raise the money and you've got investors who can invest and you've got that kind of reach already, then we work very well for those kind of issuers and those kind of founders because they're able to raise money at a much lower cost on Invone.
Excellent. Thanks, Levi. John, I'd love to hear about you, and that you bring a unique perspective to the panel, being from a broker-dealer operation as well.
Yeah, John Panachone. I'm one of the founding partners of Fola Capital. We're a 5-year-old broker-dealer. Just one little thing that's important. 17 years prior to that, I founded a company called Logic Bay. We were a software company, ran that company for 17 years and sold it. The only reason I bring that up is in the last couple of years, because we were a software company, we created a portal to do in-state, intra-state crowdfunding in the state of North Carolina. And I learned the hard way what that's all about, and regulators, and getting our hands slapped a few times. So that led to the decision to become a broker-dealer. So a little bit of background there. I think what the audience might need to know is, it's not better or worse than a portal, but a broker-dealer is a little bit more broad in scope. So we can do Reg Ds, and we do a lot of Reg Ds. And then we also do Reg CFs as a broker-dealer. We can also do Reg As, but we haven't done one yet. But we kind of look at the exemptions, and we match the right exemption to the right situation. And sometimes it's Reg CF's the right fit, but when there's a Reg D fit there, that's what we can do as well. Number two is the bar is a little higher in terms of due diligence. So a broker-dealer is kind of duty-bound to do a lot of due diligence, about the same level of due diligence that a traditional investor group would do if someone came to them for investment. So that's another thing that's both a good thing and a bad thing if you want to raise money with a broker-dealer. So we do a lot more heavy lifting and a lot more packaging for our clients.
That's a great way to introduce yourself. Thanks so much. Okay, folks, let's get started. I'd like to hear from each of you. How would you describe the state of Reg CF in 2025? What's working well? What's still misunderstood, as we're still a new industry here? Levi, why don't you kick us off?
Yeah, I think that what's working well is that people who really understand what they're doing can be really successful at it. So if people understand what the regulations are and what they can and cannot do with Reg CF, and they also have a good understanding of who their investors are and how to reach them, they can do very, very well with regulation crowdfunding. So because they can go out there, they can target their investors, and they can then raise all the money. But what's still somewhat not so well understood is that you have a lot of attorneys and others who still don't understand Reg CF. So they're misadvising clients. There's a lot of misadvice out there and about Reg CF, and people aren't directed to do Reg CF, and therefore they're doing other things which they don't necessarily have to do, or they're going to very, very expensive money when they could really go to the crowd. So I think that there's a lot of misadvice. I think that since it's still very, very early, relatively speaking, Reg D and 506B has been there forever. I think still people don't understand it that well. And then the other thing which isn't working is marketing is very, very hard. So I think that's another issue, because there are certain restrictions to marketing for Reg CF that don't exist necessarily for Reg Ds. Therefore, the marketing is very, very difficult and also very, very expensive. So we've got to figure that piece out as well.
That's great. John, since you've now moved into that broker-dealer space, what do you see that's working well? What do you think those challenges and what's being misunderstood are? And are the regulators playing a role in that as well?
Yeah, I would agree with the previous comments right there. I think at a higher level than just crowdfunding, I think there's been an awakening across the country around investing in private businesses. Most Americans haven't done that, since 1933. So this is new to a lot of families. It seems risky. And we can talk about some stats, but the recent report that came out from the SEC saying that the average Reg CF was $364 and the average was $113,000. Yeah, that's a pretty low number if you ask me, right? So, I mean, that's good funding for a lot of small startups and stuff, but that's not meaningful, lasting capital. And if you can raise up to 5 million, we got a long way to go. So in terms of trends, I think there needs to be more discussion nationally around investing in private businesses. Not to go into the weeds, but like the recent political discussion about letting 401k money go into private businesses. Private equity is going to take the same money the teachers, the firemen, and the cops can't invest now, and they're going to invest it in private companies that they want to invest it in. I don't think that's a good thing. So on one hand, we're not allowed to invest in private companies. On the other hand, we're going to let the people that manage funds do that for us. That doesn't make sense. So I think like those things are good examples of an awakening. And I think more and more people, especially younger folks, younger generation, are going to be more apt to invest in a private company, no matter what exemptions used. And that's the trend I'm seeing.
Yeah, that's actually great insight on that. Jackie, you've had experience now with 2 platforms. What do you think is still being misunderstood now that you've seen it from a couple of different angles? And what's working well? Where are we going next? Especially appealing to younger investors and the renewable energy community offerings aspect that you bring to the table.
Yeah, look, I think from one of the things that we've always said at Raise Green, we say at Honeycomb, and it's like young folks get to the end of the climate march and they're like, what do I do next? And the wonderful thing about Regulation CF is that if you're 18 years and older, you can, on your phone, click a button, jump on and take climate action today. And the wonderful thing, as we all know, and this is consistent with even just, a small business that's raising capital and getting the words investomer, where you have an investor and a customer, but just the concept of engagement. When you give people the opportunity to invest, get involved in that way, this then has other benefits to it. They talk to their friends about it. There's a sense of, in the midst of almost a paralysis for many young people in particular. I mean, I think it expands all the way up to older people as well. There's a feeling that you're taking action today, and, there's a kind of agency and empowerment that comes with that. So I would say, what's working for us and vis-a-vis in particular, for the young folks who are, digital natives, taking, on a Robinhood and doing all these kinds of things. And they actually say they want to take more ownership of managing their own money and they want to do more non-traditional stuff. I mean, Reg CF is a great place for them to dedicate a portion of their portfolio. Obviously, we don't make any recommendations here, and anything that's done on any of our platforms has, a range of risks to it. So just want to be thoughtful about that. But so what we do know is, scroll forward here, we know that Reg CF is a real source of capital for projects, community scale projects, a solar array on a school. We did a super interesting project for actually a small green bank coming out of Maryland. They wanted to build a solar array on top of a school in Baltimore. The solar array was going to give, 25% below the utility price of solar, of electricity to the neighboring folks who were low income. 100% of that, the production of the solar array, is going to go to those families, about 150 families. And they were missing the last gap capital in order to get that project over the hump and paid for. And so they popped on our platform, opened it up. And even though, it was actually a 15-year investment at not a particularly high interest rate, but people felt the importance of the story, that this can, we want to see this project happen, filled up the raise, and the project now actually has been completed. It's in production, and the families are benefiting from that low cost energy. So know that Reg CF can come in and do things, in the project space, help projects get over the line that might not happen but should happen, and give everybody a chance to put their stamp and move the climate initiative forward. So I do feel it's a great opportunity for us. Of course, it also creates an opportunity for a different kind of investor. If you think about a lot of the equity crowdfunding that's out there, many of the investments are, the opportunity for a 10x outcome. It's an equity investment of some sort. And the idea is that if this thing takes off, wow, I could really see a great return. But there's also a whole other stream of investors, impact investors of sorts, that maybe not looking for a 10x, but maybe looking to be heavy on the impact. And the wonderful thing about doing projects, for example, is they tend to be debt oriented with a limited time frame, and it opens up a whole new investment investment area for folks that want to do impact investing, per se, in a more, which only folks who have in the past were accredited investors could actually directly invest in a wind project or directly invest in a solar project.
I completely agree, actually, with you, what you're saying here, Jackie, because one of the things that Reg CF really does, because it allows the non-accredited investor to come in, it allows for this kind of diversification. It could be in clean energy, it could be in climate, or it could be in real estate. It could be even like we, for example, have up on our platform a litigation funding deal up, which we were just on the meeting yesterday with some of the people who are presenting. One of them actually invested in this deal, and he's very excited about the potential for this litigation funding going on. So and that's a really interesting one, because this is a company which already had investors, and then ended up in a situation where it had to go into litigation. And they could just go straight back to their investors through a Reg CF. Most of those investors were non-accredited because they initially did a Reg A, and they could jump right in now and then go back to those investors for this litigation funding support. So it's there's the non-accredited investor now has access to all kinds of what might have been in the past exotic type investments, and now they can kind of jump in. It's not just startups, it's not just real estate. Yeah. And there's climate, and there's all these other kind of projects which people can go in and invest in. And we actually have a green project coming up as well in carbon swaps, which is coming up and will go on our platform soon as well. And that's also projects, and people can invest in those as well. So there's really the smorgasbord. So it's really very, very exciting. So I completely agree with Jackie on that.
And how are you seeing? Are you seeing a shift in what the investor profile looks like from a broker dealer perspective? Are you seeing it change in Reg D, or seeing it change in Reg CF? Are they getting to be younger? Are they having more impact with what they want to invest in, or are they looking at it in a traditional manner?
My answer is yes. My two colleagues here just described the market. My advice is, and this is what we're seeing, and we've learned this, we got to look at this thing called the investor community as a market. And there's different segments of that market that my two colleagues just described, right? There's people that care about I call it industry related stuff. So like carbon credits and stuff like that, and green businesses are an example of an industry. Folks, I care about that potentially as a person in the market. So that's what's going to be interesting to me no matter where I live. Secondly, we have a geographic market, right? Within a walking distance of the bar that's raising money, right? So that's a geographic market, right? And then lastly, we have a demographic market. We work a lot with veterans, for example. Our deals, we get checks from all over the country by fellow veterans because they have a kinship together. And that's true for minority-led and women-led businesses and all different kinds of demographics, right? So one point I want to make, if there's all the crap I could talk about that'll put people to sleep, there is one thing I'd like to share that kind of goes along with your question, and that is the importance of alignment, given what I just said, right? Starting at the end and working our way back, we learned the hard way that alignment is absolutely critical to success. So it starts with identifying that segment of the market that's your primary target investor and saying no to everybody else, right? So who is that? Just like launching a product, right? You want to target your customer. Backing up from that is what security type would be understandable to them and appealing to them. So going to a first-time $500 investor with some crazy, complicated, safe investment is an example of a misalignment. But going to them with a revenue share agreement, good alignment there, right? The third one is, we're a little bit spoiled because we're a broker dealer, is the right exemption. So oftentimes we say, you know what, given what you want to do and how much you're trying to raise and what the minimum raise amount should be, we recommend a Reg D 506B, because you can take up to 35 of your non-accredited friends. That's probably enough. You probably don't need much more than that. You don't need to do a Reg CF and do an audit and all that, right? Just generally speaking, there's more rules than that. But aligning the right exemption up is the next step. And last but not least, and I get rocks thrown at me for this, but got to have a business plan that shows that A, you're going to be good stewards of the money, and B, they're going to get their money back. You can't guarantee it, but you ought to have a plan that at least gives it old college try that, look, here's my 5-year plan, and here's how I plan on taking your investment, putting it to work, and providing you with a return without any guarantees. So those 4 things, to answer your question, I think are important when you're talking about success in the market of all these people trying to raise money, even with Reg CF. That alignment, I think, is the trend I'm seeing. That has to be right, or your chances of success kind of go down the drain.
It's interesting because what John's mentioning about, making sure that you've got, there could be a 506B, 506C, it could be a Reg A. And a lot of people don't understand this at all. Another thing they don't understand is a lot of these things they can do on their own. Actually, you can do a Reg A on your own. You can do a Reg D on your own. You just can't do a Reg CF on your own. In other words, you don't really need a platform for all of those things. So they come to us, for example, if we think they should do a Reg A, we can help them from a technology standpoint. If they want to do Reg D, we can also help them. We actually host the Reg D. We don't take any commission for Reg Ds or Reg As, which is a key difference. So we'll just be a platform for them. I know sometimes other people might take a commission, but we're not allowed to as a fund.
Right. Exactly. Jackie, what are you seeing as top signals that show an issuer is ready for a successful raise? Johnny Price from WeFunder was just on talking about the community and having that customer base and the importance of that one side and the raise green side that shows that an issuer is ready to have a successful raise.
Yeah, I mean, one of the biggest things that I look for when I'm speaking to an issuer is you gotta want to do crowdfunding. And I think, Johnny was touching upon that. You've got to really like the idea of reaching out to a community and, even if your community isn't that big, accepting the fact that this is not set it and forget it, that you are ready to roll up your sleeves and do everything in your power to get the word out and get folks to the platform to invest. So one of the big, things, because of course I am speaking, to some folks that are used to VCs, right? And so they're like, wait a minute, you mean I gotta email everybody and do all that kinds of stuff? And once I, start to hear that there's some reticence about that, then it's like, look, you gotta really want to crowdfund. Otherwise, it's not just about the money. I get it. You need the money. You want the money. And maybe we're even, and then there is the case when we may be the only source for them to give it a shot. But if that is the approach, then appropriately size your raise, appropriately and your use of funds, so that it just kind of makes sense for everybody. And just in terms of other things, look, if somebody comes like from the renewable energy space, if folks come to us and they don't, just in the same way you were saying that they have to have a good business. I mean, this is a business. You're investing. This is not donations, right? And you have to have a good plan. And the question is, how far along are you in that plan? And, because the further along you are, the lower the risk is, as you know, and the better you can communicate your story. But having said that, it's always balanced with who's the team that's running it. And so just like in some sort of startup, which is, doing a new biotech technology, who's on that team? Do you believe that they have the right people on the team to take this earlier stage organization, and whether it's a project or a company, and get it to the next level? And so, and then of course, a very, very clear articulation of your use of proceeds, and that use of proceeds makes sense in the journey for like eventual, like some form of financial return. So those are just some of the hot buttons for me when I'm meeting with a potential issuer.
That's excellent. John, how do you work with founders when they come to you and say, we're looking to raise capital? How do you help them from the broker-dealer side say, okay, Reg CF's right for you, Reg A or Reg D? Or are you letting them tell you?
No, well, I've yet to meet an issuer that knows all the pros and cons of all the exemptions. So we actually have a process that we do a workshop for free, and we kind of walk them through a structured kind of session that teaches them about the pros and cons of the different exemptions and the rules and all that stuff. Number two, we pride ourselves on this because when I was running a company for 17 years, and Devin might not like to hear this because he uses the word, but we were introduced as gatekeepers. Man, I hate that word. I hate running into gatekeepers, right? So we don't want to be a gatekeeper. So what we do is we say, here's our process. We don't care what your background is or what your story is, but if you're willing to meet this standard, we'll work with you, and we want to let the crowd and the public decide who the winners and losers are. So, that's kind of our approach: education up front, laying out our process. We try to make it as cheap as possible, and say, all right, if you're willing to meet this standard that we have, then welcome aboard. So that's our philosophy and our process.
That's great. Levy, you kind of operate a little bit differently than a lot of crowdfunding portals out there. How do you balance that expanding access for founders and hosting maybe another raise that's not a Reg CF with maintaining the strong compliance and quality standards that you need to?
That's a top priority, right? The compliance. So that we're never ever going to compromise on that. And we're never going to compromise on the integrity. So usually, we've had situations where people have come to us and they've wanted to raise. But once we describe to them, the level of integrity that we require, sometimes there's not a second meeting. They realize they shouldn't. We're not the right platform for them if they're doing funny stuff. So it's really, really important. So and we're very, very upfront. So for example, there was one issuer which came to us, and we weren't sure exactly whether they were perhaps an investment company or not. And this is an example where Reg D might be very, very good, because if you're doing something which might look like an investment company, you can't now. So syndicators, for example, some types of real estate syndicators and other types, they can't raise money through Reg CF, so they need a Reg D. And sometimes, they'll need a broker dealer as well. Sometimes it's not just a platform. So, what John does is very valuable for people who might need that as well. So integrity is absolutely key in making sure that we have the compliance. But that said, we do not judge the company and how good the business idea is. That's not our business. Our business is to make sure that there's no fraud going on. That these are people who qualify to be able to raise money from the public. As far as the business plan is concerned, as long as there's some kind of business plan there, that's for the investor to judge whether it's something which makes sense and is going to make them more money or not. So we really don't have a view. We're not picking winners, as someone else mentioned. It's not our business to pick winners, so we're not gatekeepers at all. We're just there. If you've got an idea and you believe in it enough, and you think that this piece of real estate or this business or this startup idea is going to work, now it's up to you to find your investors, like was mentioned. Find out who the customer is who would like this idea and would like to invest in this thing. And if you know where that segment of the market is, go after them and convince them and raise the money. I can't know about every single area of business, whether it's good or not, and I don't claim to. We're not VCs, we're not investors. We're there to help facilitate people with businesses and business ideas to raise money from their public
in a compliant manner.
In a compliant manner.
Yeah.
So, Levi, staying with you for a second, what's one of the toughest decisions you've had to make as a leader, and what'd you learn from it?
As a leader in crowdfunding? Is the question, or a leader in general? Because I've
only
sorry,
as a portal leader.
As a portal leader. I think I think being a funding portal is hard. It's a hard business, and every day I wake up making that hard decision to continue doing it. So and because anyone, I think those of us who run funding portals really understand that it's not like other kinds of businesses which are slam dunk. We're in many ways we're serving the investor and issuer community, and we're doing whatever we can to grow this nascent industry. And I fully believe in it, and I believe that the future of it is bright, and it's going to be brighter and brighter. But sometimes it's actually difficult because it's a challenging space. I think John mentioned the size of Reg CFs, the average size. There's not a huge amount for a portal. There's not a huge amount of meat on the bones there necessarily. So I think that but as leaders in this industry, it's really important for us to continue day after day, putting one step in front of the other and providing this service to the issuers and to investors.
Yeah, Jackie, having started a portal, run a portal, now partnered with a different portal, what do you think people outside our side of the world don't realize, but they should? And what should they know about the difficulties in running and managing a portal?
Well, as Levi was saying, we're running a regulated entity, and there's a lot of work. We're not a broker dealer, which has another level of compliance and opportunity. We are in a very small box in what we can do, which caps our ability to actually earn, right? Which, number one, that makes the business hard. But at the same time, we do have, we are overseen by the SEC. We're a member of FINRA. We get exams. We have to meet various criteria. And we are primarily working with retail investors. Broker dealer many times is dealing with, and when I say retail, I mean, non-accredited investors, which, by the way, from an SEC perspective, those are the folks that they want to protect the most. So we do have a big responsibility to make sure as a funding portal that we are doing everything in our power to ensure everything that goes through our platform is compliant, and that we keep in-house all the books and records, et cetera, so that when the regulators come in, and they do come in often, to check in, see what's happening, inquire, that we can produce all that information. That's a very heavy lift to run as a portal while you're talking to issuers, while you're developing your investor base, et cetera, when there are very thin, opportunities and actually to earn revenue. So I think it's, I think it is as Levi was saying, and John as well, that, look, I'm a big believer in Reg CF. This is the avenue to unplug from traditional ways of raising capital. It is an amazing opportunity. Just take a look at, the number of women or BIPOC-led organizations that raised capital. I think according to King's Crowd in the first half of 2025, or it was through 2024, one of those numbers, it was 25% of the money. If you just think about, in the VC world, and let's face it, equity crowdfunding is still the largest sector in crowdfunding. Debt crowdfunding is a very small portion of this. And equity is, this is where the VC world will tend to be, right? It's less than 5% that will go to either of these types of groups. This is an important tool. It is giving people hope and opportunity on both sides, both from the investor side as well as the issuer side, to bust through and actually make things happen. So as hard as the day can be in a crowdfunding portal, I am a huge believer. And as you said, Levy, you wake up every day and go, because you got to believe in it. In the same way an issuer has to want to do crowdfunding, we have to, you have to believe in this as important for its impact. And so that is something that, everybody who's running a crowdfunding portal believes in, and folks should know that.
Yeah, I think you're absolutely right on that. From the regulatory standpoint, the compliance standpoint, John, you've been on the portal side and you've been on the broker dealer side now. If you could make one regulatory change tomorrow to meaningfully help founders and investors in Reg CF, what do you think it would be?
I knew you.
And maybe more than one.
Yeah. Well, you sent me that question, and I have an answer, but it doesn't have anything to do with the regulations. We just made it through a surprise 2-day in-office FINRA audit, and people complain about the regulations. I'm in the minority that actually I appreciate them. They make us a better company, and I think the regulations are important. So I actually don't. Nobody likes to be regulated, but it is what it is, and it's there for a reason, and it makes us better. That's the way I look at it. I'll tell you what the number one problem is, and this is like a nail on the chalkboard kind of thing, and I'm dating myself with that analogy, is the financial advising community. We are like enemy number one to the financial advising community, and I know that's a very controversial thing to say, but there's a reason why the median raise has been 113,000. We tend to do larger raises, relatively speaking, more than that, right? But if you can raise up to $5 million, let's just say you're using Reg CF to raise $5 million, you're going to have to get bigger check sizes than $50. And when you start, and I've experienced this firsthand, if you start raising the minimum investment levels, and the average non-accredited investor with a financial advisor goes, "Oh, I've heard this a dozen times, and I know it's a death knell with this investor." When they say, "I'll call you back, I'm going to talk about this with my financial advisor," never comes back.
Yeah.
And I think that's the industry challenge, is if we're going to bust up into higher raise amounts and stuff, we have to get financial advisors to factor this into their strategy.
That's actually a great point there, and I've seen that as well, that the financial advisors either don't understand it or they want to control what's going to happen with the client's funds because they think they're better, lack of better word, gatekeepers from there.
And they don't get paid.
Maybe. Right, exactly.
Can I just...
Maybe. Go ahead, Jackie.
Yeah, sorry to jump in. I just really wanted to second something, John, that you said. And I want to be clear. I wasn't indicating regulations are bad. I'm indicating there is a big lift to do this, and it's not easy, and it's serious, and it takes a lot of effort on the part of the crowdfunding portal. And so therefore issuers have to understand that when we're asking certain questions or requiring certain things, one, we have to, and two, it's for them as well. And the investor, it's for the integrity of the entire ecosystem. I am a huge believer in regulations. In fact, because I've been in the broker-dealer community for 25 years, and now 5 years in crowdfunding. My last role was at Goldman Sachs, and I actually for almost a decade, I actually took a compliance function there, even though I'm a business person by training. So without the regulations, we wouldn't have good capital markets. We couldn't do what we do. We couldn't be the United States. I mean, that is why we have functioning markets, because we do have regulation. Yes, we shouldn't be overregulated. That can be a problem. And so there needs to be a healthy balance. Otherwise, we're not going to have the movement of capital. So we're always kind of going back and forth, based on what who's in the office, and which way they lean. But healthy regulations, that's what keeps us all going on both sides. So sorry, I just wanted to jump in.
I want to answer that question, by the way, about the regulation. I think it's really, with any regulators, and I want them to hear this. Okay, and there's one thing which I think really needs to change. There's some of the advertising rules around for Reg CF are stricter for some reason than anything else. Because of that, it causes it becomes really challenging to be able to look. It's online. People need to know how to be able to advertise it properly, not misleading in any kind of way, not promissory, but you need to be able to say more than that. People who know what it's talking about, that tombstone advertisement, right? So that needs to change. I don't know how this got into the laws, but the way in which we can, issuers can actually advertise about their offerings needs to change. That is really, really important. The other thing is,
I think that is one of the focuses that FINRA is making with their FINRA Forward efforts from there. I've had conversations with FINRA and with some of their leadership, and that's one of the things that they recognize as well, that there's ambiguity there. There's not anything that's really carved out that makes it easy for the portal, for the investor to understand, and for the issuer to be able to use from that side of it. So hopefully, that's the direction that we're going to see. We're going to be running out of time soon, but I'd love to hear in one sentence from each of you, how do you hope your platform's role in Reg CF will be remembered 10 years from now? And where will we be in 5 years even as we're moving forward? Jackie?
Is the first question 10 years from now, or which?
Yeah, how do you think you'll be remembered in 10 years, and what do you think 5 years is going to look like, halfway point from where you are?
The original vision of Raise Green was to make it possible for everyday Americans, and in particularly for folks in their own community, to literally own the clean energy transition. In a perfect world, you can imagine the school teacher teaching in the school, right? Benefits from clean energy on the roof. Oh, and the community also owns it. And it's a complete recycling of all the money, and it doesn't go out of the community. That is and that we were able to start that movement. And it has grown. That would be a dream to me.
John, where do you see the industry in 10 years, and where do you see yourself in 5 years?
Dorian, I apologize. Our time is up here.
Okay.
I apologize. I'm interrupting your flow, but you guys have been fabulous, absolutely fabulous. I can't thank you enough. Dorian, you were so well prepared, so well organized. I keep getting little messages from folks telling me that this was an especially valuable discussion. I'm really, truly grateful. Thank you for really delivering in spades, all of you. It's just been fantastic. A great follow-on to the discussion with Johnny. So thank you very, very much. We are going to take a quick break now. Again, we've got to pay a little homage to our sponsors. They make this event possible. They make the work that we do possible. I can't thank them enough. Our Max Impact sponsor is Proactive Realty Group, and they've got a crowdfunding offering right now going at 4scfund.com/rancho, and I encourage you to check it out. It's well worth consideration. We'll be right back.
You're watching SuperCrowd25, the biggest event in impact crowdfunding. Over 2 days, top experts, investors, and mission-driven founders are sharing how to raise capital, discover profitable investment opportunities, and change the world. Stick around. You'll hear stories, strategies, and insights you won't find anywhere else. And if you want to go deeper, join our VIP community for just $25. Get backstage access, exclusive networking, speaker handouts, and a special VIP-only webinar. SuperCrowd25, crowdfunding the future. Impact starts here.
The property was dilapidated. It was horrible. It was code violations, drugs, crime, rundown RV trailers, no parking lot, no lights at night, just nothing. Our main focus is second chance housing. A lot of affordable housing households are led by single mothers. Our portfolio is 100% affordable. So our mandate is to be 20 to 30% below market rent. I'm personally $180,000 invested. We're only one of two companies globally to have a published social impact report for affordable housing on a Morningstar platform.
What's the faster way to build wealth? A traditional savings account at 0.38%, or worthy property bonds earning nearly 20 times more? Earn a fixed 7% APY starting with just $10, access your money anytime with no fees, all backed by real estate. Visit worthypropertybonds.com today.
The African diaspora is one of the biggest investors in the continent, but they are looking for a structured, transparent way of supporting this business. This is not donation. This is investment for return, including impact, and join our movement community. Thank you.
Behind today's biggest crowdfunding raises.
The leading CPA firm for Reg CF, Reg A, and Reg D compliance.
Trusted.
Experienced.
Set apart.
Join the CFPA for the Regulated Investment Crowdfunding Summit on October 21st and 22nd.
Register at ricsummit.org.
Rural property taxes fund vital services.
Only when they're paid.
Invest in real impact.
Visit invest.coretaxdeeds.com today.
None of these are working.
Let me guess. I'll bet you want to exit or diversify.
Thank you.
You're welcome.
ISPD strengthens health for families across Haiti.
Donate today. Make an impact.
Hello, everyone. I'm Gene Massey with Media Shares, and I'm very excited to be speaking at SuperCrowd25.
Save the date for Super Green Live, the global event on sustainability and green innovation, January 22nd through 24th, 2026. We extend our deep appreciation to our supporting sponsors and co-hosts, including Potomac Growth, Energy Capital Funding Group, Move the Needle with Rob Kaplan, Ridgecrest Herbal, Stakeholder Enterprise, Renaissance League, the Global Equity Crowdfunding Alliance, the National Coalition for Community Capital, Green to Gold, and King's Crowd.
Enter to win one of 2 FireMax 11 tablets. Videos, books, and games come to life. Scan the QR code now.
Rules apply.
Welcome back, everyone. I'm so excited. I have this great opportunity right now to visit again with my friend and colleague, Brian Christie. Brian is just a great human being. He was on the program a little bit earlier. I've invited him back because as vital as the Crowdfunding Professional Association is, all of the people involved are volunteers. And Brian is the co-chair with me of the Crowdfunding Professional Association. Jenny Casson, who's been on the program, is the president this year. A bunch of the board members have been participating in the program, but again, as volunteers, they have been focused on their day jobs. And I wanted to pull Brian in to have a conversation about the Crowdfunding Professional Association. Brian, thank you very much for joining me for this. I think this is an important little part of what we need to talk about today. When we talk about impact crowdfunding, and I think you share my passion for that, it requires a healthy, robust ecosystem for crowdfunding. And the Crowdfunding Professional Association is leading that effort. Tell us about what the Crowdfunding Professional Association is, how it works, and how it helps. Give us an overview to start the conversation.
Sure. Thank you, Devin. And again, thank you for organizing this event that I mentioned earlier, that it's a tremendous amount of work goes on behind the scenes. People may or may not know that. And we are all beneficiaries. The community is a big beneficiary of what you're doing here with SuperCrowd. And by bringing all these minds together to look at impact crowdfunding. So CFPA, the Crowdfunding Professional Association, has been around really since inception of crowdfunding. Our current mandate really falls into three buckets. One is to educate, one is to advance, and one is to advocate on behalf of the industry. Now, it is made up of really a range of stakeholders. So everyone from funding portals to accountants to lawyers to consultants to advisors to just everyone who has an interest. We have academics, but anyone has an interest in advancing the field or participating. And it's we call it the Crowdfunding Professional Association, but it's people who are active in the industry or aspirationally want to be involved in the industry. And so the association is I'll do a plug here, shameless plug here. It's very accessible to join. It's $10 a month for an individual, and if you are a part of a company, you can participate. You can be a corporate member for just under $50 a month. And so, but we have a range of activities that we do on behalf of the association. Association has very much committees that operate in different areas. And it's the committee structure where a lot of the work that gets done. Again, all volunteers, as you mentioned, Devin. It's also a lot of volunteer input from the members of the broader community as well. So participants in the industry. But we have, for example, and I'll just name a few of them. We have a policy committee that meets regularly, and this policy committee has brought together an 18-point, or maybe 19-point now, but an 18-point sort of policy platform. This took several years in the making to go over. It was a consensus-driven process. And at the end of that, we came up with policy so that we are using to make recommendations for the industry, to the regulators, to lawmakers on how we think we can better advance the industry. We have another committee that's been focused on tax reform and looking at ways we could use incentives for investors, retail investors, to get involved in government incentives to get them involved through tax credits to get people more involved in trying their hand at crowdfunding. And then we have a conference committee that and we can talk a little bit about that later, really that meets to put together this industry summit that we've had. Last year was sort of the first post-COVID time that the group got to meet, and again, doing again this year in October.
You know, it's a fascinating work that we're doing, you know, and at the CFPA. And one of the things that I think it was you that kind of surfaced this, but there's a controversial little thing that came up recently. I say little, it's an interesting innovation. And I think that there's this clear trend we're seeing. The future of securities and the future of crypto seem to be headed toward an intersection, a tight intersection that they will become perhaps fully interwoven over the next decade.
Right.
One of the early manifestations of that is the mirror tokens that Republic is offering. And the CFPA pondered this at your suggestion. Tell us about how that process worked, what happened, and what was the outcome when the CFPA saw this new implementation of it, kind of a creative approach to Reg CF.
So yeah, it's a good example of clearly things are happening in the industry that we're all watching carefully because it impacts everyone who's a participant in the industry, and the sort of, I wouldn't say call it the encroaching, but the march of crypto has become very obvious. They've raised over $100 million as an industry just to lobby, and so you've seen a lot of clarity that they would like around rules that are related to capital formation as it relates to their industry. And there's lots of offshoots of how that's impacting. And there, as an exemption that exists, we've been advocates for saying to the extent that something is deemed a security, then the rules for Reg CF or Reg A ought to apply. Now, that definition of security is sort of still being worked through with the regulators, and so there's clearly a tremendous amount of energy and potential interest that's driving that now. And there's a lot of innovation that's taking place now. People are on different sides of innovation. I probably was more of a true believer early on than maybe now, personally, because I think that really it's really a technology. But one of the things that came up, of course, was this concept of mirror tokens. Now, it's existed in the crypto world, but Republic was the first one that wanted to bring this into Reg CF. Now, as we talked about it at our policy committee meetings and have had several other discussions here within the organization, we really looking at the essence of where we felt the exemptions for Reg CF apply. And one of the key sort of features of Reg CF, it's really used for capital formation. That was the intent of the Jobs Act. That has been true to all the companies that wanted to participate, true to the ecosystem of providers that's building around it. And so capital formation is really quite critical. And we really came down on the fact that in that world for that concept of capital formation, mirror tokens don't really meet the test, in the sense that mirror token, for those who are not familiar with, it's basically it's an investment into the performance of a company that's not available on the market today. So SpaceX is a good example. You can't invest in SpaceX as part of the crowd, or just people don't have access to that unless they're part of the small group that's already invested into it. So the concept is, hey, we want to make this as an investment available to the crowd. I think that was their intent, and I think that's not a bad to try and bring people into the fold there. But this isn't that, in the sense that an investment into a mirror token, not one penny goes to the actual company on which it's based. You're basically betting on the performance of that potential company. I think that's one really big issue. Second is that for many retail investors, they don't realize that there's a lot of counterparty risk. The platform on which they are making that investment, that platform has to exist. So it's not just the company that's being mirrored, it's actually the platform. So you could have every Reg CF platform out there could be offering mirror tokens based on SpaceX. And really the difference would be the risks associated with that platform. This is going to be really confusing and hard for retail investors to understand. The language, the way it's being pitched, it sounds like someone's getting direct access, even though there are some caveats to the way that they've claimed that. So I think that we will have as an industry, a big mess to clean up down the road if these things really got lifted under the exemption of Reg CF. Now, again, mirror tokens exist in different ways in the world of crypto already. There's no reason this to be a part of the exemption in Reg CF. So as an association, we talked it through. We had people who felt pretty heated on both sides of the issue in terms of, yeah, it should be a good thing, others not. But in the end, the consensus was built around, there are some problems with that sort of being something that we wouldn't really want to encourage under Reg CF. And so the association put out a statement of opposition really against mirror tokens, and that's out there, and one that we're happy to talk with anybody who has perspective on it, with regulators, others, in terms of where we stand on that. You can go to the crowdfundingecosystem.com, which is the CFPA's community site, to learn about that. You can go to the CFPA website. I think it's been picked up on Crowdfund Insider and some other places as well. So yeah, it's a good example of something that and there are other things coming down the pike too. The whole 401k executive order that came through is something else that we're paying attention to and figuring out how it's going to work with crowdfunding as well.
Yeah, there is a lot going on right now, and the CFPA is serving as kind of the industry voice for this, and so I appreciate the opportunity to participate. One of the things that is happening is that we've got the summit, the Regulated Investment Crowdfunding Summit, coming up October 21st and 22nd. Am I remembering right?
That's correct.
And on the 21st, we're organizing people who attend the conference to go visit with regulators, legislators on the Hill. Tell us a little bit about how that's coming together, what that looks like.
Yeah, so we're building off of our summit from last year. As you mentioned, it'll be in Washington, D.C., October 21st and 22nd. Great time to be in D.C. The leaves are changing colors. It's a nice time of year to be in D.C. But really, there's so much happening on the Hill, so much happening with lawmakers, so much happening, and the regulators have been handed an awful lot on their plate as a result of this new administration. So we're there to meet with them, to voice our opinion, to basically advance the interests of the industry. And as a really authoritative source, the regulators are listening to us. So on the 21st, there will be a series of meetings that are taking place. They're being organized now. The Hill will be back in session at that point. And then on 22nd, we have Conference Day, which is a lineup of what you're doing virtually, we're doing in person. And so it'll be a bunch of fabulous speakers who will be there to talk about different issues. We have a couple regulators that have agreed to attend. So James Murphy from FINRA will be there to speak. Commissioner Hester Peirce from the SEC will be there to speak. We have other invitations outstanding as well. So we'll have regulators there. We'll have potential lawmakers or their staff there as well. If not, we'll be meeting them again the day before. But it's a great event. It's a chance for people in the industry to come together, the industry insiders to come together and to really share experiences, best practices, talk about the future. It is not something where we're focused on any pitch events. It's not really something that we're focusing on bringing in potential issuers. There will be issuers who are there to talk about their sort of case studies, but it is really focused on as an industry event. And so we encourage people to sign up. You can go to the crowdfundingecosystem.com or cfpa.org to get links to the sign up page for it. And there will be limited space. So I think it's important if people are interested to get registered as a participant now.
Yeah, it really is going to be a fabulous event. Last year was just absolutely tremendous, and it's shaping up to be even better this year. I'm excited for it. And Brian, you have been such a leader in this space. I thank you and credit you for really making this work. As you think about the policy making process at CFPA, obviously we don't set policy, we recommend policies, but we have seen evidence that the regulators are listening to us. Board members of the CFPA have not been infrequent guests in formal hearings with the regulators and even on Capitol Hill. So what are some of the elements of the policy statement? I think back to you led particularly the effort on the tax credit. Maybe you could talk a little bit about that and the rest of the context, some of those other policies that we've been advocating for.
Yeah, I'll maybe focus a little bit on tax because, again, it's an 18-point platform. We have a big team of people that are all working to advocate. I have heard the regulators say that they've heard what we're advocating for and that we may be able to see something. Of course, they can't go on record. They have to run a process themselves. But on the tax specifically, one of the things that we have wanted to advocate for as an association is to give a tax credit to investors who put money into a company that's being funded via Reg CF. And so and this wouldn't be an unlimited amount of tax credit. It would be up to $1,000 of credit for an investment of $2,000 for any individual investor into a Reg CF company. And it would be twice that for for a married couple or couple filing jointly. So the idea is that the majority of the companies who are raising money through Reg CF are small businesses, and they put that money to work directly to the economy. So if you get a tax break to a large corporation, 40% of their shareholders are foreign companies or are foreign investors. They do tax dividends, they do dividend payouts that don't necessarily work its way into R&D or work its way into hiring more. It doesn't necessarily work its way into sort of more jobs. We don't not seeing that connection made when benefits are given to large corporations. But when you give it to small companies, the impact and ripple effect from that those dollars spent, which go directly to hiring, goes directly to paying vendors, to really building their companies, and often in local communities, you can see as much as a 6 or 7 times impact of that single dollar spent to $6 or $7 of economic activity. So we believe, in having done research, that a tax dollar credit setup would actually pay for itself just by the amount of economic activity it would generate, and that would be through dynamic scoring. And so we've kicked the model around a bit, and so we think it's actually a net gain to the Treasury if there's would be some sort of tax credit to consumers, to investors who use Reg CF. Now, we've also expect that type of tax credit we've described will create millions of jobs, not just tens of thousands or hundreds. It can create millions of jobs, and so we've advocated for that. We have reached out to people on the Hill, had some discussions with them. We weren't able to get it into this past year's tax bill that was passed last month, but we do hope that it's something that someone will pick up in the future. Especially if there's a need for any economic stimulus, it's a shoe-in, something they could go to right away. So we are continuing to educate folks on the Hill that this is something that's out there and possible, and we'd like folks to pick it up.
Well, Brian, thanks for joining me for this conversation and for all the work you do at the Crowdfunding Professional Association. You've been in leadership for a decade or so, and I appreciate all the sacrifices you've made at the work that you do, and you have been tremendously effective as a leader, and I'm grateful for that leadership, and want to wish you continued success in all that you do. I invite you to pop back in. I think you've been in there earlier today. Pop back into that backstage area. I'm sure there are people who, after this little controversial policy discussion, now want to talk to you.
Sure. Happy to.
And I'm glad they'll be talking to you, not me, because I'll be over here. But I encourage you to take a few minutes in there. And folks, if you have not signed up as a VIP, it's not too late. You can sign up, pop into the backstage area. You'll get the instructions for how to do that automatically. You pop in, talk to Brian, and you can engage the rest of the day. You can get the VIP LinkedIn group. You can get the VIP webinar tonight. You can get the speaker handouts and the flyers, and you can get. There is so much value still to capture with a VIP purchase right now, this minute. I encourage you to do it. Brian, thank you very much.
Okay, I'll go over there.
I am really excited now to introduce one of the true rock stars of SuperCrowd25. Ron Miller is the chairman of Start Engine, the co-founder. I think among crowdfunding sites, arguably the only unicorn company is Start Engine in that mix, and doing phenomenally well, helping to lead this industry. And Ron spoke at SuperCrowd LA, but he spoke only in the VIP session. And in the VIP session, there was no recording. There was no live stream. It was just a few dozen people. But I tell you, the praise, the enthusiasm, the excitement after Ron spoke was just unparalleled, unrivaled. People were so excited. I was thrilled when I asked Ron if he would be willing to come back and and share some of those ideas with us at SuperCrowd25 that he was willing. And so Ron, thank you so much for being here. We're just thrilled to have you and look forward to learning from you today. I mean, good golly, what we learned at SuperCrowd LA was mind blowing. So thank you.
Great. Well, thank you for so many kind words, Devin, and for the kind introduction. And I think I would be remiss if I didn't, like you did, Devin, also acknowledge Brian Christie and the entire team at CFPA who just worked tirelessly. Let me just drop this down. Who just worked tirelessly on behalf of the entire industry to do the right thing, to make sure that our interests are protected as there's so many dynamic changes that are taking place. So I just wanted to at least start with the acknowledgement there. Well, terrific. Well, thank you. It's also always an honor to participate in SuperCrowd. This is one of the preeminent industry conferences, and so it's really great to be a part of it and to be an invited speaker. So thank you for that honor, Devin, and appreciate your entire team for putting together such an unbelievably great event. Well, today, what I wanted to share with you is similar to what I shared at SuperCrowd LA, which is really just to give you the high level of what the advantages and disadvantages are of equity or investment crowdfunding. And the reason that I do that is that I often like to, as I speak to various prospects, people that are interested or exploring this idea of investment crowdfunding, I like to first give them context before going on a deep dive of the detail of what's involved in regulatory compliance, disclosures, budgets, and so forth. I like to try to just at least give them a high level to see, well, first of all, just to make sure that they're aligned with the understanding of what investment crowdfunding is all about. And secondly, to make sure they're the right person and the right temperament and that is seeing this opportunity in the right way. So I always start first with the disadvantages because, I guess being from the marketing department, as I sometimes say, I always think that it's a good idea to start with the disadvantages so you can end with the advantages. And so the first thing that I talk about in terms of disadvantages is I tell them, look, honestly, the raising capital under Reg CF or Reg A plus is going to require significant disclosure. And so what that means is that you're going to have to accept the fact that in doing so, you're going to be disclosing your financials, your plans, your essentially the inside of your business to your employees, to your competitors, to your vendors, and of course your customers. And I think that's a consideration that needs to be, I guess, accepted by the prospective issuer at the outset. Because if you can't get through that one, frankly, as most everyone knows that's probably participating in this conference, those are non-negotiables. Those are regulatorily required and cannot be negotiated by an individual platform or an individual issuer. So that disclosure thing is the first hurdle that needs to be overcome. And sometimes they have questions there. I usually stop and ask and to make sure that they really do understand and take to heart that raising capital in this way is going to require some publication of the critical aspects of their business in lieu of what you would raise if you were raising a friends and family round or even a venture capital. Or even a big angel that comes in and invests does not require public disclosure. So I let them know that. Second, I tell them this straight up. If someone is knocking on your door and has a check for you for $1 million or whatever your target investment amount is, I think you should consider seriously taking it. And the reason I say that is because the reality of investment crowdfunding is it takes a lot of work. Not a small amount of work, a lot of work. And unless the company, the issuer, is prepared to really make this issue of raising capital a priority, then it's probably not a good fit. Now, I do share with them that no matter how you raise capital, it's going to take a lot of work. It requires decks, conversations, follow-ups, meetings, sometimes travel. There is a lot of work involved by the founder or founding team and CFO. But at the same time, investment crowdfunding is going to take an extraordinary amount of work. And I like to let them know that up front so that later on, it doesn't come as a surprise to them when they realize that indeed this is a really onerous, an onerous burden. I like to just tell them that right up front, and then I stop and pause and I listen for a while and see whether or not they understand that that's what it's going to take. So those are, I think, the two primary disadvantages I like to discuss. Then I shift immediately over to the advantages. And first and foremost, what I tell them is probably the single most unique thing about investment crowdfunding is that it allows the issuer to set the terms. In almost all cases, whoever has the money is normally setting the terms, or at least a significant, has lots of leverage in the negotiation process over what those terms are going to be. Here, however, a issuer gets to determine the value of the company, how many shares they want to sell, what kind of shares they want to sell, and importantly, they get to, should they choose to, leave out those onerous control hooks that we all know have often defeased founders as they have gone down the path of raising institutional capital or sophisticated angel capital, and then later lost the company because they were unable to meet the terms required under the deal. Now, I usually throw in a joke right around now about, well, if you find any founders who, after having taken in venture capital and then exited, if you ever find one that says, that was the greatest thing that I've ever done, I say, please let me know, because I'd love to talk to them. Usually it's few and far between, and most founders, after they take on a sophisticated single investor like a VC or a big angel, usually they find, those founders find, that there were a lot of representations made about the assistance, the non-monetary benefits they'll get, that oftentimes do not come to bear. And so they're disappointed in that way. And second, they often hit the reality that the interests of the founders often are not aligned with the interest of the investors. Investors, after all, have to invest money and get extraordinary or outsized returns, primarily because they lose on so many deals that they need to make that up somehow. And oftentimes it's often the winners that end up in quite onerous situations. So I tend to, make sure that they're aware of that, and that they understand the control hooks that could include the entrepreneur or founder losing complete control of their company, sometimes being dismissed from their employment, and sometimes finding their shares diluted if indeed they don't meet the requirements or either the requirements of the deal or the representations that were made in the capital raising process. So a huge advantage of investment crowdfunding is that it allows the founders to set the terms, because after all, the future is extraordinarily difficult to predict. And frankly, I think Start Engine might be my 6th startup. What I've learned is that I think every single time I always project that revenue will grow faster in a shorter period of time than I originally anticipated. And of course, when the reality sets in that it actually takes longer, it's not unusual. But yet, those are the kinds of things that can defease a founder from control their business. Another huge advantage I talk about is what I call an army of brand ambassadors. And what that's all about is that once people raise capital with investment crowdfunding, and let's say you were to get 1,000 investors, while I highly doubt that 1,000 of them will become an ambassador in the way a founder would like them to, something like, I would guess, somewhere between 20 and 35% of the people that invested would be willing to pass messaging along to their contacts that are in their phones. And I think I saw a study saying the average person has something like 1,000 people in their phones. So if you can think, if you raise, from 1,000 people, if you got 200 of them, you could then have theoretically an audience of 20,000 people that you could push messages to at a cost of zero. And importantly, as traditional advertising becomes less persuasive and peer-to-peer and word of mouth becomes more impactful, that army of brand ambassadors becomes incredibly more effective. In fact, one of the entrepreneurs that I worked with actually had a brewery, and he took his brand ambassadors, the people that had invested, he gave them t-shirts and he sent them out to the local bars. And it was actually, it was a gin distillery. And they went out to the local bars and they went bar to bar and they were asking for his brand of gin. And when they didn't have it, they pushed the bartenders to order it on their next round, so that it then provides the context and reason why that customer base would begin to expand. And of course, they can grow sales simultaneously at a fairly low cost. So those are the disadvantages and advantages. Now, where I go from there is I start then talking about what it takes to succeed. And I want to mention, by the way, these disadvantages and advantages and what it takes to succeed are equally relevant, whether it's impact or whether it's traditional for-profit companies that are raising capital. These exact principles apply in either case. So what does it take to succeed? Well, first is there has to be an understanding that raising capital becomes the single most important priority for that company during the time of the raise. Now, if you think I'm a genius, I'm not. I just learned this the hard way when it was in the early days of investment crowdfunding, and I brought on a client. I loved him, I loved his company, but he launched his raise, and about 5 days after the launch, suddenly I couldn't get a hold of him. And I'm calling and emailing and texting, and I'm not getting any reply. And about a week later, the guy resurfaces, and I said, Chad, what happened? And he said to me, well, I went off the grid for the week because I had planned a family trip or whatever it was that he was doing, but he went on a camping trip, basically, and went off the grid. And I said, you have to understand, when you're doing this, this has to be the priority. And if you need to go off the grid, bless your heart, I'm not trying to tell anybody what their life priorities ought to be, but I can tell you that when you're raising capital with investment crowdfunding, the number one priority is not further product development. It is not tending to family issues. It is not dealing with personnel problems. It's not calling on customers. What it is raising capital. Now, having over 40 years of entrepreneurial experience behind me, what I can tell you is if you have money, you can solve problems. If you don't have money, you can't solve problems and you end up in a lot of trouble. So that's why I think it's justified that when somebody agrees to enter into an investment crowdfunding plan, that they actually prioritize it and make those other things secondary. So having an understanding that this is a top priority, that's foundational. Second, it requires a plan. This is the one where I see most people trip up. I think often it's kind of where you see the difference between what I would call a real entrepreneur and somebody who wants to be an entrepreneur. A real entrepreneur has a plan. A plan is something that describes specifically who is responsible for what by when. And the what, of course, includes the defined outcomes that are expected to be achieved. That is a critical element of any investment crowdfunding campaign. And unfortunately, it does take a lot of coaching and handholding to get issuers to develop those. They often don't show up with them at the outset. So in addition to a clear understanding and a plan, clear understanding of the priority and a plan of how we're going to do this, there also has to be a budget. There has to be an understanding that when you go to raise capital from the crowd, it's going to require some upfront investment, whether it's paid media, social media, even if it's earned media. The process of what it takes to get earned media still costs money. And so there has to be a budget allocated to this. And there can be a budget that's pre-raise and then also during the raise, because as I'm sure most people that are in the industry know, that once you begin raising capital and your first 100,000 is in, you can break escrow and use a portion of that to reinvest to continue to grow your investment crowdfunding campaign. But it does require a budget. The next thing is it requires a team. It takes more than one person. Clearly, the main person has to be the founder or CEO, has to be committed. There's nobody more effective than in raising capital than the founder or the CEO. Or should be anyway, is probably the best way to say that. But there has to be a team that's committed to execution. And then finally, as I mentioned earlier, the CEO or the founder has to be committed. Now, what's happening there is that I'm laying out in some detail what it's going to take, what an issuer is going to have to do to raise capital. What that does is break the very common misconception of what I call build it and they will come. To the extent there's other platform operators that are participating in this session. I think you guys all know what I'm talking about, but that's where people come in and they believe. So Start Engine, just by the way, has about 2.3 million people in our registered community. That's what our messages reach. Of that 2.3 million, something like 700,000 or 800,000, I believe, are actual investors. And so what they think is, if they believe that their product that they've developed is so great that all they have to do is hang it on our platform and people will come and run it with their checkbooks wide open and start investing. And in some sense, I can't blame them for that belief, but it's truly a misconception that tells me right here, right now, that if we spend more than 10 more minutes on this thing, it's going to fail. We're just wasting time. And it's wasting the issuer's time as much as it is wasting the platform's time. Because, the platform's going to be fine in many cases. As I mentioned earlier, the availability of capital is critical to the long-term success of these companies. And because of that, they could be under threat if they don't raise the capital. And if they're thinking that all they have to do is post it on the platform and they will come, well, I know it doesn't work that way. And if they expected that and don't get that outcome, then it puts their company at risk because they weren't pursuing other options that they may have for raising capital through alternative means. So I think that in and of itself is super important. Now, while I'm at it, so I think that it's important that we are now past the 10-year mark of this industry, or just about to be. And as we do that, I think collectively, as industry participants, we should be thinking about ensuring our long-term success. And clearly there's a few things that are troubling that we at Start Engine are doing everything we can to mitigate or eliminate. First is compliance. And there's two components of that. One is the upfront compliance, and second is the post-close compliance. What we're seeing, unfortunately, is a pretty significant level across the industry of issuers who do raise capital successfully, but then forget their compliance obligations later. And that, unfortunately, creates a black mark on the entire industry. So what I'm asking as an industry participant is that we all collectively share the responsibility of doing the very best we can to set expectations with those issuers at the outset of what compliance means, and importantly, following up with them afterwards to remind them of their responsibility and asking for their compliance. I think that is absolutely critical. The second one is in the area of valuation. I think that many of the raises that we see across platforms have valuations that cannot be what I call reasonably justified in some sense by some analysis. And although I don't agree that a platform has to be responsible for proving valuation, because after all, I think it's difficult to prove no matter who tries. But certainly as a platform, we're in no position to value a company that's in the retail business or restaurant business, whatever business, transportation industry. We don't know what those values are, and we're not compensated in the same way that a traditional broker dealer would be in order to establish that valuation. But at the same time, we also have common sense. And this is what I'm asking for industry collaboration and cooperation on, is that we all band together and utilizing our best common sense know when somebody is being overly aggressive with regard to their valuation, their terms, or other issues where we see, I guess, troubling facts or evidence that are in an issuer's offering that we know just from common sense should not really be in front of our community. We take great care for that. It's not to say that we're perfect. I don't think any platform is perfect, but I can say that I do think it's super important that we all collectively share that responsibility for reasonable valuation and reasonable compliance efforts. We've all seen there have been a couple of very highly publicized and very unfortunate circumstances where a few people have raised capital that frankly weren't doing so in a way that met the compliance standards. And, you know, in the broader context as an industry, I think it's important that we continue on our mission, and I think we've done a nice job of it overall. We really have. Of, in a collective sense, understanding this responsibility to make sure that charlatans and scammers are not taking advantage of investment crowdfunding rules to take advantage of the broader public. And I think if we continue to do that, it'll serve us well. It'll show that our industry is one to be trusted, and it'll allow us to continue to succeed across the many years that we have in front of us, and ultimately realize the potential I think that we all see. So I think that's an important issue. But finally, let me leave you with this. When my partner and I started StartEngine, frankly, I'm a cancer survivor. I had started, I think, 5 companies prior to StartEngine, and I had sworn off startups. I was not going to do anymore because of the stress, and I just decided, you know what? That was something I used to do, and I'm now in my late 40s or early 50s, and I was kind of just too old to keep doing this. And so I decided no more startups. Well, I did have lunch one day with my current partner, Howard Marks, and Howard told me about the Jobs Act. And it just floored me. It floored me because I believed then, and still believe, that investment crowdfunding and the Jobs Act is one of the greatest advancements for entrepreneurship in a generation. And the reason that is because you can raise capital based on 2 things: the merits of your idea and your ability to hustle. Those are the 2 factors that matter. What doesn't matter is your age, your gender, your ethnicity, your sexual orientation, where you live, any of the things that I think collectively as a broader community, we would agree that those are not appropriate criteria, but frankly, product market fit and ability to hustle are indeed the main factors which will determine entrepreneurial success. And then when I thought about it, I thought, not only is this the greatest advancement for entrepreneurship, it's actually one of the greatest advancements for the American economy that we've ever seen. And the reason I say that is what we do well as Americans is we're great at innovation. That's what we do. We innovate, we create. And it's that which, fortunately or unfortunately, finance and money is the fuel which brings those innovations to the market. And because the Jobs Act has such great potential to allow anyone and everyone to raise capital based on the merits of their idea and the product market fit, and their ability to hustle. And that's, of course, what we talked about earlier in terms of those things that it takes to succeed. I still believe that investment crowdfunding today is one of the greatest advancements that can help our country, our economy, and our founders and our entrepreneurial brothers and sisters out there that are fighting the good fight to bring those innovations to the market and make the world a better place.
Ron, I really, great insights. It was so kind of you to reprise some of these ideas that you shared at SuperCrowd LA, because the folks there were just blown away by the insights. We've got a question that's come in online, so if I may, I'll ask you.
Bring them on.
But Tom Wright says, first, thank you, Ron, for everything you do. I'm an enthusiastic investor in StartEngine itself and in dozens of startups at StartEngine. How do we get the word out to bring more angel investors like myself into the CF world?
Well, we've done quite a bit. For most people that are familiar with our company know that we've engaged Kevin O'Leary. He's become an investor. He's a brand spokesperson, and using his name and likeness because of his reach, he has a community of several million himself. And in addition to that, because of his broader exposure, not just from Shark Tank, but from his many other activities, I think has that potential. So we think that's been huge for us. Secondly, as we raise capital for StartEngine, we invest significantly in all kinds of advertising and promotional techniques that ultimately drive more people to the industry. So I think that's a second thing that we can do. The third thing that we did was we created our own ambassador program where we were compensating our ambassadors. I think, if I recall correctly, the amount we pay is $10,000 for a company that will list on the platform. So anybody, let's say it's a CPA that works and is active in the entrepreneurial space, and they can refer over a couple deals a year that launch. Now, remember, to get a couple that launch, I think, it's going to take more than 2 referrals. I think something like, we usually see somewhere between 20 and 30 companies before we'll make an offer to one to launch, and not all of those decide to proceed. So it does take a lot of referrals in order to do it. But I think those things being out there, I think that as there are more platforms out there that are targeting more industries, I think broadening it into the impact space, which is what this event is all about, is also another element of that. And I think that, frankly, it just takes time. It just takes time. I can tell you that, I've had my own personal frustration. I was on an airplane a couple of years ago flying out of San Jose. And I'm sitting next to this guy on a Southwest flight, and he's a MBA working in a Silicon Valley tech company. And he asked him what he did. He told me, and then he asked me what I did. And I told him, and I said, well, got an investment crowdfunding platform. And he said, what's that? And of course, that was incredibly disheartening. I was like, wait, someone should know. This is like a early 30-year-old guy that's, working in the tech field in Silicon Valley. He should know, but they don't. So we still have, very much as an industry, I think our biggest battle is just what you mentioned, which is how do we broaden the knowledge so that it's common knowledge that this is an option to raise capital as an industry, rather than fighting each other. I think our bigger one is trying to harness the bigger opportunity here.
That's I think a powerful point, and I really appreciate you sharing that, Ron. I want to, if you don't mind, I'd really like to explore another topic with you briefly, and that is, there's been some discussion at SuperCrowd25 over the last 2 days about the intersection between crypto and the regulated securities market.
Mm-hmm.
For the last since probably 2017, the paths kind of have diverged to some extent. Mm-hmm. People can argue about how much, but there's been some divergence between what crypto is doing and what the securities regulations were doing. Tell us, if you would, what your take is on how you see that coming together, weaving together. We just have a 1 minute for that, if you don't mind.
Sure. So the single biggest potential here, Devin, in the crypto area is really where it allows our investors to get liquidity. That's really, I think, the main impetus that we're super excited about, and I would submit the entire industry should be excited about, because after all, our investors, should be able to get liquidity. If you put a few $1,000s into a deal, but you need some of that or all that money back, you should have an option to get it. And today they don't. So I think that's what we see as the greatest opportunity in the tokenization of securities. Further, you have to remember this. I think our industry is very well positioned. And the reason I say that, at the end of the day, when you talk about tokenizing an asset, it's still a security. It's going to be considered a security by the SEC. And anytime when somebody, the Howey test doesn't go away. No one's overriding the Howey. So what that means is that tokenized securities have to be issued either because it's a publicly listed or because there's an exemption. Well, the exemptions are clearly likely to be Reg A, Reg CF, and maybe Reg D to some degree. But Reg A in particular, as well as Reg CF, are the vehicles that I think tokenized assets are going to be bought, sold, and traded. And now that there's secondary liquidity, I think it offers a huge opportunity for us to grow significantly.
Yeah, I really appreciate your take on that. As the paths diverged, I paid less attention to that. Now I see them suddenly coming back together in this giant crescendo, and I'm thinking, holy cow, I got to get back up to speed. Thank you. Ron, thank you for all of your insights. I really
My
appreciate
pleasure.
you sharing. It's just tremendously powerful. Thank you.
Well, thank you. And again, if time limited our ability to get to questions, or people have additional questions or comments for me, it's just ron@startengine.com.
Thanks, Ron. You're the best. Really appreciate it.
Thank you. You're the best. Thank you, Devin, for the tremendous effort. And, gosh, I hope everybody recognizes that Devin has been a longtime stalwart of this industry and has probably done more to support this industry than any other single person around because of the tenure of your engagement. So thank you for all you do.
Well, thank you, Ron. You're very, very kind. It's generous of you. Thank you.
Thank you.
Well, I'm excited now to introduce our next guest. Our next speaker is Doug Wilmore. He is the CEO of WorldTree. I'm proud to be an investor in WorldTree and excited about the work they're doing to address climate change with a really intriguing structure for investors. We've got about 14 minutes for you, Doug. I really appreciate you coming and participating. We look forward to hearing from you. Thank you very, very, very much.
Devin, thanks so much for inviting me. I apologize if I was a little bit late. I clearly had a time zone mishap on my calendar. And so anyway, thanks for letting me know. I'd love to share.
We're thrilled to have you here. Do you have slides you want to share?
Yeah, I do. I'm going to share right here.
Okay.
So there we go. WorldTree, as some of you know, have been in the industry. We've been raising money for a while. We raise money every year, and we do it to plant trees around this hemisphere, the U.S., Costa Rica, Mexico. We're doing it for profit as well as for impact. And so we've raised over $18 million, much of it from crowdfunding, or started with crowdfunding over that time. And I'd love to tell you about our journey and what we've learned. A few things. One of the first things I'd say, and it's really how Wendy Burton started WorldTree, our company. That is, let's see, can you still see that slide? Okay. So Robert James Waller wrote something years ago: the surest way to lose romance in your life is to do things just for money. And so WorldTree was really founded on the purpose to actually make a difference and to make an impact. And there we go. To make an impact. And it's been at our founding purpose as we've continued to proceed through our journey. We never lose sight of the fact that we're here to make a difference and make an impact. Doesn't mean to say we don't focus on investment as we work with investors about what our program is and what we do, but it does mean that we never lose sight of the fact that we are here to make an impact. So for us, our journey over 9 years, and it's really amazing. We have over 7,000 acres planted right now, over 375 locations, more than 863,000 trees, which is just an amazing impact when you look at where we started, and to think that a group of small investors, small farmers, and WorldTree could actually create something this big. And so one of the things I wanted to speak to actually was, why WorldTree was created. So back in the 50s, the forestry industry was vertically integrated, meaning the people that grew the trees, processed them, sold them to manufacturers, and yet that got broken up by Wall Street. And so when you started to see lumber shortages and supply chain shortages and threats, and the ability to bring in new species into a market, that can make a difference and make an impact, which is what we're doing. There's no companies that can do it, no companies to work on the growing side to develop the IP and the protocol at the same time that there's someone to work on the market side to develop a market. And so for us, we're really excited the fact that Wendy was that entrepreneur that was there to solve that market problem that existing companies couldn't solve. And I'd venture to say virtually everybody on this call in the crowdfunding space, you're entrepreneurs that are here to solve a problem that existing companies can't solve. And as the quote here from Fernando Flores says, many entrepreneurs, when we're exercising the skills we need to, it's when we're living our lives at our best. And so for us, again, 7,000 acres planted, more than $300 million in assets. That's what we've done with the crowdfunding capital that we brought into our company to be able to do, sequestering almost 1 million tons of carbon. So our very briefly, our model, we raise money every year. As we actually raise money, it goes into partnering with small farmers who actually grow the trees on their property. When we harvest the trees, we share the profits, 30% to investors, 50% to farmers, 20% to World Tree. And the most amazing thing about this species we're growing, very friendly, very benign. It's the fastest growing hardwood tree in the world, reaches maturity in 10 years. So we're distributing profits in that time frame. And then it regrows from the stump after we harvest. So truly renewable, regenerative lumber. We're the largest grower by far in this hemisphere. The other largest farm that we know of is 200 acres, and we're well past 7,000, all fueled by crowdfunding. So a famous quote from Margaret Mead, never doubt that a small group of thoughtful, committed citizens can change the world. Indeed, it's the only thing that ever has. And so for us, we surprised ourselves with where we've gotten to with small farmers, small investors. Again, as you see some of the impacts that's had, but now let's put it in terms that we know about. We're on track to plant our 1,000th tree this year. To give you an idea, that will offset the annual carbon footprint of Boulder, Colorado. So that tells you what a group of small people can do when they get together, committed to the same thing. So the trees that we have in the ground set to distribute more than $127 million to our investors, more than $254 million to our farmers, all fueled by crowdfunding. Let's see, the other thing that we really love to do is work with small farmers. Many of the larger institutional investors who've looked at World Tree and our model, they pull away because of the small farmers. They call it a risk. For us, it's our secret sauce. It's our multiplier. It's the way, not only is it a huge part of our impact, but it's the way we're able to turn $17 million into $300 million. So barriers to investment are barriers to impact for us. I mean, they're very much the same thing. We see all sorts of reasons why people may not want to invest, especially larger investors. It's one of the reasons why crowdfunding has worked so well for us. We run into people who care very deeply about impact on crowdfunding platforms, not so much in institutions. You see, again, institutions have a very low bar for impact. Much of the diligence processes we've been through with quote unquote impact funds, they're specific. They do almost all their due diligence on the finance part of the equation, not the diligence side. And so there also ends up being very short-term thinking that we've run into. whereas climate change are a long-term problem. And so some of the insights that we've had from our process that I'd love to tell you about is that marketing is a year-round effort, happens before, during, and after the raise. It's a always be in the market somehow, some way. Even if you don't have your raise up, you're in the market getting ready for it, getting ready for the next one. It's also very important to come out of the gate strong. You've heard the statistics. The vast majority of crowdfunding campaigns raise less than $100,000. And you have to be ready to come out of the gate strong. And so I think so many people new to the crowdfunding space expect the platforms to be their vehicle, sort of the if you build it, they will come kind of thing from Field of Dreams. And yet it doesn't happen that way. The good platforms will give you pointers. They'll point your way to success. Some of them will have an audience already built in there that will give you a boost, but you have to count on most of the investment coming from your own network, your own work, or marketing partner that you've hired to help you along the way. The other thing, a really great quote I've loved from the past is the opposite to courage is not cowardice, it's conformity. And so I frequently find the most impactful campaigns on crowdfunding platforms, they're the most different. They dare to be different. They are willing to stick out. They're willing to be unique, and they're willing to express themselves. I think authenticity is one of the most underused, undervalued aspects of a campaign. It's how are you being authentic to yourself? Then the next thing, and I touched on this, but it's so important, and I'm so proud of our founder and the culture that she built with WorldTree. And so, it's that question, what do you want to say your life was about at the end of your life? And so your product, your service, the thing that you've developed to bring to a crowdfunding platform, that's just the ticket into the game. After that, it's all about the offer that you make to the market. What is the offer? What's the compelling offer? So much of that comes from your purpose and why you're there in the first place. And what's the reason that you're there? What's the passion that has you be there that has to be expressed and communicated out there in the market? So that gets me to my last point. And I think this is one of the most controversial, I'd say. We find that for WorldTree to be the most impactful in the market, for our offer to be the most impactful, we have to ask for more than money. Yes, it's true. Someone can invest, go on to Dealmaker right now, put in their credit card, invest $5,000 and be part of our EcoTree program. Yes, it's true. By the way, one of the things I do want to say that's very unique about us, our average investment is $3,600 into our EcoTree program. The minimum is far less than that, but that's the average. And I say one of the reasons I think it's that large is because we ask for more than money. We ask for you to commit, to care, to give something of your heart to this movement that we're part of. And it's really, really important to us. We don't demand it. It's not required. You don't have to do a blood oath. But we do ask you to invest yourself in this movement that we're committed to, that we're a part of. And I want to use an example for that. So, many years ago, this is a famous Apple ad that Steve Jobs was part of. Richard Dreyfuss was the original narrator for the TV campaign. And, you can read through that. Here's to the crazy ones, the misfits, the rebels, the troublemakers, the round pegs and the square holes. Many of you may remember this. And while some may see them as crazy ones, we see genius, because the people who are crazy enough to think they can change the world are the ones who do. And so the thing I'd want to point out about this ad is, first of all, many people can see it as, oh, hey, that's really clever marketing. No, you go back to the early days of Apple and what Steve Jobs built. He asked you to be a crazy one. He asked you to be a misfit and a rebel and a troublemaker. He wanted you that way. If you remember back in the day, you'd show up in a tech store. Apple would have volunteers in that store marketing their product, explaining their computers to prospective buyers. And so he really wanted you to be part of this movement. It was important to him, and it was an important part of what he built there and what they built. They didn't just build great products, but at premium prices. They asked you to be part of a movement that was different. And I say one of the things that was most powerful about what they did, they asked for more than money. They asked for their their buyers to give part of their soul, not just money. And so for us, the final thing that I'd say is find your leverage point. So, this really famous quote, give me a lever long enough and a fulcrum on which to place it, and I shall move the world. So I could ask all of you, this isn't a class participation exercise, but what's the leverage point that WorldTree has found? And there may be many answers that are good ones, but I'll tell you and sort of fast forward to the answer. The answer is the small farmer. So if we didn't have small farmers part of our equation, that $18 million in funding we've raised from the crowd and from individuals wouldn't have turned into more than $300 million in assets. It would have turned into about $75 million in assets, because we'd be buying property. We'd be paying people to perform the regular uptake and the care on our trees every year. Instead, the farmers are our partners. And so we really believe in partnering your way to the top. And again, someone doesn't have to follow that, but I promise you, in the entrepreneurial problem that you've taken on to provide a solution to, there's a leverage point that you can find that can take you to a whole new level. So with that, I'm finished. I'm complete. Devin, I hope that met the time frame that you needed.
Well,
And,
thank you so much.
Totally
We're so glad to have you.
Totally willing for anyone to ask, to respond with questions or get back to me at I'm doug.wilmore@worldtree.eco.
Fantastic. And Doug, I invite you to pop into the backstage area. We've got that set up. People are there. I'm sure there's some who want to talk to you. And folks, if you are not yet a VIP, if you're a VIP, pop into that backstage arena and chat with Doug. If you're not yet a VIP, I encourage you to buy a ticket. It's not too late, just $25. Get time with Doug. Get time with the other speakers today. Get access to the handouts, the speaker handouts, etc. Get access to the VIP LinkedIn group. Get access to the VIP webinar this evening. Tremendous value still left to harvest, just $25. Doug, thank you very, very much for being with us. I do invite you to pop into that backstage area. I think you'll enjoy that, connecting with a few folks there. I got investors and others back there waiting to chat with you. So thank you very, very much.
Thank you so much.
All righty. I'm excited now because we've got my dear friend Jason Fishman is going to lead a discussion. And Jason runs Digital Niche Agency, one of the absolute best at marketing crowdfunding offerings. He's been doing this for a long time now. He's helped some of the most notable campaigns, including what's the folding house one? Jason, you'll have to help me. We don't call it Boxable. Boxable. You helped with the Boxable raise.
Among other Regulation A Plus campaigns this year. Absolutely.
Yeah. So you've been involved with some really great campaigns. We've got a great panel discussion coming up here. And so I'll let you introduce, Jason, the other panelists, but thank you so much.
Thank you, Devin. Appreciate you putting this on. You are a voice for the industry. I have a stack of your books. I think I'm quoting a couple, but someone brought it up. They shared this book on a video screen to me this week, so I had it right in front of me. But a round of applause for Devin from all attendees putting this together. Truly amazing. Was listening to Ron, was listening to Doug at World Tree. All of the top thought leaders have been speaking over the past couple of days, in my perspective, and Devin goes out of his way to make this all happen in person through digital events. Can't thank Devin and SuperCrowd enough. Excited about this panel. Speak on many panels, have a weekly podcast, but it's not every day I get to be on a panel with some of the top agencies in the space, some of the top creators, designers, strategists behind the the Regulation A Plus campaigns that raise the most, that raise the quickest, that have a real impact, even for smaller rounds, for issuers, for founders in this space. We just heard Doug give some great recommendations on what issuers should be doing, misconceptions in the space, how they've seen success on their annual raise year after year after year. That's what we're going to be getting into detail here in this conversation, from clicks to capital. I hear founders say, we don't care about clicks. We just want the capital. We just care about investments. We're going to speak about why all of that matters, what the story, what the offering page, what the best channels, even on a lean budget, can really produce. So mastering the marketing of investment crowdfunding. This is going to be a high energy, interactive discussion. We're going to be giving you value. I think Devin said in one of the emails, have your notebook out. There's going to be a wealth of knowledge dropped on you here. I feel like I could do the introduction for each of the panelists, but I'm going to let them hop into it one by one. Potomac, one of the top agencies in this vertical. Can you share with the audience a bit about you, and we'll cycle through each of the panelists from there?
Sure. Great to be here with really such a diverse panel. Jason, thank you for moderating this. I'm Eitan, co-founder and CEO of Potomac Growth. We were our run-of-the-mill B2B D2C agency doing regular B2B and D2C marketing for years. Very successful company, dozens of clients at a time. And we accidentally, a few years back, got involved in a Reg A raise for a marketing client of ours, fell in love with the space and found it much more exhilarating than product marketing. And, we just sort of take this approach of we want to try to help our issuers as much as possible, even if it's sort of out of the scope of our, contracts. And just, we built a reputation, I think more just on being supportive more than anything else.
Excellent. And Eitan, working on many of the top fundraisers right now, strategic partner of Start Engine, WeFunder, a lot of different groups out there. Really would get in touch with all of the panelists, but with Eitan to learn more about how they're seeing success. We're going to go into the details here. Dawson, want to familiarize the audience with what you do, what you're great at?
Absolutely. So co-founder of Raise Launch. I've been in the capital raise marketing space for about 15 years. We've started out focused on kind of everything, and then honestly, in the last several years, really have kind of whittled that down to focus on story, messaging, go to market, all the creative that goes with that, and then hand it off to the groups that are on here that are amazing at paid media. So hyper focused on story, hyper focused on creative video content. And just love the collaboration really that comes with that, of working with other groups in the space. I think it's a very small sandbox that we all get to play in, and at least from my experience, everyone is always super friendly, super open to working together, and I think that's one of the things I love about the industry as a whole.
Peter, fellow Crowdfund Professional Association board member. Honor to be on here with you. Would you like to give your bio?
Sure. Thank you, Jason. Hi. So I'm Peter. I'm a CEO and co-founder of Raiseway. Now, where my company has shifted focus, so we're now going to be automating donation crowdfunding, and that's really the purpose of what we've been working on for the last, 4 years now. Being the smallest of the issuers cannot afford the fine services of the folks on this panel, and so we've been thinking about if the person can do it themselves, right? If they can, they don't have the budget to hire professionals, what are the automations? What are the solutions that we can bring to them that are super affordable at the cheapest possible price? We looked at the market. We just figured that, okay, well, in investment crowdfunding, the small business market is just too small for us to operate in. So the place where we can drive the most value in the immediate future is automating donation crowdfunding, and then move to other types. But at any rate, I'm really super excited to be on this panel to listen to folks on it and to learn as well. And so my input may be more theoretical than that of folks here, because I personally have not touched as many campaigns as y'all have, but I'm happy to contribute whatever I can.
And Dana, last but not least, can you tell us about Pitch for Impact? Can you tell us about yourself, why you focus on this space of regulated investment crowdfunding?
Okay, thank you, Jason. And I just want to say thank you to Devin and Jason for inviting me to be on this panel. I'm so excited, and I've learned so much in the last day and a half already. So I am Dana Sather Robinson. I'm the owner of Pitch for Impact, and I'm also an angel investor. And I help founders with their skills, particularly around pitching, so that the content of their pitch is focused on what their ideal investor is motivated to take action on. And so that when they're pitching in person or creating a video or doing a webinar, that their communication skills are engaging and that they're developing relationships with investors. That's the short answer.
Thank you. Thank you. Excited to be here with you, Dana.
Yes, I do something very different than the rest of you, but I'm so excited to learn how you all work.
Well, as Eitan mentioned, it's diverse and it all connects. So being able to talk about the story, the pitch, really understand the audience. I'm looking forward to getting into that with you. It's such an important part as we start to look at analytics and some of the performance aspects. It builds that foundation. And for anyone that is not familiar with me, I run an agency called DNA. We've worked on over 500 deals across Reg CF, Reg D, Regulation A+. I've raised 9 figures of capital collectively on these campaigns through content, advertising, and outreach channels, and showcase a lot of the results in my podcast. Like to be an open book in terms of what we see working and not working in the space. I want to see a higher success rate across the entire vertical. Get the metrics from King's Crowd. Shout out to Chris Lustrino and Brian Boulay and the whole team over there. I like adding the realism. I may throw some numbers in here based on stats from 2024 insights, as well as what we've seen in July and already in here in August. But I want to begin the discussion with the question that I get asked on a daily basis. Where should I run my campaign? I'm going to do a Reg CF. I'm a founder. I want to raise 1.235 million. I want to raise 5 million. Should I go the self-publishing route? Should I talk to companies like Dealmaker, Issuance, Dalmore, T0? There's a lot of other solutions that can build this type of infrastructure. Should I go to a portal? Start Engine, WeFund, Republic, Net Capital, Looped, what have you? Dawson, wanted to ask you this question. I feel like you have a unique perspective on this. What do you tell groups that are trying to determine the best place that they should position their fundraise?
Yeah, absolutely. Like you said, I think it's a question that from the marketing agency side would get asked on a regular basis. Lots of time we're talking to groups that are in the process of really figuring out what are all the different pieces of the puzzle to this whole crowdfunding game. And so one of those big questions is, do I go with an Issuance, Dealmaker, Dalmore, type scenario where I'm self-hosted? And just for everyone, you might not know what that means. You own all the data, the analytics, you're putting it on your website. And what comes with that is maybe a higher upfront cost, of just kind of full transparency here, higher upfront cost. And then, or do you go the platform route where it's WeFund or Start Engine Republic, something like that, where, maybe it's a lower upfront cost, but your cost of capital, percentage wise down the road is a little bit higher. And I think from our perspective, it really is dependent on where that issuer is at and, their kind of cycle of raises. If they've raised before, do they have a big list? Do they not have a list? So it's one of those things where it really is dependent on their particular situation. And we try to do a good job of guiding them based on that information that we gather on which one is the best path for them. The one thing that we always say, though, is that might be helpful for this call and everyone listening is do your due diligence. So it's going to take time, but I would recommend interviewing every single potential place that you could list your offering, if that's self-hosted, if that's platform. You've got to find the one that feels like a good fit for you, and the one that from a cost of capital standpoint makes sense. So it might make more sense to start out on a platform and then move to self-hosted down the road. So, it's one of those things that, I don't have one of those answers where it's like only do this. It's really dependent on that particular case, but that's really where we look at it and go from there.
Definitely pros and cons to each, and it's an important aspect of the strategy. Where is this physically going to live? I use the word strategy. I find so many groups do not put together a marketing plan. I like to look at it as an algorithmic roadmap to hit each milestone, understanding where the traffic's coming from, which channels. But before that comes audience. And Dana, I really enjoyed our discussion around this. How do you guys determine, clarify the target audiences, the variance of each of those that you want to go after in a campaign, and then build a story from there?
Well, I think it's really important for founders to understand who's their ideal investor, because it's going to be different for every company. And your story is going to change depending on who you're talking to. So you have to really think about who are your biggest supporters? Are you pitching to the right investors? And identifying the ideal investor. Because like every great marketing campaign, you have to have that ideal customer profile. And before you start a fundraising campaign, you need to think very clearly about your ideal investor profile. And you might have more than one. But the first step is to really do some self-reflection and think about what you want from investors. I mean, maybe your investors are your customers. And maybe you have a big list, so then you've got these people that are going to be excited. But maybe that's not the case. Maybe you have a mission and your investors are going to be attracted to your mission. Like Doug, the previous speaker, was really trying to motivate us, and I was really excited about what he's doing. He's asking us to be part of a movement. That's a very different message than if somebody's selling a gadget and you this is your chance to buy it and be the customer and the investor. So it starts with self-reflection and really think about what you want from investors. Are they going to align with your mission? Are they going to buy your product? And how can you align your message with the investors that you want to attract? And I ask my clients to think carefully about the qualities and the characteristics you want in your investors. I mean, particularly if you then also raise from angels, are you going to want people that are mentors or that will connect you to customers or be advisors? And I've had some clients that have had some bad experiences. So when they describe the characteristics of their ideal investor, it starts with no jerks. Be that specific. Think about what you want and what you need and what your situation is. And then think about that ideal investor. What skills do they have? What mission is going to attract them? And actually, I've created this handout, this downloadable tool that asks at least the core questions for founders to consider about what do they want and need, and also what's that investor look like. It's in the handout section because there's so many, but it's really thinking deeply about what it is that's going to motivate them and what they want to hear.
I like to feel like I know what they do on the weekends, what sites they go to, who are the biggest influences, what actually makes them move. I'll put a fictional name and picture. I won't stop on the picture till I get it right. But if I can't encapsulate who that audience is, I'm kind of just throwing broad words at it, right?
Exactly.
And Eitan, to build on that, we get asked questions all the time about channels, how to build a community, should we run advertising? And sometimes it's lean budget. One campaign has to produce enough capital to fund the next, rolling closes, reinvesting portions of it back into marketing. How do you address that conversation? How do you figure out what to do with those audiences, the right ways to reach them, and put some numbers on the board so you can then ramp up into higher milestones from there? Oh, I think you're on mute, Eitan.
Can you hear me now?
Yeah, I didn't know if it was just my speaker. Loud and clear.
I don't know. But no, it looks like the host unmuted me. Thank you. So if I unpack your question, there's two parts, right? There's the practical side, which is what are the tangible marketing efforts that we undertake in order to achieve tangible results in difficult circumstances. And by the way, that's, as a company, what excites us so much about equity crowdfunding and why we doubled down so much in the space and have grown to, to be servicing literally dozens of campaigns at a time right now. And then there's really the more philosophical, personal part of your question, which is how do we communicate that with founders, right? So I'm going to start with the second part of the question and then go back to the technical steps that lead you to success, right?
Sure.
You have to be hyper transparent. Okay. It all starts with hyper transparency. I mean, literally, that's part of our pitch when we speak to potential issuers who are referred to us from any of the crowdfunding platforms, Jason, you already mentioned. It's the first thing I tell them. I'm not going to lie to you. I'm not going to oversell anything. I'm going to tell you the truth the way I see it. And that truth might be underwhelming sometimes as well, right? So for me, it's about honesty and expectation setting. Great, you have a shoestring budget. We are going to do everything in our power to make this campaign successful with that shoestring budget. But we also need to set our expectations accordingly, right? And if we can successfully set expectations with issuers, regardless of their size, I think that it's far easier to achieve success because we're now using the same metrics to determine success, right? And I'll give you a great example of a conversation I had today with a founder. It's a small raise. He's aiming for $400,000 or $500,000. We tend to not support issuers under $500,000 goals up through, 5-10 million plus. So for us, it's a small project. It, gets the same amount of TLC as any other. But his ads, direct return on ad spend in the second month of his campaign is just under 4x. But he's growing followers in a really, really, really healthy pattern, right? Because we spoke to day one and said, listen, we are talking about spending $1,000 a week, $2,000 a week. Okay. What is that really going to give you? I think that helps a lot with longevity because we all know what may or may not be achievable. So that's answer to part two. Part one is what are the steps you do on a shoestring budget? I'll try to answer it very, very briefly because I think that's more of a less interesting answer in my opinion. It's really going to be about how we as a marketing agency work with that founder as an advisor, right? It's great. We're going to do email marketing to their network. We're going to be putting out updates on their pages. We're going to be running ads. Fine. And it takes PPC experts to, fine tune the ad performance and all that. Then my number one job on a technical level, I talked about expectation setting. I'm going back to still my relationship with the founder. I, as an agency, do more than advertising for one purpose only. I want to take as much off the founder's plate as possible So their email marketing we do, their updates on the page we do, file for dollars all day. And so that is, I think, more than anything, our secret to successful campaign management is being willing to take on additional tasks most marketing agencies won't. And at the same time, every day communicating to founders, this is what we're doing. Your job is to call everyone you know and solicit them. That's honestly our secret.
Well said. You need a crowd to have that crowd effect and to build audiences on top of it. The expectation setting, crucial. I will really echo that. And being able to say, hey, 4K a month, if you're hitting 16K, if you're seeing 40K full marketing efficiency ratio from all traffic and social sharing that's occurring from there, it sets the right playing field. I think it works against many agencies too when they just point at their best campaigns and everyone's expecting those results. You're adding that level of realism. And what I'm hearing on the relationship side is you guys are strategizing, you're playing at the goals together versus just saying, hey, we're delivering this at a later point. I think that's a great context, a great perspective to be able to
do you
provide.
mind, can I add something? Because you brought up like an interesting point, right, about case studies.
Yeah, it's a
My
conversation.
favorite case study to share with issuers who are speaking to us the first time is, I'm not ashamed to say this, right? Right now we're supporting over 30 raises just as we speak, right? Some are going to be amazing and some are going to fail. We had an issuer at the beginning of this year that after 2 months in, we raised zero. And the funny thing is, I thought that they were going to be a big winner, right? That is always the first case study I share with issuers because that is the best way to set expectation setting. The reality is I can be a top expert and one of the biggest agencies in the space, and I can still get it so wrong. And I think that really helps us because then issuers understand, oh, there is actually a chance for failure here. And I think it helps them make more informed decisions.
Yeah, I'll get asked by issuers, hey, we want to raise $5 million. Do we need 2 months or 3?
Yeah.
Whoa, there's a lot I have to share here. There's about 5 campaigns that did it last year, actually 4.8 or higher, about that many this year. Of 1,400, only 7% hit $1 million. Let me talk to you about how they were effective, but these are all tests. We're going to optimize what's working best and make recommendations from there. And I like how you're setting that framework with the issuers, the clients you're working with, because it's based on the fact that, whatever the starting budget is, let's make sure it's meaningful enough, but comfortable, because there could be a couple months without performance. I've seen campaigns where there was no results 6 weeks in, and by month 3, we were surpassing all the performance benchmarks. And I share that story as well. Peter, I know there's different types of Reg CF campaigns, different types of crowd funds. What's the difference? Is it the same approach for marketing investments with small business credit offerings as what we're seeing on high growth startups, scale ups, if you will?
Right. So thank you for the layup. No. Right. So one of the key things that people experience when they consider, small business under 124K raise, in my opinion, like the one key element of that is that, well, your budget is basically zero, right? Your budget to do the campaign itself is non-existent. You're not going to have, ad spend on Facebook marketing, on Instagram ads. If you do, it's going to be minimal and probably towards retargeting rather than, kind of broadening the reach. And one of the more, I guess, pronounced effects of raising for a small business, especially for a credit offering, is that you really have to look at the community of the founder, right? If you don't have any means to increase the size of it inorganically, then you kind of have to look at what is in front of you, and that's where people really have to do a long, hard look, right? What I recommend people to do is the first thing is scrape all of your Facebook, scrape your Google contacts, scrape your LinkedIn, get it all in one spreadsheet. And, it's going to take you a lot of time to put a mark for every person how much money they might be able to contribute to you, but it will, just kind of like zooming out and looking at that list will really help you to understand how much on average people in your community can give you. And unfortunately, the nature of crowdfunding, investment crowdfunding, and I think to an extent rewards crowdfunding, donation crowdfunding doesn't apply, is that this is a very class-based product. This is fundamentally a middle class or an upper class product. It is not a lower class product. If you're living paycheck to paycheck, your liquidity preference will always scream at you, no, you're not putting $100 into that campaign. You're not going to be doing that. And the reality of the situation in American economics in the last 30 years is that the middle class is compressing really fast. Our cities are becoming poorer and poorer every year due to the high cost of living, due to other issues. And in that environment, a lot of small businesses, if you're going to be raising money with rewards crowdfunding, if you're going to be raising $100,000, $50,000, $70,000 to maybe put a small improvement in your business, maybe, raise money for the first time you're opening the business, you really have to do extensive parsing of your network and really high target kind of outreach. You're targeting connections with strong connections, right? There's a high difference between going to someone that you know well and asking them for money up, 3-4 months after you've been buzzing in their ear about your business. There's a very big difference between that and, just kind of like blasting everyone with a marketing campaign. So these campaigns take a lot of time. They can take, up to 6-7 months of just warm up and getting the community ready and communicating the messaging of what you're trying to do and connecting your small business and that, that minuscule in many cases returns, right? Like not in a sense of minuscule relative to how much you contribute, because relative to how much you contribute, that's quite significant. Sometimes it's, 14, 13% returns, which is higher than what most investment instruments can offer to you. But in the debt space. But you have to connect that offering to, this business growing, the profits being shared within the community, the business growing, they're not evading taxes, they're going to pay the taxes, so the schools are going to get better, the roads are going to get better. If you're a real estate owner in the community where this business exists, the value of your real estate increases, right? For each campaign, the investors don't know this, right? Even more or less sophisticated investors don't know this. So you have to spend a lot of time working with local stakeholders, getting any free marketing you can, parsing the hell out of Google Maps for all the entrepreneurs, all the business owners in your neighborhood. It's a comprehensive zero budget campaign where you really put a lot of effort in building connections and making sure that you have local advocates for your business. I'm sorry, that was a long spiel.
That was great. It's what you're emphasizing. It's that much more important to tap into your first degree network to warm up the prospects that you're going after, often through direct outreach, in-person meetings, events, what have you, because you have to establish that trust, that confidence. You have to be very analytical about which audiences are working best for you. You're talking about income. You're talking about a lot of different topics. I'll take a note on. I haven't heard it broken down in that fashion before. Across all these campaigns, there's an offering page. I've heard it described as your e-commerce platform with shares, stock being sold on it, meaning it has to do a strong enough job. It has to be engaging enough to convert even a cold audience, not just those that have a direct relationship with you or your company, but someone who's never heard of you to believe in what you're doing. People don't trust what they see online. There has to be enough social proof, has to be enough third-party validation, of course, but to put in their personal information, their financial information, difficult feat, especially at scale. We were talking about traffic, how many people need to get there. I can tell you how many visits probably for a $5 million campaign. Dawson, you are an expert at this. You've built, I would say countless, you probably know a number of offering pages. And I'm curious, what can we say is the best approach? the tools, the message, story, visual graphics, video, some of the funnels that follow. The SEC wants that to be the centralized location so that it passes the glance test, but has all of the underlying details to give an investor enough info to move forward. What are the secrets?
Yeah, no, I mean, to your point, it starts out with what you just mentioned about compliance. So, anyone has a cousin that has Photoshop that can design a, website, and that's great. But if you don't have someone that has experience in the compliance, SEC, FINRA, everything, on the Reg CF side, the FAQs, the different things you have to have in terms of discussion boards. I mean, there's all these little check boxes that we have in terms of making sure that it's going to pass compliance before it goes to that compliance officer. But once you get past all that non-fun stuff and get to the storytelling and the graphics and the content, I mean, from our side, we have kind of a framework that we follow in terms of those offering landing pages. But really, when we break it down, we're huge believers in the component of video on that page to quickly tell a story, calls to action throughout, not just one at the top and one at the bottom, but multiple places they can download the investor deck or, jump on a webinar. We have seen the power of the automated webinar or the live webinar for issuers and making sure that's a part of that funnel. But then also just from a storytelling perspective, it really does begin with that messaging in the marketing that starts at the very beginning. So, you can throw up a landing page very quickly now. There's lots of AI tools that can help with that. But to really start and sit down and figure out what the story is you're going to tell so that the graphics match that, so that the charts match that. So it's not just, kind of a random grouping of content, but that there's really a flow that the investor can go down and feel like, one, they're getting educated, but two, just from a design perspective, I think the credibility markers of seeing a high quality designed landing pages versus just a WordPress template that has invest now thrown at the top. I think that's a huge piece of the puzzle too, to make sure that that investor feels comfortable, clicking, opting in, putting $500 into the, offering $1,000, whatever it might be. They need to start out feeling confident that, okay, the design looks like an 80-story building. The content I can understand and I can follow. I'm not getting confused, and just follow those different story markers throughout the process to start that journey. Because really, that's the place they're starting, and then from there, they're going to go through. They're probably not going to invest that first time they opt in. So now they're getting dripped on through email campaigns, SMS campaigns. But really, that landing page was the first place they decided to take that first action, which is the most important to get into that journey, to get into that flow of the drip from there. So. Yeah, I mean, I think the landing page is a huge opportunity to either hit or miss, on the campaign. And, I'm sure Jason, everyone else on this call, you've seen, landing pages from paid ad campaigns not convert worth anything. And then you get an updated one. It's like, okay, it wasn't necessarily the ads, it was where they were being sent to.
It's what's doing the selling. A 1% conversion rate, a 3% conversion rate, worlds apart, and warrant different types of scaling as a whole. Dana, anything to add to that? What makes an investor invest? What really needs to be present on one of these offering pages so the audience not only feels strong enough about the deal to put in their own funds, but to then share it? Peer-to-peer marketing's ultimate. What needs to be in there for this to really happen?
Yeah, thank you. And I'll expand a little bit on what Dawson said about having that great story. Because that pitch story is really the core. It's the foundation of the entire pitch. It's that strong narrative that's the starting point for everything. Then that goes through to your deck. It goes through to what's in your video. It goes through to what you put in your webinar and all the narrative on the landing page. And having that really strong story to start with my clients, we actually storyboard it. Having that very clear and concise and understandable, as Dawson said, to start with, makes all the difference. Because I found if people get confused even a little bit, you've lost them. So the biggest mistake I see is founders they are so excited about their product that they're building that they start diving into the details and the features and the technology. And sometimes that's confusing. And that's the thing that will lose people if they're not like in your industry or understand everything that you're talking about. So to first really to storyboard that whole narrative around what it is that your ideal investor is going to be excited about, and make sure that it covers how you make money and the problem you solve and who's your customer, so that and as Dawson said, it flows. But to do that, it needs a really clear story and narrative that flows, that you can use that same narrative in an investor meeting with no deck. You can use it in your pitch. You can use it in your videos. And once that's done, you actually then save time. I met with a client this week who was so relieved that once we've created that basic story, she's like, I'm so glad I don't have to then create a totally new pitch when I meet with these other investors next week, because that's what she'd been doing, because every investor is different and they wanted a different thing in a different format. And now she just has this story that she adapts for different investors, for different lengths, for a different format, right? If it's video or deck. So that's really the key that's going to attract the right investors and get them to be motivated and take action, and then have actually storytelling in that. It's not just the narrative of the deck, but use stories to get people excited. Stories are really handy to make something that's very complex simplified. And stories are really good at connecting to people, because that's how we communicate when we're building relationships. So if you were trying to build relationships using a story in there, whether it's on why we started this business or why we're motivated to solve this problem, makes people feel like they can trust us. And it's more authentic, and it sounds authentic.
Absolutely. It's well said. Do you ever test out through focus groups or offline, online comparisons what the messaging actually is to that target audience, more of a closed loop type of process, so you know, hey, this is going in the right direction, we're ready to take it to a larger arena?
Well, we do find, as an angel investor, I can give them a lot of feedback on this is not going to appeal to investors and this is, but as we know, all investors are different. So once we've created the ideal investor profile, we do try to find friendly investors that I can say, all right, now test this on them, get their feedback and come back. So and also when we're out there meeting investors or pitching or putting something up on a platform and getting that feedback, then they learn as they go. It's never perfect the first time.
I really like the way you put that. Not everything works right out of the gate. Being able to shift, optimize, pivot, I've looked at as the differentiator from the top performing issuers. Eitan, offering pages and beyond, how do you get a higher conversion rate? I know you guys are experts at investor relations, and being able to actually speak to investors is a difference from what could be said from a founder. I know there's some comparisons there, as well as content, some of the funnels, what you were talking about, to get more of a response from the prospects that you're retargeting. Can you speak to that a little bit? Oh, I think you're on mute again.
My bad. So how do you sort of, maximize efficiency of this funnel that you guys have been talking about? Landing pages, advertising. So I want to zoom out for a second, right? We need to talk about data for a minute. With crowdfunding, it's as true as it is with any other marketing space. It today requires multiple contact points with a investor to get them to convert. What is that number? On average, it's around 4 or 5 times, right? That's not my data. You can read that in a variety of academic articles published on the subject of equity crowdfunding. So for us, it's always a question of how do we get those 5 touch points, right? That touch point can be an email. That touch point can be a phone call. That touch point can be a landing page. That touch point can be your portal page or tech page, right? Whether you're through like a WeFunder, Start Engine, or a Dealmaker tech, right? At the end of the day, you need to have those points of contact, and it's best that they not be the same thing more than once, right? So I'll start with something generic and then we'll get specific, right? Make sure that your email flows are not more of the same, right? So if I sent an email with a general pitch, I'm not going to send the same thing or the same highlight twice, right? If I've pinged somebody via email, I want to make sure that potential investor then gets a phone call after that, right? We're also a big believer in A/B testing landing pages, right? Data is king in marketing, even though in equity crowdfunding it's a little more opaque sometimes. At the end of the day, if I throw up 3 separate landing pages, even if the written language is the same, right? Because we all have to go off of what's in Form C, just presented differently, in a different order, with a different aesthetic. Within a week or two, you're going to know what's working and what's not. So to summarize my answer, it's follow the data. That's what you need to do.
And Eitan, you mentioned calls in there. We haven't really touched on that yet.
Yeah.
What do those calls consist of? If it's the founder, if it's a team member, if it's an external IR firm, and what type of impact, what type of role can that play in the conversion funnel?
Yeah, absolutely. So, we learned very early on when we got involved in crowdfunding that investors the founders personally spoke to invest more money, right? Somebody might invest or not invest, whether they speak to the founder or not. They're more likely to put more money in if they have that personal relationship, right? Ultimately, retail investors, yes, they're looking to make money, but they're really looking to be part of something, right? Whether that's because there's a really strong direct-to-consumer angle to the business and they want in on that with some sort of discount, or because they ideologically or morally identify with a specific cause or problem that a business is solving. And there's additional reasons beyond that, right? So that personal relationship is key. Founders should be the ones speaking to investors. That being said, there are some founders who are too busy to speak to every investor, or their raise is producing leads at a volume too large for any one person. We're one of the few agencies in the space, maybe the only one that actually has an in-house team of SDRs. We're limited. We're not a broker-dealer, so we can't solicit investment. But simply a ping from our SDR saying, hey, thanks for downloading our deck. Would you like to speak to the founder? Increases conversion rates by up to 30%, sometimes even higher. So that's, I think, the best touch point is to actually talk in a one-on-one conversation. I hear a clock ticking.
Devin, do we have time for a final recommendation from everyone, or are we at time?
I am afraid we are wrapping up. But what a great job you guys did. This is just such rich content and such value, different perspectives, different experiences, everything relevant. Wow. This is one of those things that issuers, new, pending, and future, need to just replay and replay and replay. But thank you all for being well prepared. Thank you for being here. Thank you for the time. I want to encourage all of you to drop into the backstage arena now. We've got a lot of people there waiting to talk to you. If you are not yet a VIP, it's not too late. Still more great content coming up, more opportunities to talk to great speakers. We've got the live pitch coming up. You'll have an opportunity to talk to the companies that are pitching. So get your VIP pass. We got the VIP webinar tonight. It's still not too late to join the LinkedIn group. It's not too late to get the speaker handouts. All of these things that are available only to VIPs, still valid, still valuable. I encourage you to check it out, get one, and then join us for the rest of the VIP stuff. Again, panel, thank you very, very much. Jason, Dana, Eitan, Peter, Dawson, thank you all. You just did a tremendous job. Really appreciate you. I'm now excited to introduce our next. Oh, wait, no. This is we have coming up. You'll all be glad. We're gonna take a quick pause while we thank our tremendous sponsors. We've got, we're so fortunate that this event is successful. It helps to fund our operations for the year. We could not do this event. We could not do the work that we do without the great sponsors that we have. Our Max Impact sponsor is Proactive Realty Group. The CEO is Dr. Kanan Van Williams, and he is doing a crowdfunding campaign right now. You can check it out at 4sc.fund/rancho. I encourage you to do that. This is an opportunity for you to support affordable housing and to support our sponsor. We encourage you to check it out. Make sure that you're thinking about this as seriously as possible. Now, please, let me invite you all to check out our sponsors and thank them for the great work that they do to support us.
You're watching SuperCrowd25, the biggest event in impact crowdfunding. Over 2 days, top experts, investors, and mission-driven founders are sharing how to raise capital, discover profitable investment opportunities, and change the world. Stick around. You'll hear stories, strategies, and insights you won't find anywhere else. And if you want to go deeper, join our VIP community for just $25. Get backstage access, exclusive networking, speaker handouts, and a special VIP-only webinar. SuperCrowd25, crowdfunding the future. Impact starts here.
The property was dilapidated. It was horrible. It was code violations, drugs, crime, rundown RV trailers, no parking lot, no lights at night, just nothing. Our main focus is second chance housing. A lot of affordable housing households are led by single mothers. Our portfolio is 100% affordable. So our mandate is to be 20 to 30% below market rent. I'm personally $180,000 invested. We're only one of 2 companies globally to have a published social impact report for affordable housing on a Morningstar platform.
What's the faster way to build wealth? A traditional savings account at 0.38%, or worthy property bonds earning nearly 20 times more? Earn a fixed 7% APY starting with just $10, access your money anytime with no fees, all backed by real estate. Visit worthypropertybonds.com today.
The African diaspora is one of the biggest investors in the continent, but they are looking for a structured, transparent way of supporting this business. This is not donation. This is investment for return, including impact, and join our movement community. Thank you.
Behind today's biggest crowdfunding raises,
the leading CPA firm for Reg CF, Reg A, and Reg D compliance.
Trusted,
experienced,
set apart.
Join the CFPA for the Regulated Investment Crowdfunding Summit on October 21st and 22nd.
Register at ricsummit.org.
Rural property taxes fund vital services.
Only when they're paid.
Invest in real impact.
Visit invest.coretaxdeeds.com today.
None of these are working.
Let me guess. I'll bet you want to exit or diversify.
Thank you.
You're welcome.
ISPD strengthens health for families across Haiti.
Donate today. Make an impact.
Hello, everyone. I'm Gene Massey with Media Shares, and I'm very excited to be speaking at SuperCrowd25.
Save the date for Super Green Live, the global event on sustainability and green innovation, January 22nd through 24th, 2026. We extend our deep appreciation to our supporting sponsors and co-hosts, including Potomac Growth, Energy Capital Funding Group, Move the Needle with Rob Kaplan, Ridgecrest Herbal, Stakeholder Enterprise, Renaissance League, the Global Equity Crowdfunding Alliance, the National Coalition for Community Capital, Green to Gold, and King's Crowd.
Enter to win one of 2 FireMax 11 tablets. Videos, books, and games come to life. Scan the QR code now.
Rules apply.
Welcome back, everyone. I am so excited. We've got such a great program this afternoon, and it just keeps on rolling, keeps on going. And our next speaker that will be joining me is Frederick Pena. And Fred is an amazing human being. He's the founder of Springport Consulting now, but until fairly recently, he was the president of Angel Funding. a crowdfunding site or a portal, a regulated portal that did film finance, and he helped. I don't know, raise 50 million, $100 million, a lot of money on that portal as they were financing all kinds of mostly family friendly films. They even helped to finance one or two blockbuster films that lots and lots of people saw. So it's an amazing experience that he's had, creating tremendous success, invaluable to the rest of us. So with that, let me bring Fred onto the screen here. Fred, we're excited to hear from you. Take it away, my friend.
Yeah, thanks, Devin. Definitely glad to be here, and hopefully you all hear me all right. Well, as Devin said, my name is Fred Pena. I am actually still, just for a little while longer, the president of Angel Funding. And as he said, it's a niche crowdfunding platform that focuses on film and television productions that are family friendly. And now I am also the founder of Springfork Consulting and Springfork Legal, where I put my experience to use on behalf of companies looking to raise funds through investment crowdfunding. I live here in the middle of Missouri on a small homestead where I get to supplement my office work with hard manual labor. Think digging holes, pulling weeds, baling hay, milking cows, stuff like that. But that's enough about me. Let's go ahead and jump right into the lessons that I've learned. And the first one, you have to. I have to apologize ahead of time. You're not going to like the first one. For all of you watching, the first one is actually that crowdfunding for companies, it's more likely that you would fail at crowdfunding than not. And what I mean to say by that is, you might look at the crowdfunding data in the industry, published by the industry or by platforms themselves, and it gives you a different story. But let me give an example using our platform, Angel Funding, to help you understand. And let's say that there are 1,000 of you here today watching, and all of you wanted to use our platform to raise funds. With our 94% success rate, you might think, great, 940 of these companies are going to be successful. But that's not it. What's really happening is, out of the 1,000 companies that apply, only 10 would be accepted by our platform. That's about the statistics for who would be accepted to even list an offering. And then of those 10, roughly 9 would be successful. So out of all the people who wanted to use our platform, only 0.9% successfully raised funds with us. Now, obviously, that's using our numbers and our rejection rate. The number is definitely going to be different on other platforms, but I know that other platforms also do reject some companies. So there is a vetting process that's happening earlier on. And I do want to give a warning here, because some companies will look at this and say, well, easy, they understand the law, their attorneys talk to them, the platform talks to them, and they know the law. They can make their offering be successful if they set a low offering minimum or a target offering amount. And you shouldn't do that. This is my opinion. You shouldn't do that. You're setting yourself up for failure for your company and for the investors. Potentially setting yourself up for litigation moving forward. And why do I say that? And let me give you another example here. So say you have $750,000 that you need in order to do some growth plan. And you come in and you want to prevent a situation where the offering fails. And so you set the offering low, the minimum low at like $50,000. Well, what happens if you don't reach that? Or let's say you reach the 50,000, but don't get much more than that. What happens here? Well, you might have lost money. It depends on how much you spent on your service providers. but it's possible that you've paid $20,000 to $30,000 for legal and accounting. $10,000 on the low end for advertising, and then you still have to pay portal fees. So if you come out of the offering, you close the offering, it's successful, but you still have no money. It's a loss for the investors. It's a loss for you. You're not going to be able to do the work that you wanted to do because you only raised a little bit of money, and that should, in my opinion, be counted as a failure. So why is it that most companies are in this situation? Let me give some examples again from my experience here in film. In film, it's really easy to tell. We get a sample from every applicant of what they plan to produce and then distribute, and we can tell right away. Is the script good? Is the directing good? Is the lighting good? The sound good? The acting good? Like, it's very easy to tell. And so most people actually get rejected just because of this. It wasn't a good enough product that made people want to invest or even us to accept it. So what about for not film? I mean, you're here, you're probably not doing film. What is it like for you? And what I would say is that, and this is all right here, this is my opinion based on what I've observed, that investors connect most with your idea. For example, if it was me, man, I'd be all over investing in a company who is doing something with ice cream. I love ice cream, and that's what I would invest in. And so I'm already half sold just because I connect with the idea. The next is that you need to have a pitch video that is high quality. Like, the investors need to see that, and it needs to elicit trust because of how high quality it is. If it's low quality, they're cutting off right away. People have that response that they know right away what they're connected with and what they're not. And it might not even make sense to them. They might not know what it was, but if they're not connecting with you as a person who is pitching, like I just noticed in the last presentation, one of the focuses was that they were saying, the founder needs to be the one communicating with investors. And I agree. And they need to actually connect with them. And so that pitch video has to be high quality. Okay. Other important considerations, I think, is your company profitable? Does the plan seem even plausible? Okay. Maybe also who's on your team. You're looking at retail investors who don't know exactly what to focus on when choosing investments a lot of the time. And so they're going off of what connects with them and what they want to see succeed, and this base level of believability. Okay. So I had someone come to me about a year ago who wanted to use our platform to raise money in a field they had not been in before. And it would have been a company from scratch. So no profitability, no experience. And immediately I just knew that this wasn't going to work. This issuer, this founder, was very sporadic in their messaging. Everything was scattered. They just shot out idea after idea, everything that they could say to try to get a go ahead from us, instead of being focused, understanding the profitability, like how they were going to make this happen. Their financials were too basic, so many red flags. Okay, that's the kind of thing that you're looking for, or that you should avoid. So how do you know if this is lesson 2 technically, how do you know if you are one of those ones that's going to fail or going to succeed? And if you haven't already heard the message today from someone else or yesterday, this is done through testing the waters. And this is the embodiment of the idea of musket balls before cannonballs. So if you've heard, the story goes that way back when boats were wood and they were shooting cannonballs, the sailors would measure distance and trajectory first by shooting musket balls, of which there were plenty. And once they zeroed it in, they would then start firing the cannonballs to save ammunition. You have limited cash, most likely. So you need to be doing a musket ball attempt at determining what the market thinks of your offering. So you should hire a securities attorney and someone to do your marketing if you don't have anybody in-house. You should be testing the message, the deal terms, and when you get this out in front of other people who are not family and friends, you're going to get honest opinions, not lies. Let's be honest. You're probably your family and friends are telling you this is great, no matter what it is. All right. So this is the least costly method to get that feedback. And if it is positive, great, you can move forward. But if not, you'd save yourself from a big loss. Now, there is something you can do. Obviously, if you really want to raise money, get consulting, find someone who can help you improve the business, improve the message so that it could work for you. Third lesson, okay, use the right metrics when you're choosing the platform to work with. What I have seen is companies choosing based on things that are more of a vanity metric in a sense, like the total number of offerings, the total number of investors that have gone through the platform. What you should be focusing on is similar projects. What is the total number of investors in similar projects and the total number or the average offering amount from similar projects? And how many of those investors came from the portal? To me, that's the main value of a portal. There are definitely other things that provide value. So go ahead and obviously include those other values in the analysis, but you should be asking for that information, the similar types of projects when analyzing which platform to go with. Fourth, sorry, I think I'm going fast. I think I only have a couple more minutes here. The fourth lesson is a focus on marketing. So we've had a couple of companies come in and fail. One of them came in, they had millions of social media followers. Obviously it's film. So, it's typically they're following a past project, a book, an author, whatever it is. And they think, I'm just going to post a couple of things on social media and we're going to get tons of investment. And that's not how it works. People don't see it. They might see it and it might fail. And so they had kind of a PR campaign ready, or not ready, but like thought out of who they could approach, what they could say. What ended up happening is that the ads that they bought, the messaging ended up connecting more with their haters than with those who supported them. So it took over the algorithm and they ended up spending all their money to get their message in front of haters. And it didn't go well. So the planning has to be upfront and a lot. Just want to reiterate one more time that the quality of your materials matters. So I know that on the last group, there was a couple of people, Jason Fishman, for example, marketing. These are the kinds of people that you're wanting to work with to get your project done. I think, Devin, that's all Fred, that was the backstage if people have questions. Yeah. And I'd love to connect with people on LinkedIn. It's under Frederick Pena.
Yeah, Fred, thank you so much for taking the time to be with us. This is such great insight, and you have a truly unique perspective. I'm so grateful that you shared. Thank you for being here. Again, folks, Fred just said he's going to be in the backstage. Please join us. If you're not a VIP yet, it's not too late to join. 4sc.fund/25. That'll get you to the page where you can sign up to be a VIP. And in 5 minutes, you can be in the backstage. It's not hard. We would love to see you there. And Fred, thank you very, very much. We're excited.
Of course. Thanks, Devin.
Thank you. All righty. Our next panel discussion is one that I have really been looking forward to, and I'm excited to have this discussion. I think this is just going to be vitally important. Let me bring our panelists onto the stage here with me, because this is a great group. DW, I hope you can turn your camera on. We're thrilled to have you all here. Roy, gotta get Roy on the screen. Here we go. There's Roy. Okay, what a great group. I appreciate all of you being here. And I am we're waiting for. Oh, there we go. Fantastic. So, Stephen, thank you for joining. We're thrilled to have you here. Stephen's our moderator, so I'm going to turn the time over to you guys. Stephen, thank you very, very much for being here. I'll let you take it away, my friend. Stephen, it seems like we're having a little trouble. While you're sorting that out, let me invite Bill, Diane, and Roy in that order to introduce themselves.
Hi, everyone. My name is Bill Houston, and I'm the founder at CrowdMax Consulting. And what I do is I help companies raise capital using Reg CF. My focus is on minority communities, women communities, and underserved communities to help them raise capital that they need. What's really interesting about that is that a lot of the times they don't need to raise tremendous amounts of capital. They're able to do the 124 and below raises. So glad to be here tonight.
Okay, I'm next. I'm Diane Santum, and I am the co-founder and CEO of the Local Crowd, which is a rewards-based crowdfunding platform that's designed for local communities. So they subscribe to the Local Crowd, so it becomes the Local Crowd Laramie, Wyoming, or Monadnock, New Hampshire, or Bozeman, Montana, so that each community has their own crowdfunding platform.
I'll go ahead. My name's D.W. Farrell. Can you guys hear me okay? Great. And I am with a company called Localite, and we have a platform for funds and partners called localfund.org. And we are connecting community funds across the country.
DW, you'll want to check your microphone settings. We're not hearing you clearly. We're hearing you. Stephen, go ahead and give it a try. See, are you connected now? Okay, we're still working on that. Roy, go ahead and introduce yourself. Okay, Roy, we're not hearing you either. Need to get a little help there. It doesn't appear to be a muting situation. I think what we've got going there is choosing the right microphone, using your settings wheel under the picture of the group of us, and then checking your microphone to make sure the right microphone is selected. It may have defaulted to a non-existent microphone or a fictional microphone.
Can you hear me now?
Yes, much better, DW. Very good.
All right.
Roy and Stephen, do you want to give us a shout? Okay, they're still working on it. Bill, I know you've been working closely with Stephen on a lot of things in this area, and in some regards, that's what inspired the construction of this panel, is the work that you've been doing with Stephen. Why don't you take a moment to just give us a bit of an overview of the work that you and Stephen have been doing and how that relates to crowdfunding.
Okay, great. So I met Steve about 3 years ago, and we started having a conversation. And as we were talking, he started telling me about his work as a political activist, which was very interesting to me. And then he started talking about these networks that he knew of people who were political activists, who donated time, who volunteer, or who donated money, who volunteered time to to whatever cause they believed in. You know, whether it was social justice, economic justice. And I was really intrigued by that. Right, being a crowdfunder, everywhere I look, I see a crowd. So Steve and I started talking, and we were like, "Wow, wouldn't it be interesting if we were able to reach out to these people who are already activists and take the next logical step and make them financial activists?" And Reg CF allows them to do that, right? Reg CF allows, non-accredited investors to invest. I always like to give a little bit of the history and context there, and that is that for 80 years, over 80 years, non-accredited investors or non-accredited people were not allowed to invest. Then after 2016, they were allowed to invest. And getting the word out to people is really important in order to grow the opportunity for founders, for real estate developers to reach out to these communities. We found that it's very important that people are educated, that they know and understand exactly what Reg CF is, what they're investing in, how to do due diligence, how to look at particular projects. So Steve and I have created the Community Finance Academy. The Community Finance Academy is kind of a dual strategy where we work with issuers, but we also work with people in the community to teach them about Reg CF, to teach them about investments. No advice, just pure education. And so we've been really moving forward and doing a really good job of engaging with networks. And people are really interested in this because they actually do see the power of moving beyond the protest and moving into portfolio. Oh, should I keep talking?
Thank you very much, Bill. And no, let's see. Roy and Steve, give us a shout. Let's test your mics. Okay, Roy, it's not working for you yet. Steve, let's give you a try. I'm still not hearing you. Okay. Roy, I'll give you the coaching that I gave Steven. Why don't you pop out and pop back in, see if that'll reset your mic. If that doesn't work, you may want to try rebooting your computers to get the full reset going and come back. Well, we're excited to have you. In the meantime, I'll ask Diane to explain how she's been adapting her rewards crowdfunding site to facilitate some activism from her desk.
Yeah, well, thanks, Devin. And so, like Bill was talking about, people wanting to get involved with activism, which is people, um, helping people that have been marginalized, helping people that are targeted, and there's what I call the new localism. Like localism, when we started the local crowd, was really helping communities help themselves, help businesses with non-dilutive funding be able to get a new floor in a restaurant, or a new machine for a coffee shop, or different things like that, where they don't need a lot of money, but a little money was very helpful. And so that was our vision of, really helping communities do barn raising for each other. And now I'm seeing also a desire for an activism look at providing mutual support. And it's also called dual power, that when you see people that are marginalized and they're needing things, and some of the safety nets that we've depended on for a long time in this country are going away. And so community groups are getting together, little pods of really wanting to support each other. And so one of the things that they need often is money. So these a locally based crowdfunding platform can be used to support this kind of stealth activism in a way.
That's brilliant. That's brilliant. It's exciting to see that. Now, DW, you are maybe you wouldn't use this word, but I would think of you as kind of an activist investor. You have a strong social agenda with the work that you're doing with Local Fund and Local Light. Tell us a little bit about how. Oh my gosh, we lost DW. We're this. We're not having the luckiest hour, are we? Bill, let's go back to you. You and Stephen are kind of working in the DC area a lot. You've got a serious presence there. I think you see some opportunities there. Tell us a little bit about how you see this potentially coming together in DC, particularly.
How about, Devin, I switch that up a little bit and I talk about the opportunities that I see here in my home city of Louisville.
That's a much better idea.
Yeah, because there are some really great opportunities here in Louisville. Right now, I'm working with a project called Gateway and the Seven Bridges, and it's the 7th Street corridor, which has been ignored for a very long time. And some of the opportunities, the developer that I'm working with we actually got a Reg CF set up, testing the waters, and we're actually doing a pretty good job of getting to that inner circle and getting people to come on and invest, or make reservations into testing the water. That's been really interesting. Um, and when I think about or talk about the activist movement, 2 Fridays ago I went to an event called the Bishop's Table, where a lot of people gather in the West Louisville community, and they have discussions about issues going on in West Louisville. So there are two really large opportunities. There's an investor, I'm sorry, a developer who is looking to actually bring the community in. He received a grant for $1 million to bring people from the community in to help talk about, what their project was going to be. It was an affordable housing project. And what was really interesting about that, when I had the opportunity to sit down and talk with him, is he knew nothing about Reg CF. He knew nothing about the opportunity to let the people in the community actually invest in this project and not just talk about it. And again, I think that's really a part of the power of what's going on with Reg CF. And a lot of people here in Louisville are really excited and they're really interested in the education that we're providing. And the last opportunity here is, there's a building that was owned by the bus company, and the building is they're ready to sell the building. They were going to sell it to one group, and a lot of the people in the community came out as activists, signed a petition, like 25,000 people. They signed a petition because they didn't want it sold to this particular group of developers. Well, now there's a strong conversation around those same 25,000 people being willing and able to invest in a Reg CF to actually purchase the building. It's a commercial building and it's under $5 million. So that's a real possibility. And people are fired up, they are excited, and they're interested to learn because they see the power, the empowerment, and the activism that is really embodied in Reg CF at the local level.
Yeah, that's brilliant. Now, DW, let's try you again. Tell us, if you can, how you approach this, your agenda, because I think you have a strong agenda with your investing. Tell us about how you're approaching this.
Yeah, so, and I'll pick up what Diane said earlier and Bill's kind of touched on, thinking in terms of where the broader population is. A lot of people are just not aware that they can move their investment from Wall Street to Main Street, or even get into the market. So just, she mentioned localism, and I kind of think of, moving people from apathy to awareness, that they can think different about their local community, that they can move from being a renter and move into ownership, or what we call anchorship, and really equipping people with a mindset that they can invest in their own community. And so, as Diane mentioned, stealth activism is one way that we can participate. That means kind of, using your position and connections to do something that's going to be challenging or regenerative. But there's also proactivists, where seeing systems that are broken. Like, I'm very critical of private equity, and one of our speakers today, Brian Christie, spoke about stakeholder equity, and that's really, they coined that phrase with his organization, but that's really what Local Fund's built around, is this idea that we can be stakeholders, not just building enterprises for shareholders, and Morton Friedman's idea of shareholder primacy, but instead that we can be building up wealth within communities that actually turns into legacy, turns into futures that turn into liquidity, that someday you can cash out, that you can pass along to your next generation. So the opportunities, not just with Reg CF, with Regulation Crowd Fund, but even outside of that, there's reward crowdfunding that Diane mentioned. There's bonds, like worthy bonds, and you and I are both big champions of proactive bonds, which is just launching another round, and they have a guaranteed return that is rated by Morningstar. That's not gambling. That's not crypto. That is putting money into your future that unlocks others' legacy. It's great.
Yeah. Roy, let's see if we can is your microphone working? Say hello. Oh my gosh. Roy, you worked so hard. I know you invested heavily in being prepared for this, and I suspect the glitch is in our Wave studio, and I'll reach out to tech support for a little support, see if there's anything they can do to help us get the audio working for you and Stephen. But Bill, why don't we let me invite you, Roy and Stephen, hang on. You've got almost 30 minutes left, 24 minutes left of our discussion, so don't leave. But Bill, maybe you could take a minute and tell us more about how you guys are thinking about the intersection of finance and activism.
Yeah. So what we're thinking about the Community Finance Academy is number one, collaborating with networks, right? Not just reaching out to other people who we don't know, but actually collaborating with networks that we do know. We've been able to have some really good conversations with activists, with people who are doing funding, with CDFIs, people who are looking to deploy funds into various communities, especially underserved and disinvested communities. And the reason, we're really looking at them is we see Reg CF and the financial activist movement as a real opportunity to bring the people who are on the ground, actually the people who are living the problem, right, and looking for their own solutions, to allowing them to do some community-led economic development. And once they have that community-led economic development, bringing on some larger funders who are really interested in impact and doing a really good job of bringing change to these communities. So when I talk about impact, it's really important to understand, for us anyway, it's really important for us to have, to have impact, to understand exactly who we're helping, how we're helping, and having those stakeholders is really, really important. I want to talk really quickly about Diane, and she's doing rewards crowdfunding. And I know this is an investment crowdfunding show, but I will tell you that I worked in 2023 with Fund Black Founders. And again, right here in Louisville, Kentucky, and we worked with 15 Black-owned businesses. We took them through a coaching program that lasted about 3 months. And one of the biggest businesses to come out of that was called Black Coffee. And it was a coffee shop, still is a coffee shop. They've actually opened their second location, here in Louisville. They're doing really, really well. And the reason that resonates with me really quickly is, when Opportunity Zones first came out, I was speaking with some people about the West Louisville Opportunity Zones, and they wanted to meet with me, and they said, "Why don't we go to a coffee shop in West Louisville?" And I said, because there are no coffee shops in West Louisville, right? I mean, we could go to McDonald's in West Louisville, but there are no coffee shops there. And, through rewards crowdfunding, there are now two Black-owned coffee shops in West Louisville. And again, for me, it's always the power of doing. Doing and showing. When I was a kid, my dad used to tell me all the time, there are two kinds of people in the world: talkers and doers. And it doesn't take long to get figured out which category that you fall into. And I think that as far as activists go, being able to take that next step into financial activism is an obvious way of doing.
That's great.
Black Coffee does a great job also merchandising their brand too. They also have jackets and all sorts of fun products with Black Coffee.
Diane, what would you like to add to the discussion?
Well, I appreciate that, recognition that it is an ecosystem of funding available, and that rewards base is a piece of that. And like when you talked, Devin, early on, we had the conversation about Tampon Tribe and started, and they raised a lot with CF reg crowdfunding, but they started with the rewards based, and so it really is part of the ecosystem, and it is non-dilutive, so it's a really good way to get started, and definitely, you know, a local tool.
And that local activism is really, in a way, the heart of that the power of crowdfunding, isn't it? And DW, I think you see that, right, with your focus on local communities nationally, right? I think that's the dichotomy of your work, is trying to find ways to support local action across the country, right?
Yeah, well, you know, the thing we remind ourselves of is community is opportunity. And at a local level, that's absolutely true. If you think in terms of economic development, there's a framework called ABCD, which is asset-based community development, where you say what already exists here that's already been developed, and can be supported. And it might be an existing business, it might be, you know, people in the community, but how could that be packaged also to attract additional funding, outside funding, non-voting funding? You know, if you brought on 49% of your you know, cap table as external money, and they're passing along the voting rights to the stakeholders, then that allows for the effective cost of what they're developing to be cut in half. So to your point, to your question, you know, local is a bit of a mindset, but also if each of our work is separate and siloed, then we're not really seeing how we can really leverage each other, support one another, do playbook sharing. You know, what worked in Louisville could be brought over to Cincinnati. What worked in Long Beach or in Georgia, a couple communities that we work in, how that could be brought into DC. So, you know, playbook sharing is a really important thing. Making sure that the pathways that have worked, regulation CF honestly is kind of an expensive route. There's much lower cost pathways. Local Fund provides one that for qualified founders is $0. So we want to see more of those opportunities for packaging entities that are adding value, creating value. They're not extracting from their communities, but they're building their communities.
That's fantastic. I appreciate that, DW. Tech support, by the way, Roy and Stephen, the tech support suggests that there is a tool in there to test your microphone. So I encourage you to try the microphone testing. See if you can get those little green bars to start popping across the screen, and then come back to us. I find that sometimes it won't work until you do the test. So try that. Be sure to click the test button on the microphones there. Bill, let's go back to you. Why don't you give us a little bit of an update on the work you're doing with CrowdMax, and maybe how your activism also relates to your work for the Rancho Affordable Living, proactive affordable housing efforts there.
Yeah, absolutely. I tell you what I do at CrowdMax, thinking about the activism, you know, working with Proactive Realty Group and Dr. Kanan Van Williams, it takes it to the next level because he is all about community. That work is all about impact. It's all about measuring impact. It's all about understanding the impact and looking at the outcomes in the community. So the work that I do with Proactive, especially with Rancho, is really exciting to me because it's all about the impact in the outcomes and how people's lives are changed, not just the number of units of affordable housing, but how that affordable housing impacts the outcomes of people's lives. there was a video story that you can see on Proactive's YouTube channel that was very interesting to me, and I mean it was really heartfelt. There was a young man who had come to Dr. Van, and he was looking for a place to stay. He had just had his pay cut, and he had lost his family. They had to go stay with other people, and he came to Dr. Van. Dr. Van worked with him on the rent to allow him to have a place to stay that was affordable for him. But not only that, he provided him with some employment, and that employment allowed him to bring his family, back together. The children, the wife, they were all able to come back into the house. And activism doesn't get any better than that. A lot of times we think of activism as people out protesting these major issues. What I see with Proactive, with Rancho Affordable Living, and the work that Dr. Van does is that he looks at it from a person by person opportunity, right? It's an opportunity to impact the life of every person who rents from him, from every person who is in that community, every resident, and how you support people outside of just putting them in a house, in a home, building a community, making sure the community's safe, making sure there's a level of dignity there. Working with Dr. Van has been really exciting for me because of his focus on the individual and the focus on people's outcomes and social impact. And that to me is real activism.
Can I jump on that, Bill, and kind of build on it? Because you mentioned opportunity and then earlier opportunity zone. And, I think that's something that I'm most excited about is recently the opportunity zone program was made permanent. And it also has been expanded to allow for 30% capital gains to disappear after 5 years. But if for people who are not familiar with it, opportunity zones exist across the U.S. You can look up online maps in your own community, your own city, that have been designated as areas that, based on the data on the area, they're ripe for investment. And I call it the opportunity gap. And it had been also called over the last decade the displacement zone instead of an opportunity zone. In other words, gentrification displacement. And yet there's groups like ours, like what Dr. Van's doing, that are saying, hey, wait a second, we can invest in this opportunity gap, in this opportunity zone. And for folks that are moving money from another asset, there's capital gains tax, typically 30%. They can see all the capital gains be wiped away if they move it into a qualified opportunity fund, and which we support. And what's really amazing about that is the money for investing doesn't have to just go into the property. If a business, small business, growing, scaling business, is producing at least half of its revenue, even online revenue, on that opportunity zone property that's already gone through the qualifying event, they can attract that investment and can go into the small business, to the enterprise. And now you have a really strong incubator for a community to leverage that property to bring value back to people who are taking the risk to pull it out of another asset. Maybe they sold a house or something like that, and put it into property that's going to increase in value. Like Dr. Van, the most recent project he did was a $1.5 million property that within 6 months, the new appraisal was $3.5 million after his proactive team did their work. That's phenomenal. And can then double down through our model to turn that into an incubator for independent businesses, for scaling enterprises, with additional capital gains free investments. It's really remarkable when you line these things up.
That really is inspiring. I appreciate you sharing that. I want to learn more about
capital,
that.
DW. It's patient capital. It's going to have to sit there in order to get those gains, and that's what's really important.
5 to 10 years. Yeah. Yeah. And that's why it's not gambling. This is about actually investing into stewards that were going to turn that into value. And especially when it's tied, when you're talking about being backed by real world assets, property, even IP, like, part of Black Coffee's value proposition is their IP. They're also producing other product. They're roasting their beans. They're selling to restaurants nearby, and that's a local business, right? It's not just property, but building up that IP as well.
Diane, let me ask you something. As you think about, this idea of activism and pairing that with supporting businesses, whether we're talking about, local crowdfunding, rewards crowdfunding, investment crowdfunding, the fact is we're talking about supporting typically small local businesses with some sort of investment, let's call it, but including in a rewards thing where you're buying something, even if it's future products like your interesting rewards
Right.
that you've created. How do you see that aligning with this goal of changing the world, making a difference? How do you pair those two in your mind? Because I know you do.
Yeah, absolutely. Because, like Michael Schumann said earlier today, that planet saving is going to come from crowdfunding, and I think there's a lot of saving that and changing that comes from crowdfunding, and in the way of really, really local. That when you are connected with your community, you recognize what the needs are, and then you can activate your friends and family in that community to support that. And so there's a concept called dual power, where we recognize that power doesn't just come from above and regulations and the government, but that people have the power. And so crowdfunding really puts an emphasis, an exclamation point on that. It's like, okay, if I want to make sure my neighbor is safe, then how do I do that? And when I need funds to make sure that my neighbor is safe, how do I raise them? And so that's kind of how I see, in a real change is in our world comes from people caring for each other. That's when we're at our best. And so that's where I see crowdfunding and changing the world is it gives us a way to do that exponentially.
Yeah, I see your point, and it is powerful. Uh, I'm nervous that we may not get Roy's microphone working, so I want to just pause. Roy, do you want to yell at me for a second and see if it
Hi,
works?
can you hear me?
Oh, there he is.
Yeah, look at that.
Okay.
Hey, you made it work. Thank you for your patience with that. I'm not sure what went wrong, but I apologize for not making that easier. Roy, take a minute now and catch us up with your thinking on this topic.
Sure. My name is Roy Allen. I'm with Pathways to Equity. And we focus a lot on legacy businesses. Business has been around for a long time. And if you think it out, we have land trusts to protect open space. We have land banks, real estate that's been around, historic real estate, but we often don't have community asset trusts to preserve established businesses when the owners retire. So baby boomers perhaps don't have exit strategies. Young people don't have entrance strategies. And the young ones can't learn overnight. It takes time, just like it takes time to take an intern or apprentice carpenter or make them a master carpenter. It takes time to train a young person how to become a community leader and take responsibility for producing assets. Like, for an example, in Ithaca, New York, our group just took over a 50-year-old legacy newspaper business that someone had run for 50 years and didn't have an exit strategy. And just because the market was in a strange cycle and wasn't being kind to print media doesn't mean that there wasn't goodwill in that particular business that had been around for 50 years. Go back to patient capital. There has to be a mechanism where instead of just trying to connect the young ones to the older ones, you actually take responsibility for preserving that business until the young ones are ready to take it over. And at the same time, if a boomer is retiring, they can't risk all of their retirement on perhaps some young person can figure it out. That's not just the retiring person and the young person's responsibility. It's a community responsibility. So we found that while we thought sometimes our job was to introduce the young ones to the older ones, it really was about preserving local wealth, community wealth. When a business starts, the entrepreneur is the asset class, but when it's been around for 50 years, the business is the asset class, and protecting that asset class is really important. If we go back to this theme of activating the activists, training advocacy or turning advocacy into action, I do this thing twice a year, which is helpful to me, and it's a sort of a procedure about, are my actions matching my intentions? And when you talk about local advocacy, are we getting behind the people who are practicing the advocacy we seek? Sometimes we want to be the stars, and sometimes we just need to be sidekicks and help the people that are already out there doing great work, whether it's black coffee or whether it's, I live in Rochester, New York, and the AAA ball club there, the Rochester Red Wings, have been owned by the community since the 50s because one guy stepped up when the Baltimore Orioles wanted to sell the team. And he said, if we raise the money, would you sell it to us? And that was a big deal back in the 50s. They raised $500,000. That millions of dollars of local sports money has stayed in Rochester, is still owned by 4,000 shareholders, and the community stepped up and took responsibility. But you had to have one guy that stepped up and poked at everybody to get them to do it. So I think it's, advocacy, public policy is a wonderful thing, but you got to activate it. It's important to get behind the people. And I think Bill was talking about people that do and people that watch. Perhaps I don't know the exact language, but in Texas, they say all hat and no cattle. Okay. So, it's important to, I'm fortunate to be on this call. I met Devin a couple of years ago. I met Michael Schuman a couple of years ago, and they've been just great to me. I'm just, one guy from Rochester, New York, and this whole community you put together is just, it's delightful for me.
Well, Roy, thank you very much for being here. Stephen, let's see if we can get a shout out from you before we wrap up. Is your mic working yet? Well, Stephen, thanks for the wave. Let me just tell you a little bit about Stephen. Stephen is a social entrepreneur who merges expertise as a housing developer, community organizer, political activist, and grassroots strategist to improve neighborhoods and initiate solutions. Based in D.C., his proximity to Capitol Hill has allowed him the privilege of engaging in both local and national justice projects and networks, and his community organizing and leadership have contributed to the founding, funding, and advising of numerous nonprofits. Prior to forming Community Vision Solutions, his company was responsible for over $100 million in housing and community development efforts within several underserved Washington, D.C. communities. From this experience, he discovered that revitalizing underserved communities is a multi-billion-dollar opportunity waiting to happen, as well as a moral and economic imperative. Stephen, thank you very much for being with us. I'm sorry that the mic didn't work, but we appreciate all the preparation you did to organize and prepare the panel. Roy, again, I apologize for the difficulties with your mic, but glad you were able to get a word in. Bill, Diane, and DW, thank you so much. Great conversation. This has really been a wonderful, wonderful 45 minutes, and I appreciate the insights that you delivered. It really was valuable for all those who were able to tune in. With that, I'll thank you very much for being here. And we are now ready to kind of move on to the next phase of our conversation. We're going to we're shifting gears to the live pitch. One of my favorite parts of any super crowd event is the live pitch sessions, and we had a great live pitch session yesterday. We're back. Let me introduce our host for the live pitch. Our live pitch host is Chris Miller. He is the CEO and board chair of the National Coalition for Community Capital. And there really is no one in the country that is more passionate about working to see the local communities enhanced by the structures we're pursuing here, including, and not just exclusively, but it's certainly including crowdfunding as a tool. And Chris has become a friend of mine. I know he's an active investor. He and his wife, I guess technically his wife, started a business, raised the capital for it via crowdfunding. And so he's got the expertise, the experience, on both sides of the ledger. Just a great guy. Chris, I'll let you introduce the judges and run the show from here, okay?
It sounds like a deal, Devin. Thank you very much. Hopefully we don't have the kinds of challenges that the last group did. Boy, hopefully all of that stuff was in the last group. But in any event, it's great to be here today. Really appreciate all the work that Devin and his team has done to bring this group together. Just a ton of really incredible content, applicable in the U.S. and across the globe, really. So super excited for this. And the pitch event sure is always cool and always fun. I don't think there's anything as much fun as a live pitch event, whether it's a Shark Tank or a group of lambs. Either way, it's really interesting. And we get to see, for me, the most exciting things that happen in our economy are all about entrepreneurs and the innovation, the new ways they see to slice and dice stuff. So super excited to be here, very thankful for the opportunity. And I have this incredible panel of expert judges, I think probably unparalleled on the planet right now, the team that's in the room with me, not including me, definitely focus on them. So Leo, if you would start and introduce yourself to the group tonight, that would be terrific.
Thank you, Chris. Happy to be back today. I'm Leah Bollier-Gautreau, Senior Investment Associate at KingsCrowd. And so what I do at KingsCrowd Capital is that I basically look at the most interesting med, climate, social deals, and we invest in what we believe are the top 1%.
And I'm such a fan of KingsCrowd, Leah, and the work the team does there. It's such a great reporting mechanism, a great synopsis of what's happening in the industry, and so really appreciate that. So Woody, let's jump to you next. And again, yesterday I said that if you don't say enough cool stuff about yourself, I'm going to jump in and say it. But let's just say we're all really glad that Woody's in the room with us today.
Thank you. That's I'm humbled. Woody Neese. I am with Crowdfund Capital Advisors. We did write the framework for investment crowdfunding, so I know that's what Chris is talking about. But there were many people that got this across the finish line, so it's teamwork. I wrote a book called Investimers that takes 15 years of work. It's 400 pages long. If you want to go to sleep at night, this is actually, the winners are going to get it. So, but it's the entire reason for why this industry exists from essentially our point of view, the work that we did with the World Bank. We are very focused right now on why institutional capital should be paying attention to this. I just was speaking at the Keiretsu Forum in Seattle to family offices and angel groups across the country, getting them focused on it. And that's where my attention is. Other than that, it's in Washington, D.C. to help get the cap moved to 20 million and then help, improve the industry however I can.
Oh, that's fantastic. And I do want to note, and you did say good stuff about you, so I'm glad for that. But I do want to note just that idea of reaching out to the foundation world and family offices and that sort of thing. And we're doing a lot of that work in the individual funds that we're setting up. And we are finding such receptivity in that space because I think we all want to make a difference in the place where we live. And that is fundamentally more challenging. We've had such an exit of the ability of a local community to control what happens in their community, make decisions about what's built, the kinds of restaurants and businesses and how houses that are built, et cetera. So bringing that back in is really important, but that capital has to be married with form-friendly capital from outside in order to accomplish the things that need to be accomplished, especially in our really challenged communities. So terrific. I'm lovely that you had an opportunity to present to them. I know that good things will happen from that seed planting. And speaking of seed planting, I did that pretty well, right? Paul Lovejoy, just an amazing seed planter, doing incredible stuff all over the place. Paul, introduce yourself.
Yeah, my name is Paul Lovejoy. I'm the principal advisor at Stakeholder Enterprise. We specialize in crowdsource investing, and we make impact financial planning accessible. And I'm thrilled to be here. I'm a huge fan of your work, Chris. I have such respect for both Leah and Sherwood, and just doing these events is just such a highlight for me. I learned so much, especially today that I got to do due diligence on 3 healthcare companies. And it really opened up my eyes to the industry, and I'm excited to kind of share what my due diligence revealed.
That's fantastic. And judging on yesterday's due diligence, I hope our pitchers are ready because there were some really great questions that were asked. So be ready. All right. So I think we're ready to go. And that's going to require the big boss, Devin, to bring our first contestant into the room. Fantastic. Great. So this is Diana Tucker from Senogard, and I've actually been privileged to hear a bit about your project and the work that you're doing in an incredibly important area. And so please take it away. And I think Devin is at about 8 or 10 minutes that they've got. I don't know, but I know that number. But I know that Devin will show up when you get near the end, and he will be scowling. So be prepared to end when he does that.
5 minutes. So I'll pop back in when you've got 30 seconds left.
Alrighty. Thank you, Devin. Take it away.
Hi, my name is Diana Tucker. I'm the CEO of Senogard, and we are developing a non-radiation way of treating breast cancer. My career has been bringing non-existent medical products to market. And the way I've done that is I've been passionate about the need for them to be there. But I've never been as passionate as I am about this one. I can't help my passion. My mother had breast cancer at a very early age, and she's very active, and she ended up dying from heart disease. And the heart disease was caused by the radiation that they gave her following the breast cancer surgery. So here we are. We have breast cancer as the #1 cancer of women. It's the most expensive one to treat. But yet for 45 years, there's only been 2 ways to treat it. You either remove the whole breast, cause a mastectomy, or you excise the tumor, a lumpectomy. But if you do that, you need to use radiation to kill any remaining cells that might have been left behind in the tumor cavity that could cause a recurrence. So we've developed, first going back into all the other bad things about radiation therapy. It's weeks of daily radiation treatments every single day, except Saturday and Sunday. It's clinically and cosmetically toxic for the woman. It's not available for everybody. It's either too far away or too expensive. Some women actually choose a mastectomy the minute they're diagnosed just because they want to avoid radiation. And now here's a kicker. 20 to 25% of women today do not have their annual mammogram because they don't want either a mastectomy or radiation. So this boils down to about 28% of all the women that could qualify for a lumpectomy not being able to get it because they live too far away, they can't afford it, they can't take that much time off of work. 33% of the women who start the radiation drop out. And for them, it's a 17% increased chance of getting a recurrence. So Centigard has developed a way around all these problems. We call it intraoperative cryoablation. Instead of zapping extraneous cancer cells with radiation, we literally freeze them to death. And the way we do that is during the lumpectomy, the surgeon excises the tumor, immediately inserts one of our probes, puts the probe to a really super cold temperature, and freezes any cells that might be left behind in that surgical cavity. He removes the probe, sews up the woman, she can go to work the next day. So this eliminates all the radiation toxicities, and the more important is it eliminates the radiation team. It's not just radiation oncologist that does radiation treatment for breast cancer. It's his associate, it's a technician that manages the isotope. And this package of people is not only expensive, but they're rare. You don't find them in every city. You'll find them in medium to large cities. So the fact that our procedure is about 50% of the cost, plus you don't have to have radiation, makes us available in any hospital, rural, community. And now we can serve our own patients in our own community hospitals, which is where the patients want to be treated. National Science Foundation had us do a market research, and we found that 100% of community hospitals that we surveyed that did not have a breast cancer care because they couldn't afford the radiation and couldn't have access to the radiation oncologist would adopt our program. So here's what we've developed. We have a refrigeration unit. You put one of those in each hospital. And then we have a series of different sizes of probes because every tumor is a different size. You insert the right size probe into the tumor cavity and you freeze it, and you get like this little blue ice ball that freezes the cells around that tumor cavity. So far, we've raised $1.25 million undiluted funding with 2 different awards from the National Science Foundation. Our next award from them will be that they will match any private investor fund 50%. You invest in $100 in us, the NSF will put $50 in. Our test results have been phenomenal. 45 minutes was the minimum acceptable. We've done it in 10 minutes. We have market validation from patients and surgeons. Now is the time to move treatment away from radiation and into your community. It's the right thing to do for every woman you know.
Great. Thanks very much, Diana. And we're going to turn it right over to the judges. Do I have a volunteer? You're dying to go first. All right. Leah, you got it.
Diana, so great to hear you again. So what I want to hear right now, after understanding how your product works, what's the problem that you're solving, is where are you at in terms of development stage? I know you say you tested it in animals, but we're talking about dead animals, live animal. What are the results and what are the next steps? What is the grant going to help you achieve in terms of testing the product?
Our next step is to go into live animals. And right after that, we'll either go into a human clinical trial, or we'll go into human mastectomy trial. And it depends on the FDA. We anticipate that they will allow us to do a human mastectomy trial with just a handful of patients who've already elected to have a mastectomy, but they'll do our procedure first, and then go immediately into a controlled, non-clinical 510K clearance for certain breast cancer tumors.
Terrific. Thank you very much. Woody, what would you like to ask Diana?
Yeah, sure. Diana, amazing job. Fascinating take on this space. I have my neighbors dealing with chemo and radiation right now for a form of cancer. So I'm in touch with the effects of it deeply. I'm listening to this. Anytime I listen to these, I'm hopeful. Like, I want this to work. Okay. And what I love about this entire industry is the seeds of innovation here are just spectacular. So what you're working on, I'm praying that that this achieves the results that you believe it will have. That's where my question is can you talk a little bit about the equivalency? Oh my gosh, I can't even speak anymore. How this performs next to radiation? Like, have you proven that this is superior to radiation? Tell me a little bit about those tests there, so I can understand that from that point of view.
Exactly. Well, cryoablation has been around in medicine for 20 years. And we've proven that it kills cancer cells. We've proven that it kills breast cancer cells. But we've never had the power to kill breast cancer cells that are in a surrounding cavity. Like if you had a beach ball, we only want to freeze the cells that are around the outside of the beach ball because we've excised the tumor that's inside the beach ball. So we now have this patented, we've got 33 patents. That's called supercritical nitrogen. It's the most powerful cryoablator you could have. And our equivalence is that there is a company right now killing breast cancer cells directly in the tumor, in the breast for women. Here's the issue. It's only very, very tiny breast cancer tumors, usually ones that you don't even find on a mammogram yet. I love the company. They're doing a great job. I talk to them a lot. I think we'd make great partners, but they don't have the power to go beyond that particular size. So that's what, and the other market research showed that women prefer to have the tumor removed. When you freeze it in the body, you leave it in the body and it shrinks over time, about a year, and it goes away. Women they have a hard time with that. They're running in for a mammogram every other month to make sure it's the dead tumor. So by letting the surgeon excise the tumor and just killing the tumor cavity where the residual cells might be lurking, makes everybody happy.
Great, thank you.
Terrific, thank you very much, and appreciate the question, Woody. Paul, it's in your lap, sir.
Yeah. Hi, Diana. Women should be able to keep their breasts. I support this. The access problem you're solving and the fact that cryoablation has been FDA approved for multiple cancer applications since the 1960s gives me confidence that this isn't experimental technology. However, I am concerned about premature adoption driven by marketing rather than evidence. You mentioned that 93% of patients would pay out of pocket to avoid radiation. And your materials emphasize that surgeons will attract more patients and hospitals can capture revenue instead of referring out. How do you plan to prevent hospitals and surgeons from adopting this technology for economic reasons before you have clinical data proving it's equivalent to radiation therapy? What safeguards are you putting in place to ensure patient safety during the adoption phase, especially given that desperate patients might choose an unproven alternative over proven radiation therapy?
Great question. We have shown that we can ablate 1 centimeter deep, and that's exactly the depth of radiation right now is 1 centimeter deep depth. And we do the exact same thing. We've shown it many, many times in testing. So we're killing the same degree and the same amount of cancer cells that the radiation is without these toxicities. The other safeguard is the FDA. They are super, super, super strict. We will have to jump through the hoops, we're happy to, that they require in order to make this safe and effective. We will start at one center and really monitor those patients closely before we go out to other centers. Each center will have one cryogenerator placed, intense training with every surgeon that's going to be using it. Our people will be there for the first and second at least the first and second use of it. And we're going to have ongoing webinars where the surgeons can get together and say, did this ever happen? Have you seen this? What do you do? So we're not going to just put it out there and run. And we're also going to, part of the training of the surgeons is which patients to start with. We're going to make sure that they start with the lowest risk, I don't want to say the easiest, none of this is easy, but the best candidates. So that's our game plan. We're also going to have, I'm sorry.
So really terrific. And like Woody, I think we all want this to work. So thank you very much for that important work you've done. Thank you, judges, for great questions. And the best of luck to you, Diana, with your work.
Thank you.
Alrighty. Next up, Scott Aldrich. Are you ready?
There we go.
All right. Awesome. So far we are, I shouldn't say this, but we're glitch free so far.
You just jinxed me.
Just jinxed me. But that will be on me, not on you, Scott. Once again, we're staying in our theme this evening on really remarkable innovation in health, and we're excited to hear what you have to say. So introduce yourself and go right into your pitch.
Fantastic. So my name is Scott Aldrich. I'm the CEO of EndoSound. At EndoSound, we are redefining access to one of the most powerful tools in gastroenterology, endoscopic ultrasound, or EUS. EUS combines white light endoscopy with ultrasound we all know. EUS is a vital diagnostic and therapeutic technology considered the standard of care for evaluating diseases of the esophagus, stomach, duodenum, liver, pancreas, and gallbladder. It plays a critical role in detecting cancers and cysts and other conditions earlier and more accurately than other technologies. But today, the technology is out of reach of far, far too many. But why is that? Well, traditional EUS systems are prohibitively large and expensive, costing hospitals upwards of $500,000, requiring specialized rooms, and often needing a dedicated staff. That means access is largely restricted to major academic centers and urban hospitals. The result of all that is a technology that could be everywhere. It is, in practice, available to only a fraction of patients. So our solution, which is stemming from a serendipitous meeting between our founders, a therapeutic gastroenterologist and a serial entrepreneur who is developing an ultrasound probe that fits on the tip of a finger that's used for military use. But the combination of those two minds created EndoSound. And we've developed a groundbreaking innovation, a system that converts any gastroscope already found in the GI lab into a fully functioning EUS scope. It's modular, cost-effective, and designed to integrate seamlessly into existing workflows. With our solution, physicians can perform EUS in ambulatory surgery centers, so outpatient centers, as well as community practices. There's no dedicated rooms, no massive capital equipment, and no compromise on image quality at all. In essence, we're democratizing EUS. Our go-to-market pricing is simple. EVS is a fraction of the price of legacy systems, and there's a price per procedure for the disposable component, which offers a substantial recurring revenue model. We've already had over $1 million in revenue and have independent repeat revenue customers. And it's not just us saying that. Some of the top voices in gastroenterology are in our corner and are our strongest advocates. Given a few quotes here that you won't be able to read in time, but we've got a lot of big names on the list. But we were also awarded the Breakthrough Device designation from the FDA. It's a recognition given to technologies that offer significant improvement over current standards. We also received a transitional pass-through payment, which is a code from CMS, which accelerates reimbursement and adoption. In 2023, our innovation was also named the Innovation of the Year Award by both the AGA and the ASGE, two of the largest and most respected GI societies in the world. The AGA also, with their innovation fund, became an investor in our Series A. But this isn't all about cost, it's about equity. Access to life-saving diagnostics like EUS shouldn't depend on your zip code, your income level, or whether your hospital has a seven-figure equipment budget. Right now, too many patients in rural and underserved communities are left behind. They wait longer for diagnostics, they travel further for care, and they often face worse outcomes. At Endosound, we're changing that by lowering the cost and the footprint of EUS, making it accessible in ASCs, ambulatory surgery centers, and community GI practices across the country. And if you look at things globally in underserved countries, the opportunity to leapfrog legacy technology is even far greater. So the market opportunity. There are 700,000 EUS procedures performed annually in the United States, almost all concentrated in those hospitals in urban settings. By enabling procedures in the ASCs and community settings, we are already taking meaningful share from legacy system providers. We also unlock the potential to do EUS into index endoscopies, or the initial upper endoscopies done, the first line of scopes done for dyspepsia, abdominal pain, or surveillance. But by doing endoscopic ultrasound at that endoscopy, we're adding imaging of liver, gallbladder, pancreas, and screening to routine exams. That's how we move from 700,000 procedures to millions, and from an elite tool to a mainstream diagnostic. We're making EUS affordable, accessible, and universally available, and that's what Endosound delivers. We're proud of what we built and even more excited about what we have ahead, where if you're looking to invest in a proven innovation with clinical validation, strong reimbursement, tailwinds, and a mission grounded in both health equity and global impact, we'd love to talk.
Terrific presentation, Scott. What a really great use of innovation. And I think everybody in the room loves the idea of democratizing because we're in that business. So not health-wise, but I got a feeling the panel will have some really great questions. So Leah put her hand up first. So I'm going to give Paul and Woody an opportunity to who wants to ask the first question.
Well, you want to go?
I could go ahead if that's okay.
Yeah,
for sure.
Great, Paul.
Hey, Scott. First off, thank you for working on such an important problem with such innovation. As Chris said, democratizing access to EUS technology is genuinely important for patient care, especially in underserved areas where patients currently can't access these diagnostics. My question is about the implementation nuances of this expanded access. EUS is a technically demanding procedure in gastroenterology, requiring extensive fellowship training and hundreds of supervised cases to achieve competency. The ability to identify subtle pancreatic lesions, interpret complex ultrasound findings, and perform safe interventional procedures represents years of specialized training. I'm particularly concerned about the financial incentive structure. EUS procedures reimburse significantly more than routine endoscopy, creating strong economic motivation for surgical centers to adopt this technology. Without robust training requirements and quality oversight, there's a risk of inexperienced operators performing complex procedures they're not qualified for. In the case study you provided, there was a misdiagnosis by a GI doctor, and the one from the legacy hospital with all these specialized credentials was able to accurately identify the problem. While I love democratizing technology access, how are you addressing the competency and training requirements as you scale? Do you have partnerships with academic centers for structured training programs? How do you ensure that expanded access doesn't compromise the quality of care that EUS is supposed to provide?
Paul, that's a great question. And it's certainly one we've given a lot of thought and action to already. So first of all, you have to be credentialed in order to do endoscopic ultrasound. So there are only a great number of, but there are a number of physicians that are qualified and credentialed to do endoscopic ultrasound. That is our initial beachhead market and targets. The majority of physicians that do these procedures in hospitals also would be able to do these procedures in ambulatory surgery centers in their communities, as opposed to traveling and doing these procedures once a week in an academic setting 2 hours away. They can be doing that down the road and spending day blocks in the local community, already credentialed. Additional to that, the societies have training programs that are done, and there's a large number of graduating fellows from these programs every year. EUS is one of the largest growing procedures in gastroenterology year after year. And it's not because of the reimbursement, it is because of the capabilities it provides the physicians and the patient care capabilities. So we would take advantage, and we are already working with the societies on that front. We also have studies planned with a number of large teaching institutions that graduate these fellows. We're going to combine a number of large institutions throughout the US to start to train on endoscopic ultrasound earlier in their fellowships. So the goal isn't to be a fourth-year advanced fellowship to be able to do this, but to be able to incorporate ultrasound earlier in that training, to be able to expand even further the number of qualified users. So but in the reimbursement incentive, it's helpful, but you're providing much greater patient care on those endoscopies. The capabilities of our system are equivalent to the large systems that are found in these large urban settings. So, we see no downside to being able to offer it to more patients on more procedures with our device.
Okay, great. I know it was a kind of a softball question, so Woody's going to pitch you the hard one next. So.
Oh, perfect.
Yeah, well, clearly, Scott, not only did you do a great job, but in full disclosure, we already invested in you so that people know that we believe in everything that you're doing. I just want to underscore, what I believe that you've done is you've converted these regular endoscopes into ultrasound instruments, and the equivalent is like turning your kitchen spatula into a Swiss Army knife. Like, it's very clever, it's cost conscious, it's impressive. But hospitals, everyone is used to doing things the normal way. You're dealing with people that are cost conscious, a conservative device marketplace. I love the fact that you are there, that I like the SaaS model. Clearly, I see the opportunity, but how do you get the traction that you need to scale this thing? Because people are just used to what they're currently doing. They have something that sort of works. It might not work 100% to your point, but you're changing a whole thinking in a hospital setting, which doesn't like change.
No, that's a very good question, Woody. And it's honestly, it's a difficult challenge for any new device, especially in the gastroenterology space. So what we've done is we've tried to mirror existing devices as closely as possible, right? We want the same imaging quality. We want to be able to maneuver and navigate with our device the same way they did in training. So by and large, the learning curve is very short for use of our device with these advanced gastroenterologists. It's 4 or 5 procedures to feel acclimated with our technology versus the one that maybe they were trained on, or the one they've been using for 4 or 5 years in a different setting. So, luckily, I think that the challenges to overcome to be able to adopt our device are fairly minimal. That paired with the fact that the procedure is much, much more common and can be used on other things. And traditionally, our device is being used more on the diagnostic side of things, maybe taking samples, as opposed to cyst drainage procedure or a necrosectomy. I mean, these procedures are much more advanced that warrant use in the hospital. But the procedures we're doing and that we can provide access to and provide better care with, by and large, are not challenging to these physicians. Did that answer your question? Okay.
It does. Appreciate it.
Terrific. Okay, Leah is all yours.
Thank you. So, a similar disclaimer to Woody, Kingscroud Capital already happily invested into Endosound. And I think that one thing that was missing from the 5-minute pitch, and you just cannot say everything, is that you're already generating revenue. So can you kind of give our viewers a little bit an overview of the revenue you've been generating? And what I want to hear today is, what is your sales strategy to finally be able to kind of get that revenue growing?
Yeah, absolutely. So we've been very thoughtful in our growth, and I think it behooves us and many companies to take the same strategic approach, which is that we're more in a market development mindset right now. Our goal is to find the right accounts, to do the right procedures, to learn what the best way for onboarding those new accounts is. Learning the best way to help them with reimbursement and any challenges in that, training their staff, training our team. So we've been very thoughtful of how we've done that, and really want to grow, I guess, in a scale, in a way that we can provide support to. Our goal, we recognized early on that a Gen 2 product would help us with some usability things. Like any product, we're trying to continue to get the right device out there. That next product will be available later this year, and that's when we'll put a larger sales team out in the field and really migrate from that market development approach to more scalability. But right now, we're been very successful at our existing accounts, growing procedural volume, seeing more recurring revenue. We have numerous accounts that have grown their volume as they incorporate EUS in that index endoscopy that I talked about. But they've grown that significantly, upwards of 60% of their volume year over year.
Terrific. Well, as you can see, Devin's back in the room, which means that the big cane is going to come and pull you out right now, Scott. But thanks for your great work. Obviously, you've got 2 fans already in the room, and who knows, Paul may have invested since you started to talk. That would be entirely possible. But great job. Thanks for your good work, and best wishes to you.
Yeah, thank you, Chris, and thank you all the judges, and thank you, Devin.
All right. And we turn to our final pitch. So we've been talking health, and we've been talking science, and we've been talking medicine, and we've been talking about technology. And I think we're going to take a bit of a turn now with Joel, CEO AJNA Biosciences. So Joel, introduce yourself and give us your pitch.
Yes, Chris. Thank you for having me. I'm glad to be here. My name is Joel Stanley. I'm the CEO of Ajna Biosciences. I have spent, really my entire career, the better part of the last 2 decades, innovating in plant medicine. Really my history is highly relevant to what I'm doing today and why Ajna Biosciences, why we started Ajna Biosciences. I'm going to share screen. Hopefully this works quick. Okay, so Ajna Biosciences is a platform to turn medicinal plants into FDA-approved drugs. Where I started is I was the founding CEO of a company called Charlotte's Web, and I took it from its inception through IPO to a peak market cap of more than $2 billion. 5 years ago, I stepped away from that company to start this company. And everything that I learned at Charlotte's Web and everything that my team learned is directly relevant to Ajna. That experience wasn't just valuable to us, it was actually absolutely necessary to lay the foundation for what we're doing today. I do need to give a little bit of a background to kind of set the stage and the case for botanical drugs. Many viewers may remember the story of Charlotte Figge. I met her about 13 years ago. She was 5 years old. She was suffering from as many as 400 seizures per week. And with a very simple extract of ours, they dropped to nearly none, about 1 seizure a month. That story went completely global, mostly through CNN's Sanjay Gupta, but multiple other documentaries. And this opened doors for legalization, for new research, for new studies, and for new drug approval. It was everything we learned here that really showed us this was the first time that the world had seen a simple standardized botanical extract surpass the efficacy of multiple FDA-approved drugs. And though we help thousands of people with Charlotte's Web, still to this day, we're really moving that into the millions. You know, we realized we were just scratching the surface. And we realized there's this major gap, this problem that we don't have any botanical options available to us. We have only highly unnatural pharmaceuticals. Many of them work, but they also come with some unnatural side effects, as everyone knows. So we've really built a platform to bring natural medicines almost for the first time into the FDA approval process so that finally we can have some more natural, safer options like we gave to Charlotte and ultimately covered by insurance in the end. We're very unique in that, you know, I really call this the critical components to overcome the barriers to entry. Developing botanical drugs is very different than creating a dietary supplement. And very different than developing a conventional single molecule drug. You have to have the right infrastructure. We have a custom built laboratory. And then, you know, chemistry manufacturing controls, we call it CMC in drug development. That's fairly easy when you're dealing with one synthetic molecule. With a botanical extract, we're dealing with hundreds and sometimes thousands of different plant compounds. And so we have to characterize those compounds so that we can move them through the FDA. Then you have to have the right regulatory approach. There have been 4 FDA-approved botanical drugs to date. We anticipate being potentially the 5th, 6th, 7th, and 8th. And then you have to have the right clinical expertise. But what we've built, because of the story of Charlotte's Web, our experience, we've really built the team and the infrastructure to infiltrate one of the largest markets in the world. You know, U.S. pharmaceuticals do around $700 billion annual, 1.6 trillion global. And we're really moving some of the first natural options into that space. So it's a category disruptor, but more than that, it's important. We deserve these natural options. I'm just going to talk a little bit about the pipeline. I'll talk about the first drug for a moment. Our first drug, AJA001, is targeting autism spectrum disorder. Now, this is solving a massive unmet need. And the reason why is because there's only 2 FDA-approved drugs within autism spectrum disorder, both of which come with very severe side effects. And zooming out to the rest of the pipeline, we're looking at anxiety, PTSD, and other central nervous system disorders. Every indication we're going after, the studies we have to do, a lot of it's highly de-risked because with these botanicals, we already know that many of them work for the indication we're going after. So highly de-risked, and the first 4 drugs in the pipeline solving major unmet needs, which means they have major blockbuster potential. This is really as simple as taking age-old medicine, the intelligence of nature, and combining that with modern technology to really, for the first time, provide us with natural options, and we believe safer options, better options.
Did we lose Chris?
We lost Chris. Holy cow.
I think it's my turn to go first, so I can jump in.
You better, jump in.
Thank you.
Do you want to say anything, Chris, or should I just?
Just thanks, Joel, for that really important work. Obviously, natural remedies are the best way to go when there's an opportunity to do it. So great that you guys are doing very serious work and looking for natural ways for us to become healthy. So, and go for it, Woody.
Okay. Joel, this is really fascinating. You know, botanical medicine with FDA grade ambition. My yoga instructor would completely be on board with this. And, you know, we were at the World's Fair in Japan this summer, and the very first country we went into was Latvia. And their entire setup was about botanical and botanicals and how it's used to treat all sorts of ailments. And I could have spent the entire day there because it was wall plants everywhere. And I was really, really fascinated with this whole, this is the way it was done, like in the past. Why are we not using this today? Why are we having to create these chemicals and all that stuff? But how do you protect a botanical? Like, first of all, are there licenses you get for this? Is there some IP that you can get on a plant because everyone has access to a plant? Can you talk a little bit about that?
That's a very important question. Glad you asked it. It's highly misunderstood. A lot of people might think that, so if you're developing a botanical pharmaceutical and other people can access the plant, what stops someone from just replicating what you do out of the gate? First off, we do have first a minimum 20-year IP protection through what's called plant variety protection patent. Honestly, I was the first person to receive one of those from the patent office for a cannabis variety because I was the founder of Charlotte's Web. So we know a thing or two about it. So that's a 20-year time clock from the get-go. Plus, botanical drugs receive the indication exclusivity that's offered for any FDA-approved drug, and that's 5 to 7 years, depending on what indication you go after. But more importantly than both of those, and there's an actual case for this. Botanical drugs are so complex that even if you had access to the exact genetics that I have patented, it would be very, very difficult to genericize, this many compounds. There's one case, there's a drug called Premarin that's been on the market since the 1940s. 3 people have tried to genericize it. It's nowhere near as complex as a botanical, does come from pregnant horse estrogen. But it's complex enough that all 3 attempts to genericize it failed. So when we produce botanical drugs, we don't just have to go in and try to evergreen patents. We don't believe, in our IP council, which is some of the best in the game, has equipped me with this statement. We don't believe that we'll see generic competition. The only thing that would replace our drugs would be a drug that worked better for someone, which would be a good thing.
Fascinating. Thank you.
Terrific. Okay, Leah, you're next.
Amazing. So another disclaimer on my side, KingsCrowd Capital invested in Joel's previous round about a year ago, and I had the chance to visit their facility in Denver area. And what really fascinates me the most in all the drugs you're trying to develop is AJA002. I think it would be very important for our listeners right here to be able to hear more about what plant does AJ002 come from and what is the goal of that plant and what do you think is the potential in terms of market for your company?
Awesome. Thank you for that, Leah. That's a really good question. I'm also partial to drug number 2 in the pipeline. It does come from psilocybin mushrooms. And we have one of the very few DEA Schedule 1 manufacturing registrations in our laboratory in order to develop that drug. The reason why that drug is so important and going to solve a large unmet need is that the molecules from the mushroom very closely mimic our own serotonin. And it offers an opportunity to have a better antidepressant than the current ones that are on the market. We're talking TCAs, MAOIs, and mostly SSRIs. What those drugs do is they upregulate the amount of serotonin available at the synapse. So that's a happy molecule and it works for a little while, but your body seeks to find homeostasis. So it stops producing serotonin, right? It signals the body to stop producing it. And over time, people end up trapped on one of these drugs that's potentially no longer working, but they can't get off of it. So we bring an exogenous molecule that, believe it or not, is less toxic than our own serotonin by toxicity standards. There's such a thing as serotonin syndrome. You have food-drug interactions, drug-drug interactions with these other drugs. We don't have that with psilocybin, and more specifically psilocin, which is the molecule that's the most active from the mushroom. So we believe that we're bringing a very disruptive drug within this that's going to help a lot of people to get off of conventional antidepressants that are no longer working for them, that have a lot of side effects, that so far the data suggests that our drug would not have the same level of side effects.
Fascinating. Okay, Paul, what do you got?
Hey, Joel. Magic mushrooms as therapeutics? No wonder everyone gets along so well at fish concerts.
It's a brave new world. Yeah.
Yeah. Well, I absolutely love your methodical approach to FDA approval and the significant milestone of phase 2 clearance. Well, it's incredible. Also, the fact that you decided to form as a public benefit corporation, providing legal safeguards for you to look outside of your fiduciary duty, is very important to me. And someone who practices preventive medicine and has a primarily plant based diet, my values align perfectly with what you're doing. However, the methodical approach is a double edged sword. You want to do things the right way, but it's expensive and it raises questions about the capital pathway ahead. I appreciate your transparency about the need for additional funding rounds and potential dilution. Having reviewed your risk disclosures, it's clear you're being honest about the capital intensive nature of biotech development. Given this reality, I'm curious about your partnership strategy. Are you pursuing partnerships with larger pharma companies that could provide milestone payments during development, NIH grants, or other non-dilutive funding sources given your unique Schedule 1 capabilities, reducing the need for additional equity raises?
Thank you for the opportunity to answer that. I think it's a very important question. You also give the opportunity and bring in a major milestone, which in just 4 years we've reached phase 2 status. So we are raising money to go directly into pediatric and adult autism for AJA001. And these clinical trials are very expensive. This is drug development. This is biotech. It's not CPG. So we do have to raise big dollars. So this is a great question. And in short, we have multiple opportunities to us for non-dilutive financing as we reach these different milestones. And really, phase 2 status is where those doors begin to open for partnerships, yes, with large pharma, with mid pharma, and it's very common, especially once we achieve phase 2 results, moving into phase 3, which is a pivotal, very expensive trial. We have the opportunity to seek modes like royalty financing, where we make a partnership with a future commercialization partner, say Pfizer, Lilly, think big pharma, and they help to fund the trial non-dilutively for some commercialization rights or royalty rights to that drug. It's very common for a drug development platform like us to work with big pharma from our stage on. So I do anticipate this round of funding to fund phase 2, and then potentially that type of more strategic non-dilutive financing in our future. Drug over drug. So each asset has its opportunity to raise for itself once it can stand on its own 2 feet and it's in that phase 2 status or has phase 2 results.
Terrific, Joel. Thank you very much. Great questions, everybody. I love that you're as methodical on the medical side as you are on the business side. It's very impressive. So can see why our colleagues have made choices to support the work you're doing. So thank you very much. Great job. All right. We've got work to do now, right, boss?
Yeah, we have some serious work to do. Let me ask Shannon. There we go. Go ahead, Shannon. Put that up. We've got to start voting. The judges are going to deliberate, and you, the audience, are going to vote on your choice for the SuperCrowd Award. So the judges will pick one winner, the Judges' Choice Award winner, and the audience will choose the SuperCrowd Award winner. So please go ahead and start voting. I'm going to start the clock. And I'm going to excuse myself while the judges deliberate. We look forward to your decision.
All right, guys. What do you think?
You want to take it, Sherwood?
All right. This is, I'm trying not to let revenue bias me, okay? But I am biased on revenue. I'll just be honest about that because it's lower risk. It's proven market. They've got traction. I like that. You can't discount though that this when we're looking at these companies, the moonshot. We're seeing moonshots. These can be really big home runs, and I think we see that in like the Senogard and the Anja the biosciences. But the Anja, or is it? The evaluation I just can't get over. Like it's at 125 million right now, and I know they're in phase 2, and I realize you get a bump for that. But that's the one thing that would ding me right there on that. And I'm going to stick with the revenue, and Endosound is where I would put my number one.
I could go ahead if that's all right.
Yeah.
So, Woody, I totally agree with you. I think Endosound, from a financial standpoint, I mean, it's a clear winner. The surgical centers, the operators right now, they have dollar signs in their eyes seeing this. And I'm not being cynical by saying that. That's just the reality. They're a business, these surgical centers. The legacy hospitals, they're mostly nonprofit, and they see like 30 to 40% less patients per day and provide far better care than these surgical centers. And I just don't see how they can, because these things are going to fly off the shelf. I don't see how they can properly address the competency issue of having experienced people actually doing it. As much as I think they're trying their best. I think Scott and his team, I'm not trying to be critical of them. I'm just basically saying the reality of the situation. Senegard, as you said, this is a total moonshot. And really, I love the idea of using this cryoablation instead of radiation. But, it's so unknown. Yes, it's promising so far, but for me, I think it's a little bit too much of a risk. With Ajna, yeah, I mean, they are doing things slow and methodical, which I like, but yeah, it's more expensive, and it creates these situations where, as you said, they have these other, the financial structure doesn't look all that attractive to investors. But I think it's important that, and the other crazy thing is when you have do things the right way, look what it took. It took someone who has founded Charlotte's Web and has all these resources and essentially created a movement behind it in order to do things a slow and methodical way. So personally, I'm going to go with Ajna, but I think it's a bigger statement on this misalignment that we have with a systemic problem between financial incentives and patient outcome.
Thank you for sharing that, Paul. When I look at these three companies, first, I see a lot of similarities between Senegard and Endosound for the simple reason that they are taking a solution that already exists. You can already treat cancer that are lower than 4 centimeters. You can already do AUS, but they are building devices that can do the same thing as existing devices on the market, but simply at a way, way, way lower cost. And that really increases accessibility. And for that, I really, really commend these two companies. And I'm very excited about the opportunity. They both come at very different prices because they have different growth stages. They have different revenue stages as well. Now, when I look at Ajna, what I see is not increasing accessibility. It's kind of a dream, the dream to put botanical drugs on the market. And I truly believe that nature has given us the tool to solve a lot of the disease that we have. But now it will take somebody like Joel with a very strong background and really the ability to go over all of these drug development struggles and regulatory risks to be able to bring that off the market. So I do think that Rajna may be one of the riskiest companies out there, but that's where my vote is going today. So it looks like we have Ajna as a winner.
2-3.
Is you guys feel good about Ajna as your winner?
I'm good. Yeah, I love them too. So, listen, botanicals all the way.
Okay. All righty.
You're in Colorado, Woody.
Right.
That's great. Well, the voting is done. Let me see. Hang on here. Officially turn that off. No more votes will be counted, and the television audience has chosen Ajna Biosciences as well. So Joel gets the double victory. I think Joel has already stepped into the backstage. I think Diana figured out how to do it right. She's doing both. So Diana is hanging out in here. Diana, great job. I'm sure you'll find interested people in the backstage. Judges, I would invite you to head to the backstage as well. You may be able to talk further with some of these folks. I know all three of you have considered investing in all of these. Maybe there's a follow-up question on one of those that you haven't invested in this round, but I encourage you all to pop back there. With that, I will thank you all for the great job that you did. Paul, Leah, Woody, you work so hard as judges. You just do a phenomenal job. Combined, you probably put in 100 hours looking at these deals for the show and the event, and couldn't thank you enough. Leah, good luck to you in the coming 30 days. I think you've got some big news coming, and we wish you well. Paul, Woody, thank you very, very much. I'll let you go, and I hope you'll pop into the backstage. And folks, I want you to be thinking about that backstage option, the VIP option. It's not too late to participate. 4sc.fund/25. That'll get you get your ticket. You can be backstage talking to these companies that you just saw pitch, talking to the judges in 5 minutes. And we've got the VIP webinar plus more speakers to talk to in the coming hour. Some of the best content is coming up. We've got some amazing speakers. You don't want to miss this. I promise. This is for real. Great.
You're watching SuperCrowd25, the biggest event in impact crowdfunding. Over 2 days, top experts, investors, and mission-driven founders are sharing how to raise capital, discover profitable investment opportunities, and change the world. Stick around. You'll hear stories, strategies, and insights you won't find anywhere else. And if you want to go deeper, join our VIP community for just $25. Get backstage access, exclusive networking, speaker handouts, and a special VIP-only webinar. SuperCrowd25, crowdfunding the future. Impact starts here.
The property was dilapidated. It was horrible. It was code violations, drugs, crime, rundown RV trailers, no parking lot, no lights at night, just nothing. Our main focus is second chance housing. A lot of affordable housing households are led by single mothers. Our portfolio is 100% affordable. So our mandate is to be 20 to 30% below market rent. I'm personally $180,000 invested. We're only one of 2 companies globally to have a published social impact report for affordable housing on a Morningstar platform.
What's the faster way to build wealth? A traditional savings account at 0.38%, or worthy property bonds earning nearly 20 times more? Earn a fixed 7% APY starting with just $10, access your money anytime with no fees, all backed by real estate. Visit worthypropertybonds.com today.
The African diaspora is one of the biggest investors in the continent, but they are looking for a structured, transparent way of supporting this business. This is not donation. This is investment for return, including impact, and join our movement community. Thank you.
Behind today's biggest crowdfunding raises.
The leading CPA firm for Reg CF, Reg A, and Reg D compliance.
Trusted.
Experienced.
Set apart.
Join the CFPA for the Regulated Investment Crowdfunding Summit on October 21st and 22nd.
Register at ricsummit.org.
Rural property taxes fund vital services.
Only when they're paid.
Invest in real impact.
Visit invest.coretaxdeeds.com today.
None of these are working.
Let me guess. I'll bet you want to exit or diversify.
Thank you.
You're welcome.
ISPD strengthens health for families across Haiti.
Donate today. Make an impact.
Hello, everyone. I'm Gene Massey with Media Shares, and I'm very excited to be speaking at SuperCrowd25.
Save the date for Super Green Live, the global event on sustainability and green innovation, January 22nd through 24th, 2026.
We extend our deep appreciation to our supporting sponsors and co-hosts, including Potomac Growth, Energy Capital Funding Group, Move the Needle with Rob Kaplan, Ridgecrest Herbal, Stakeholder Enterprise, Renaissance League, the Global Equity Crowdfunding Alliance, the National Coalition for Community Capital, Green to Gold, and King's Crowd.
Enter to win one of 2 FireMax 11 tablets. Videos, books, and games come to life. Scan the QR code now.
Rules apply.
Welcome back. I am so excited. I sometimes get a little out of sync. You probably noticed this. We've only been doing this for 17 almost straight hours. We did get a little nap in last night, but we're so excited. I am so fortunate that I have whoa mayhem. I created my own mayhem here in my office. I have 3 computers, 4 monitors, and a phone all going, trying to keep, manage the little universe that I have in front of me. I want to introduce our next speaker. One of the real highlights of SuperCrowd LA was listening to Sarah Hardwick. She's the founder and CEO of The Crowd, a consulting firm that helps people with successful crowdfunding offerings. But she came from Aptera, a company that I've invested in. Frankly, I will confess it's the largest regulated investment crowdfunding investment I've made. So I blame it all on Sarah, but it's an exciting company, raised $140 million at least, but that much while she was there as the chief marketing officer. She led that effort. Boy, I tell you, proven expert on how to build a community and have success, especially when there is an impact, a cause angle to the business. So with that, let me bring Sarah onto the stage. Wait, what did I do? Okay, there you go. Okay.
Hi.
You can tell
Wow.
it's been a long couple of days. Okay.
Happy to be here.
We're thrilled to have you, Sarah. Let's see. Let's get your slides up. Do you want your slides? Your
B-roll? I was actually gonna just kick it off with the video, if that's okay. Just do a quick.
Let's show the video,
and then I'll dive into the slides. So
I think you get to start the video.
I need to. This video started. We're good. So as you mentioned, Devin, the last time I was here, I shared some stories from the early days of Aptera. Aptera is a solar electric vehicle that's raised over $140 million, probably even more now, from the crowd. And the real question is, what makes Aptera so compelling that tens of thousands of people want to invest in the company and back the company and follow the company? And the answer to that is psychology. So people invest when they believe in something that's bigger than themselves. And that's what we created with Aptera. So today I'll be exploring the psychology behind Aptera's $140 million plus campaign and what that reveals about emotional resonance, about values, and about how to connect with investors on a deeper level. So that's what I'll be talking about. We can, I think, dive into the slides now. Let me see if I can take these over. There we go. Okay. So the question is, why did Aptera connect so deeply with investors? And there are a few simple psychology concepts that can explain it. So when we understand these, I'm going to walk through about 3 of them today. I think you'll understand why people like our Aptera investors fall in love with companies like Aptera and campaigns and get behind them and love them, and how you as crowdfunders can tap into that power when you're raising capital. And there's a science behind what I'm talking about. It's called behavioral finance. And it's the study of how psychology and emotion work together to influence decision-making when it comes to finance and investments. And Let's see. There we go. All right. And we're good here. So really, you can see this is an ambassador of Aptera. He's hugging this beautiful vehicle, three-wheeled, beautiful vehicle. And this just kind of goes to show people didn't just like Aptera, they fell in love with Aptera. And I'm not kidding you when I say, fans printed their own merch, their own Aptera merch. I have a poetry book in my home of poems that someone wrote and published and sold on Amazon about Aptera. I've heard songs that were produced, compositions, children's books. People tell everyone that they know about their experience visiting the factory, peeking inside the factory. And that's what we're talking about here. We're talking about emotional resonance. And that's really what turns customers into investors. So really the first principle, the first concept I'm going to talk to you guys about is familiarity. And the idea behind this is that we invest in what we know and what is familiar to us. And this concept is called familiarity bias. So investors in general tend to favor companies and things and brands, whether you're buying it as an individual or whether you're investing in it, that you know and that are part of your everyday life. And we do see this as it relates to just brands that we see retail investors buying and investing in. We've got Apple and Tesla and Microsoft, and they're very heavily invested in and bought by investors, and in part just because they're a part of our everyday lives, and we see them and we view them and we know them. And so for companies like Aptera who are looking at crowdfunding, associating with these brands can create almost an immediate sense of this positive effect and really help to build trust in a way that's really compelling. Oops, whoa, here we go. And again, the idea behind this is framing your story in a way that people understand. So for these brands, we want to put them inside something that people already know. So here's a great example from Aptera. You can see Aptera parked, surprise, at a Tesla supercharger. And the idea here is, hey, Aptera is an electric vehicle. It's cool, it's innovative, just like Tesla. However, we are powered by the sun. So in addition to being able to plug in and charge like a Tesla, we're powered by the sun. And so for us, associating with that brand, it made it part of a story that people felt like they could already trust, that they already knew, that they could already relate to. So especially for Aptera, you're a startup in a category that no one really knows, or you're doing something innovative. It's helpful and valuable for you to be able to associate with brands. Now, this could be a partnership with another company that has a well-known brand. This could be association with different industry leaders, even if they're a bit different. But this idea of leaning into familiarity and trust is one of the psychological concepts and clues and keys that we were able to tap into with Aptera. The second driver is emotion. And this is feelings and our gut instinct and that is what inspires people to act. We act based on our emotions. And I'm going to put I hope you guys can see this. This is a great meme here. You've got the brain up over here on one side, and it's like, it's talking to the heart. I hate it when you make me look like an idiot. And that's what happens sometimes. It's a constant battle between our brains and our hearts. And most often, your heart is what is going to win. And in fact, 3/4 of our decisions are made by emotional factors, not rational factors. And that's what research shows. So if you're to think about some of the decisions that you've made, let's say you're, buying a home or going on a vacation, or in my case, choosing who you might want or might not want to date. You may weigh the pros and cons. You may think rationally about what to do or what not to do. But at the end of the day, it all comes down to what you feel in your gut. It's really not logical. And the video that I showed earlier when I first started was Aptera's launch video. And that was the video we chose to launch our crowdfunding campaign. It wasn't rational, but it evoked an emotional response. People felt excited and hopeful and curious. And it evoked a sense of wonder in the sense of what we want the world to be like. And so when we can bring emotion in, even though it's not logical, and Aptera wasn't logical, it was not a practical car. If you have kids, if you are a senior, it's not logical, but at the same time, it did not stop people from absolutely loving the vehicle. So the tip here is really lead with emotion first. So while you may be tempted to talk about your valuation and your market cap and all these great things, at the end of the day, if you can hook them in with emotion, you can give them reasons to believe that are financial and give them, rational reasons to believe, but you've got to have that emotional hook and that story. And once people have that emotional hook, they want to look further and they want to talk more with you. The next driver, the third psychological principle that we utilized in the Aptera campaign is identity. And what we've learned here is that we invest in who we are and also who we want to be. And our investments say something. They do say something about who we are. Depending on what you invest in, you're aligning yourselves with a brand or a company, and you're kind of making a statement about who you are. So when it relates to Aptera, you can see our amazing group of ambassadors here. Aptera fans wanted to be first movers. They wanted to be the first. They wanted to be disruptors. They wanted to be the ones to usher in a new movement, a new era of change. And that was the solar mobility movement. No more were we tethered to the gas station, tethered to the charging station. We were going to be free, off the grid, and powered by the sun. And this was a movement. This was a statement about our identity and what we really believed in. And the idea here is to position your campaign as something really that you can be a part of, that you can be surrounded by a community of people who believe in what you're doing and who feel the same way as you. And that was one of the reasons why Aptera's investment campaign was so successful. And that was because people were part of a movement that was greater than them. You see our ambassadors. We had 800 ambassadors all across the globe going to events and lobbying their Congress people and monitoring social media. And all of these things happened because of this connection that people had to wanting to be behind the driver's seat of an Aptera, to have Aptera in their lives, and because Aptera said something about who they are and what their view of the world is. And so your job as a crowdfunder is to say something, is to make a statement, is to take a stand on who you are and what your view of the world is, and to put yourself out there and get people excited. And that's a really, really powerful thing. The next slide here is all about shared value. So identity and who we are, it's very powerful, but that shared values and values are even more powerful. Now, I'm going to spend a little bit of time on this. I don't know if you guys can see this because it's small, but if you send me a message or chat with me, I would be happy to send you a bigger copy and also walk through this a little bit more deeply with you. But essentially, there are 6 universal value types that drive all human behavior, including investor behavior. And every successful crowdfunding campaign connects on one of those values. Those campaigns succeed when you basically have to frame yourself aligned with some of those values that investors hold. So it's really important to kind of dig in and look at your investors in a way that's deeper than just demographics. I ask a lot of clients at the crowd, I say, what do we know about our investors? And they say, well, they're 35 to 45 and their income is this and they live in this region. And that is just not enough. You have to dig deeper and you have to get into the heart and soul. What keeps them up at night? What are they passionate about? What are their hopes and dreams and goals and thoughts? And when you can understand and uncover those values, then you're in business. If you see this values wheel that I have here, you can see there's 6 different values. The idea is that the values that are closer together on this wheel, I'll kind of list them out in case you can't see them. We've got achievement, pleasure, freedom, purpose, tradition, and security. And I don't care who you are. These are the fundamental values. This is 40 years of proven psychology research. Shalom Schwartz, you can look it up, the theory of values. These are proven and they relate to investors as well as they relate to consumer buying behavior. So for the closer they are together, thank you, Devin, the closer they are together, the more similar they are. So freedom and purpose are very similar. Achievement and purpose, completely opposite. So if you're trying to talk to someone about the greater good and giving back in the world and making change, the opposite of that is my own status and power and recognition and doing things for my own reputation. So it's very challenging to target different values. If they're not similar, they're polarizing. So understanding the values of your investors and really digging into those psychographics, as they call them, is very important. So I'm going to give you an example that relates to Aptera. When I first started with Aptera, I thought all of our investors must be motivated by purpose, right? They must care about being carbon neutral and sustainability. And that must be the motivating factor, because that's what Aptera really is all about. Surprise! We did a bunch of research and come to find out Aptera investors, as you might have guessed, are motivated by freedom. As I said, they want to be the first. They want to be disruptors. They believe that the status quo is just not good enough. And that is why they are motivated to invest in Aptera, because they care so much about this idea of this is not good enough. The world as we know it, no, we can be better. And Aptera is the solution and part of this future that they all believe in. So that's really where, values become very powerful. And I think it's really important to dig in and see kind of what happens with that. And what you might find, your values, as I'll kind of talk about later, they influence the copy, the messaging copy, the ads, what's on your landing page, who is it speaking to, what words are you using? And if you look at, different crowdfunding platforms, look at, different marketplaces, or you look at the way different campaigns are presented, you will see it's about security and stability. Or if you look at health related campaigns, they're very focused on your family. If you look at others, they're focused on different things. And whether or not you know it, your campaigns are speaking and articulating and communicating to values. You just have to be sure that those values are the values that you really want to be speaking to. So uncovering and understanding those values is really important. Now, alignment, it's all about finding the overlap between your values and what you care about and your investors' values. And this is where your campaigns start to get real traction. So if you think about this is almost like your sweet spot. So you've got your company values, right? What you stand for, your purpose, what you believe in, why you started this, what you want to accomplish, what your hope is, what legacy you want to leave. All of those things are around your company values and your company purpose. Then you've got your investor values. Now, if you think about this, it's like the 80-20 rule applies here. So you want to focus on investors who are most aligned with your values, and those will become your best investors. Those will become your ambassadors. Those will be the ones who will be repeat investors. Those are the ones that are going to be out there as your champions, as your loyal followers. So when you can find that connecting point, that alignment between investor values and community values and company values, that is really a magic moment. And for Aptera, that idea was really brought to life. So you can kind of see, here we go. We knew that our audience was freedom seekers. Here we are. Where do freedom seekers want to be? They want to be off the grid. They want to be camping. They want to be in nature. They want to be powered by solar mobility. They want to be a part of this beautiful future that you've created as a company. And as what they're funding is this vision. So you have to align with this vision. That alignment will increase loyalty. They'll be satisfied. And believe me, they will be a part of your community forever. And that's where, when you talk about customers becoming investors, this is the key to that happening, is alignment with values and understanding the values and speaking to those values. And that's a really, really powerful thing. So in closing, a couple of takeaways here, and I don't know, we'll see, Devin will tell me if I have time for a question or two, but the idea here is that psychology and values are powerful drivers in your crowdfunding campaign. And investors are going to put their money where they feel a connection. They want to back a world and a future that they want to be in, that they associate with, that they align with, that they want to live in. And the more that you can communicate that, the better. So going back to those key psychology principles, this idea of familiarity, it gives them trust in you, trust in your brand, trust in who you are and what you stand for. Emotion, it sparks action. It makes them move. It gets them excited, and it makes them, take that next step. Identity makes it personal. It gives them the view of who they are and what you are going to, how you fit in their life. And then this idea of shared values, it's what turns this campaign, this crowdfunding campaign, into a community. And that's what we did with Aptera. So thank you very much, and appreciate all of you. I think I'm looking at some comments in the chat where we've got some investors and some fans and followers, and I love you all. And I'm happy to, do I have time for a question? No. Close.
This is really, it looks like Shannon had to unmute me.
Okay. I was like, was that
all
me?
I said was I'm discombobulated, which I proved by talking while I was muted. So, Sarah, this is such a powerful message, especially for our audience, the entrepreneurs in our audience, in our community, who are passionate change makers, who are trying to do their best to really make a difference in the world. They're listening to your message and they're going, holy cow, this could work, right? It seems to me one of the takeaways from your message is that done well, done correctly, that social impact, that difference you make in the world can really enhance your success in raising capital from the crowd.
Yeah.
And there's a perception sometimes that that social impacts is a tax. In fact, venture capital, people who try to raise venture capital often tell me, if I say anything about social impact, they treat it like, oh well, then we can't invest in it. Why does it work with the crowd? Tell us about that.
Well, I think you're tapping into, again, what people care about. And in this case, when you're talking about social impact, you are tapping into people who believe that the world can be a better place and that we should do something and that it takes all of us and that that now is the time to make a change. And those are very powerful emotions. And so, yes, it's scary because you do risk alienating people and you risk, kind of maybe you don't get that VC, funding. But at the end of the day, is that really who you want? I would say that you want people who are aligned. You want VCs, you want supporters, whether they're investors or partners, employees who believe in what you are trying to accomplish and your why and your purpose. And I do believe that your purpose can be a powerful differentiator and a powerful selling point against the competition because they're trying to speak to everyone. They're trying to be all things to all people. But when you double down, when you think of that sweet spot, that 80-20 rule, you will get so much more by focusing in on who you really are, knowing who you are, and focusing in on who really cares about your message than you ever will by trying to just go out with a mass message that's not as impactful.
Yeah, I love that point, and I just think that is such an important takeaway for this sort of last hour of SuperCrowd25. To have this be part of the closing discussion. That really what we're saying is that impact is not a disadvantage. Done well, it's an advantage. It can power your success instead of limiting your success. Lean into it, celebrate it, right?
Yes, I would say it's a non-negotiable.
Yeah.
Impact is who you are. It's what you do. It's how you rally people. It's why they care. It is everything. And so leaning into that is what we're all about. And I absolutely feel like that. This is why we're here, Devin. And I'm so happy you brought all these people together who are going to make an impact. And all together, us here, we are here because we care. And your investors and your community are here because we care. And I do believe that leaning into that is the most powerful thing. It is really so special. So I'm happy to deliver that message in the closing session.
Well, fantastic. Now, Sarah, thank you so much for taking the time to be with us. I hope you will pop into the backstage for a few minutes, because
I will be right after this. I'm coming in.
Okay, great. And folks, I know you're thinking, Devin, stop talking about this. There's an hour to go. Well, yeah, there's an hour to go. You get to meet Sarah. You get to meet Dr. Van. You get to spend time with me. I'm going to take an hour and provide a VIP webinar this evening for everyone who shows up, all the VIPs. And I'm going to walk you through step by step how to raise capital from the crowd. You can still get value well worth the $25, plus the VIP LinkedIn group, plus the handouts and the slides and the stuff that I'm going to load in there that people like Sarah will provide. My good heavens, you get your money's worth, even if you do it now. So go ahead, 4sc.fund/25. Sarah, thank you so much for being here. We'll look forward to chatting with you again in the future. Thank you so much.
Sounds great. Thank you. I'll be in the VIP for anyone who wants to have any other chats. And thank you for the opportunity. See you soon.
Thanks. Bye. Okay. We have such a neat opportunity now to kind of end the day with my friend, Dr. Kanan Van Williams. Dr. Van, as we call him, is the head of Proactive Realty Group. They're doing a crowdfunding campaign right now on their project in Vegas. It's called Rancho Affordable Living. And when he talks about affordable living, let me tell you, he's not messing around, right? It's genuinely affordable housing. And and let me be clear too, over and over, he's been doing this for decades. He makes a profit on this stuff, right? And now he's offering investors the opportunity to share in the profits. This is a no-brainer, people. This is a no-brainer. Okay, check it out. But Dr. Van is going to be with us. Such a wonderful, purpose-driven entrepreneur. I can't wait to have him on. Dr. Van, let's see. I got to do that. I got to do this. Dr. Van, are you there? Are you there?
Yes, I am, Devin.
Great. There we go. Now we see the handsome man that you are.
Really?
Dr. Van, thank you so much. I want to thank you for sponsoring SuperCrowd25. You're a Max Impact sponsor, and boy, you have had an impact. It's just been huge. I thank you for that. That cannot go unsaid. I appreciate you making time to come back as we head toward the final thoughts of the day. As you think about the work that you're doing in Vegas, Rancho Affordable Living, let's just dig right in.
Okay.
Tell us about that project. How many units? What are you doing? Give us a sense of the operation, the plan, the go-forward execution.
Okay, thank you. I'm glad to be here, Devin. Thank you for that great introduction. I appreciate it. Today is Friday. Happy Friday to everyone. First, give an honor to God, and I'm just very thankful. My faith is in Christ, and I'm very thankful for that. And that's at the center of execution. That's at the center of everything that I do and that we do over at Proactive. What I'd like to say is that it's a 23-unit project. It's really in poor condition right now. It mirrors what Rancho used to look like. So we repositioned Rancho at 1735 North Las Vegas Boulevard. And for any of your listeners and viewers who've been absolutely gracious and fantastic, we'd be happy to share our before and afters and more detailed videos as to what it is that we did there. So the plan of execution is we'll go in, we'll replace the 23 units. with brand new low E energy efficient manufactured housing. There's frontage right there. There's a building that can either be torn down or either transitioned into an office. And I'm thinking that if we keep the building up, it used to be an old bar. It's probably about 1,500 square feet that we would use 500 square feet for office space, and we would sell ADUs, tiny houses right there in the front. We have another website called sheddominiums.com or shedliving.com, shedliving.com, which is part of our rapid housing initiative. So we'd sell those right there on Rancho. We'd be able to provide affordable 2-bedroom, 1-bath homes for 23 individuals and families. And so that's our plan of execution there. We don't get to talk about returns too much, but it is a current income offering.
Yeah, this is a phenomenal thing, and I want to talk about an awkward part of this.
Okay.
And if you take me back in time a decade, I would have been among those who had a little bit of a hang up about manufactured housing, mobile homes. That's not good housing. I've completely come to the opposite conclusion over the last decade. But I wonder if you would walk us through why these work so well to provide genuine, quality, affordable housing. You talked about LEED certification. Tell us more about why this works so well, because I think it does.
Yes, great question, Devin. One of the things that I forgot is that because we have a dealer's license, we're able to bring manufactured housing in at cost from the factory. What does that mean? That means that a manufactured home that's 2-bedroom, 1-bath, that may have a retail price of 90 to 120,000, we'll bring in that same home for 40 to 50,000, have it set up, affixed to the ground, installed, and we pass that savings on to our residents.
Wow. But these are, more importantly, I want to emphasize that when, a lot of people have never been in a mobile home. Mm-hmm. And I think some people confuse a mobile home with an RV, right? Those are very different standards, aren't they? The construction standard of, maybe you've been in somebody's, RV trailer and you're confusing an RV trailer with a mobile home and thinking it's the same quality construction. That's not the case, is it?
No, it's not. And I'm really glad that you pointed that out. So with manufactured homes, they're built to HUD code, like your HUD stick-built houses. They're built to HUD code. So they have to have a certain roof load. They have to have a certain insulation. They have to have a certain type of floor, walls. Some are sheetrock finish. They're very modern and very energy efficient, the new manufactured homes. So mobile homes are think pre 1980s. Think about your mobile homes. However, manufactured homes built to HUD code, think about anything from, call it 1995, 1997 forward. Although they had HUD code, they're so much more energy efficient. They have some from legacy housing that we have access to that even have EV plugs built into them to charge your electric vehicle.
That's wild. It's just, it's hard, I think, for people to appreciate that when you are doing a project where you're bringing in this new manufactured housing, that you are providing upscale opportunities for people for quality living. They picture, I think, too often the old RV trailer but oftentimes, I think what you're helping people do is move out of the old RV trailer and into a quality manufactured home that's anchored to the ground, that's warm and safe and air conditioned in the summer in Vegas. That's important, right? Am I thinking about this right?
Absolutely. So a lot of today's manufactured homes come with They have like they'll have a mini split. They'll have a condenser. They have a heat pump. They have energy efficient appliances that are brand new. There's so many amenities that the new manufactured homes have, and they're low E energy certified. And they use Energy Star appliances, Energy Star stoves, refrigerators, Whirlpool, Frigidaire. They have the above the microwave space saver. Uh, and so a lot of times, just real quick, pivoting here just a little bit. One of the exciting things that we do at Proactive is once we have brand new homes, wherever they are, whether they're Las Vegas, South Carolina, Indiana, Ohio, is that we leave the plastic on. So the straps that are on the refrigerator, the plastic that's on the stove, I can't tell you, and we got that idea from the very first time we had brand new manufactured homes. And we had families that came in and the kids just looked like it was Christmas. Just you could just tell on their faces. And they were able to unwrap and cut the straps on their brand new appliances. And they were the very first people to live in these homes. So imagine what that could be like coming from slum, and people who have seen our before and after videos at Rancho. That was really a big deal at Rancho when we brought in brand new manufactured homes. It's just like, uh, and to your point, we had a social worker who says, "Oh, you know what, Dr. Williams, we are not dealing with no mobile homes." I says, "Okay, but we'll stop by the place and take a look at it." I says, "Okay." And so I happened to be home that week. My manager was off, and I live in Las Vegas also, by the way. And so she comes in, she goes into one manufactured home, and she says, "We're going to take all of them. How many do you have? How many bedrooms? We have families lined up."
Yeah, yeah. There's kind of this hang up, right? This perception, and I worry that people are letting that pause their support for your project, when in fact, when people are faced with the alternative of no housing or very substandard housing, being able to move into a brand new mobile home, a brand new manufactured home, is a huge upgrade, huge upgrade. And I hope that that message gets conveyed through, and you can do this on a way that's affordable for the clients. And again, we have to be cautious about returns, but you can talk about your profits. You can make a profit on this, and that profit gets shared with your investors, right?
Oh, absolutely. And it's as I was stating before, it's current income. So, and there's no slight against anyone else in their Reg CF campaigns, because some campaigns are current income and some are not. It just depends on, what the product is. However, for us in the low income affordable housing space, it just happens that, like 90% of the properties that we buy come with, residents in place. We don't displace anyone. And it comes with current income. So yes, they're pretty profitable. Most of the deals that we go into are very profitable. When we go in, they say in real estate, it's not the exit, it's when you buy. And for us, we hold on to properties anyway, long term. The only events we'll have, we do have liquidity events where we'll refinance the property with favorable financing. And again, that goes to us buying the property right for, a discounted rate, pennies on the dollar. And I just wanted to share with the audience a little bit about how just want to share with that something that affects all of us is the affordable housing crisis, and just how Proactive is part of the solution. And the reality is that, Devin, and we all know this, is that rents are rising faster than wages. And there's too many families who are one paycheck away from losing their homes. Most developers are focused on luxury, while working families, veterans, and seniors are being left behind. And behind every statistic is a story, a real story. A mom trying to keep her kids in the same school, a veteran who served this country but can't find a stable home, a retiree forced to choose between rent and medication or copays. I'm sure a lot of people are familiar with copays. Those aren't just numbers; those are real people. So, so Rancho Affordable Living is an answer to affordable housing and the answer to building a model that allows people, that allows us to go in and transform undervalued housing in Vegas into stable, affordable, and sustainable homes for working families. We buy properties no one else wants to, ones that are often, undervalued and overlooked. We rehabilitate them. We make them safe, energy efficient. We operate them with with dignity and no predatory practices, no unnecessary displacement. We operate from an impact framework and from a real theory of change. And how can we change? How can we be change agents in other people's lives? And not only how can we be change agents, but how can we be sustainable chain agents? We hear these ESG terms all the time. We hear sustainability all the time. We hear affordable housing all the time. The truth is, we're low income social impact affordable housing. We've democratized the process so that it's not just the people on Wall Street or the people, the big, Bitcoin buyers or stock buyers or bond buyers on Wall Street or, in the huge capital markets or private equity, or as little as $500 to $1,000. Someone can come in and invest. We have a very short hold time of targeted 3 years. And, it's current income while you wait. And then, and most importantly, is that you're transforming lives in the process. And we're focused on our sustainable development goals. We're 20 to 30% below market rate on rents. And for those of you who don't know, I encourage you to study up on sustainable development goals and what those are the United Nations has.
And it's wonderful the way you're thoughtful about the social impact, right? The social
Yes.
impact on the people you're serving directly, the quality of their health, the quality of the environment, the quality of our whole globe as you look at trying to use the Energy Star efficiency, things. You talked about the heat pumps. We've all got to figure out a way to get a heat pump in our house, replacing those gas furnaces or worse, because that's the only way we're going to be able to use the sun in our current technology to get, zero fuel energy heating our home. So you're doing it. You're doing it right now. You're the model for how this can be done, should be done. I want to see people supporting you because it is so unique in all the world that you are walking the talk in ways that so few do, right? 100% affordable housing. You're not doing big condo projects, sky rises, and putting 30 out of 300 units that are affordable. No, you've got projects,
Exactly.
100% of all your projects genuinely affordable. Amazing.
Oh, yeah. Absolutely. And that's because we buy NOAA properties, naturally occurring affordable housing. We're not building anything new ground up. And by the way, Rancho is another property that'll be rapid housing. So as quick as we go in, we're in contract before we close. We have permits in hand. We don't have them in hand that day. We have them in hand the very next day, as soon as possible that they are available. So I'm excited about that, the rapid housing that we create. Now, one thing I'd like to mention, Devin, if I have a couple quick minutes here, and
Sure,
let
go
me know
ahead.
when I get close to time, is that there's someone who's been so inspirational and a real inspiration for me, and he's one of the strongest people I know in a crowdfunding space, in the impact space, and a mentor, and that's Devin Thorpe. I'm very thankful for you, Devin. I'm very thankful for all of your assistance. I'm very thankful for the network that you've created, the platform that you've created. I'm absolutely elated to be a sponsor. I can't wait to be a sponsor at your next event. The other thing is thank you for helping me with the book cover design. I mean, Devin's a person who has his own life outside of everything that he's doing. And 8, 9 o'clock in the evening, he's available. I send him a text and he's like, okay, I just finished dinner. Dr. Van, how can I help? Okay, let's do 2 or 3 revisions. Let's walk through this thing. And so I just thank him for, he is a true example of faith. He's a man of faith, and I can see it. Sometimes it's like, okay, people read a Bible by your actions before they even, open up one. And so Devin is a real deal. So I just want to say thank you. And I appreciate you having me on your platform.
Well, Dr. Van, thank you. Thank you.
And what do we have next, Devin?
I appreciate you. I think we're about ready to wrap up, Dr. Van, but thank you. As we wrap up, maybe Shannon, maybe you can throw that back up on the screen there. Dr. Van, tell us how people can learn more about your offering, how they can connect with you. Remind them too, you threw out an interesting website, the Shed Living, I think shedliving.com. But share some of your websites where people can learn more about how to back you with the Rancho especially, but your other projects as well.
Okay, yes, they can send me an email at Canaan@sustainablebonds.com, or they can log on to www.sustainablebonds.com, or they can send me a message, or my phone number is 803-989-8264, 803-989-8264, and you have my email, Canaan@proactivefunds.com, and you have the link to our Rancho Affordable Living offering. I'm in Las Vegas, so if anyone comes, they're in that area, or they'd like to connect, let me know. I travel to several states all the time. And if I'm in a state that you're in, I'd be happy to take you out to Starbucks or lunch and network over Zoom and talk. But again, so Devin has our link for our Rancho Affordable Living.
There's a QR code on the screen for that, Dr. Van.
Yes.
And we've got a short link there that's easy, relatively easy. Type in 4sc.fund/rancho, 4sc.fund/rancho. So, Dr. Van, thank you so much. I appreciate your support. I appreciate your kind words. Want to see you succeed. I hope this raise is complete by the time we close this meeting, that you filled the raise. I really want to encourage everybody who's watching, check it out. Dr. Van, thank you very, very much. I hope you'll pop into the Zoom. There's a great conversation going on backstage. So check it out.
Now I have the link for that, Devin. Oh, and by the way, I'd be remiss if I didn't say I absolutely am very thankful for William Bill Houston, who's been a super mentor and who connected me to Devin. And he's been fantastic with his CrowdMax. You talk about an expert. He knows precisely what he's doing, how to do it, what to do, and how to raise. So I'm very thankful for Bill Houston.
Yeah. Bill is the man. He's the man.
Yes. And I want to make sure I have the link. Okay.
So I'm pretty sure, Doctor, that Bill has it. Grab it from him. I got to do a short wrap up here, but thank you very, very much. Well, as we wrap up, this 2-day event, I want to just share a couple of thoughts here. First off, I need to thank Chandon. Chandon has been. I want to put this into perspective for you, because Chandon works in Dhaka, Bangladesh, and if you're in the United States, you appreciate that it's daytime now, which means, of course, it's nighttime there. The sun is just coming up. It's about 10 to 6 in Dhaka. And Chandon has been up all night, keeping track. He's less discombobulated, I can assure you, than I am. And I have been up all day. So he's a great guy. So Chandon, thank you for all the work you do, especially taking care of me. I want to just highlight a couple of the key themes that we've seen at SuperCrowd25. One of the key themes is this contrast between extractive capital and community capital. And when we build real, genuine community capital, it can be transformative. We've seen it throughout history. And there are so many places. I live in a place that desperately needs it and doesn't do it well. I hope that as you are walking around your lives, world, look for opportunities. Let's let's transition our economy from an extractive model to a community focused model. A key theme came up over and over again. I don't know how many times people have talked about Investimers. And of course, that's the title of Woody's new book. And Woody's been on, he's a judge, he spoke. The insight here is that a business with customers, and so many small businesses have lots and lots of customers, have access to capital because customers make great investors. They become investors and they become fans, allies, and there's great data to show how much more they become engaged once they are both customers and investors. I want to talk about another aspect of this, and that is that crowdfunding serves global and local purposes equally well, right? Michael Schumann kicked off this morning talking about this idea that crowdfunding saves the world. And a key theme he was talking about is climate solutions. We had a whole panel discussion about climate solutions yesterday. And the key takeaway is crowdfunding is an essential element of climate solution finance. It's absolutely essential. It's one of the key reasons we're helping to host Super Green Live in January. I hope you'll save the date and be part of that. But crowdfunding also works locally. It's a vital part, and we just talked about that, of the local economy. So building up a stronger local community. And so I want to see us emphasize both sides of that coin. Another key theme that we keep seeing now, in part because of the new regulatory environment in which we find ourselves, it looks like the blockchain technology and crowdfunding are likely to fully intersect and become essentially one thing over the next decade, and that could begin much more quickly than some of us anticipated. I think 5 or 6 years ago, I saw this coming. I had come to believe it was not going to happen. I'm now back in the camp of it's coming. We've got to get ready. We've got to understand that. That's a key takeaway from this. We've got to begin understanding these rules, how to leverage them, how to take advantage of them, and make sure that they are serving community, serving our, the social impact we seek, so that we don't lose sight of that as we build using the new technology. I know I've hit on this a few times today, and I'm not going to stop. It's not too late to get your VIP ticket. In 5 minutes, I'll be doing a webinar on how to raise capital from the crowd. We're going to take you through step by step and teach you how to use some AI tools to make it easier. Ron Miller said it very well today when he was talking. Crowdfunding is hard work. Well, if you want crowdfunding to be less hard work, I think we all do in this game, I'll show you how to use a few AI tricks to make it a little bit easier. So you are not done. We're good to go. So with that, let me just thank one last time our sponsors, all of our speakers. The content that we have enjoyed over the past 2 days is just mind-blowing. And I am so excited that we have the opportunity to share this content with you. If you are thoughtful about it, if you watch the replays, if you get the VIP ticket and get access to all of the follow-up information, this can be transformative, truly life-changing, because the insights you heard here, you're just not going to get anywhere else in one succinct thing. So take advantage. With that, let me again acknowledge our sponsors and thank them, Dr. Van, especially our Max Impact sponsor, but all of our sponsors. And as I play this video for the last time today, I really want to invite you to jot down the names of the sponsors. Check out the sponsors. Learn more about the sponsors. They are mission-aligned organizations doing things that you want to do Let's work together. Let's get this flywheel going in this ecosystem so everyone benefits. All righty. We'll see you next year at SuperCrowd26.
You're watching SuperCrowd25, the biggest event in impact crowdfunding. Over 2 days, top experts, investors, and mission-driven founders are sharing how to raise capital, discover profitable investment opportunities, and change the world. Stick around. You'll hear stories, strategies, and insights you won't find anywhere else. And if you want to go deeper, join our VIP community for just $25. Get backstage access, exclusive networking, speaker handouts, and a special VIP-only webinar. SuperCrowd25, crowdfunding the future. Impact starts here.
The property was dilapidated. It was horrible. It was code violations, drugs, crime, rundown RV trailers, no parking lot, no lights at night, just nothing. Our main focus is second chance housing. A lot of affordable housing households are led by single mothers. Our portfolio is 100% affordable. So our mandate is to be 20 to 30% below market rent. I'm personally $180,000 invested. We're only one of 2 companies globally to have a published social impact report for affordable housing on a Morningstar platform.
What's the faster way to build wealth? A traditional savings account at 0.38%, or worthy property bonds earning nearly 20 times more. Earn a fixed 7% APY starting with just $10, access your money anytime with no fees, all backed by real estate. Visit worthypropertybonds.com today.
The African diaspora is one of the biggest investors in the continent, but they are looking for a structured, transparent way of supporting this business. This is not donation. This is investment for return, including impact, and join our movement community. Thank you.
Behind today's biggest crowdfunding raises,
the leading CPA firm for Reg CF, Reg A, and Reg D compliance.
Trusted,
experienced,
set apart.
Join the CFPA for the Regulated Investment Crowdfunding Summit on October 21st and 22nd.
Register at ricsummit.org.
Rural property taxes fund vital services.
Only when they're paid.
Invest in real impact.
Visit invest.coretaxdeeds.com today.
None of these are working.
Let me guess. I'll bet you want to exit or diversify.
Thank you.
You're welcome.
ISPD strengthens health for families across Haiti.
Donate today. Make an impact.
Hello, everyone. I'm Gene Massey with Media Shares, and I'm very excited to be speaking at SuperCrowd25.
Save the date for Super Green Live, the global event on sustainability and green innovation, January 22nd through 24th, 2026.
We extend our deep appreciation to our supporting sponsors and co-hosts, including Potomac Growth, Energy Capital Funding Group, Move the Needle with Rob Kaplan, Ridgecrest Herbal, Stakeholder Enterprise, Renaissance League, the Global Equity Crowdfunding Alliance, the National Coalition for Community Capital, Green to Gold, and King's Crowd.
Enter to win one of 2 FireMax 11 tablets. Videos,